All right. Thank you, Greg. Thanks for coming. My name is Jeff Gibby. I'm going to kick off things today. Thank you for being here. You should be able to hear me. You should be able to see me. And you should be able to see my screen. So all those things are going well. We're off to a good start. If you're joining us on YouTube, thank you. It's good to see you there too. If you do like the show today, make sure to like and subscribe. If you have questions, make sure you ask. In GoToWebinar, there's a little questions box. If you click on that, you can send us a question. And in YouTube, just ask in chat. And either way will help you. We'll be happy to answer those questions. So in any case, let's go ahead and kick things off. Thank you for being here. It's good to see you. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information presented today should be construed as investment advice or the solicitation to buy a security or any security. Hello, Lori. Thanks for saying hello. Hello, Vincenzo. Thank you for saying hello. Good to see everybody today. All right. Before we kick off, I'm going to talk a little bit about some of the sponsors we have. There's only 4 of them. I'm going to go rather quickly so we can start on time and maybe stay on time. I want to say thank you to the American Association of Individual Investors, nonprofit, been doing their nonprofit stuff for a number of years. I'm sure you've heard about like the AAII investor sentiment surveys and all that kind of good stuff. AAII is a sponsor of our event and we appreciate it. If you want to find out more about what they do, go to www.aai.com. All right. Also want to thank Stocks and Commodities Magazine. They've been a long time running sponsor of Metastock and the events that we do. Ever since we started them, oh my gosh, it's been 14 or 15 years ago now. So really appreciate them. Stocks and Commodities is a great magazine. Every month they send in articles about kind of technical analysis and routines and that kind of stuff. They've done 17,000 articles, and if you subscribe to them, you get access to all of those. www.traders.com. Traders Forum, if you haven't joined the Traders Forum community yet, you should. It's absolutely free. There's a lot of really cool stuff that goes on up there, a lot of market chat, market discussion, lots of lessons you can get. www.thetradersforum. Of course, we're Metastock. Metastock this year has been rated #1 in its software category, in its price category, by the readers of Stocks and Commodities Magazine, 32 years in a row. We'll be talking about Metastock all day, about how it can help you scan markets, test ideas, forecast using our patented forecaster, get real-time alerts, commentary, signals, all that kind of stuff. It starts at $75 a month for streaming delayed data. And of course, there's real-time options available as well. At the conference, we're going to give you an extended trial where if you buy a month, we'll give you the 2nd and 3rd month for free. All of the stuff that we talk about and we sell directly here over the weekend can be found at metastock.com/conf-promo. So we got all that out of the way. I want to thank you for being here. Thank you for being here, spending some time with us. My biggest goal for these events is that you learn something. So I hope you do. And I hope it's something that's valuable and helps you with your trading. Our first presenter today is going to help you with that. Gentleman by the name of Vince Vora. We've been working with him for a number of years. Some of the stuff I've learned from Vince, I actually use very, very much in my own trading. Some of the advice and some of the nuggets of wisdom I've gotten from him over the years has been really, really good. I've helped him design, or I've helped him create systems and kind of over the years. Very, very smart guy. I would consider him a mentor. And with that being said, let's get you started, Vince. How you doing?
I'm great, Jeff. Thank you for having me on. Good morning.
Good morning. Let's see. I'm just sending you the screen control. There you are.
Hey, how are you? Can you see me?
Yep.
Good morning. I'm going to try to share my screen here.
All right. I'm going to make sure it's working and then get it out of the way.
All right.
Bye-bye.
Sure, it's great. Thanks, Jeff. Good morning, everyone. It's great to be here with you. I'm Vince Vora, the head trader here at Trading Winds. And as Jeff said, we've been working with Metastock for many years. Great group of people. from Scott to Kelly, Jeff, Greg, William, everyone there, the whole sales team. We've had the pleasure to work with. It's been fantastic, and they've really helped us create some great add-ons. The most recent one I want to share with you here, which is our Victory 2.0 add-on. We initially created the first version of Victory back in 2019, just before the pandemic kicked in. And then last year we made a few upgrades to it, came out with our second version, and that's what I want to share with you here today. I'm going to quickly go over what you're seeing on your screen, what these arrows and dots mean, etc., these ribbons, and then I'm going to show you my approach, not only how I approach trading, but how I use the Victory 2.0 add-on to trade with every day, and hopefully you'll be able to see how you can use this for yourself. So, excuse me. What you're seeing on the screen here is the add-on Victory 2.0. Now, I do want to say this is strictly based on technical analysis. There are no fundamentals behind this. The algorithm is strictly based on technical analysis. For that reason, it can be used to trade any market, whether you're trading equities, futures, forex, crypto, on any time frame, 1 minute, 5 minute, daily, weekly, monthly, any exchange around the world. We tested this on several before we launched it. It works great across the board. The main idea behind Victory is to follow the trend, and not only to follow a trend, but a trend that has momentum behind it. So let's get to the symbols here and show you what these all mean. Obviously, we have a bunch of arrows, green and red. Green arrows, obviously long trades. First of all, if you hover over any of them, they will tell you what they mean here. And some, you'll notice like this green arrow is a little bigger, a little darker than this arrow here. And the little one says long, the thicker one says HPB. HPB stands for high probability buy. So there's a couple of additional layers in the algorithm that come together for these ones here. So you have a choice to work with only the HPBs or to work with all of them here. Obviously, the red arrows are for short trades, but having said that, what you're going to notice when I go through the presentation here is that the intent is not to take every single symbol. We have a strict set of rules, a set of criteria that we need to go through before we qualify any one of these signals. It's pretty simple, straightforward. I'll give you those rules, the list of criteria that we use to judge these trades. And then we select which ones we will actually trade or not. You also notice that there's these red dots or green dots. What these are long RE, for example, is re-entry. What it means is if we're already in a trade and the same criteria that came together to produce that buy signal comes together again, we now call it a re-entry. So it's the same thing, except if you had missed the first one, now you have a shot at getting in here. Or if you had gotten in on the first one and you're a little more aggressive, you can add to your trade here. Okay. The way I use it is once I find a setup that meets my strict list of criteria that I will share with you in a minute, the condition that I'm looking for is to add to whatever new reentries happen along the way and exit fully on any change of color. What you might notice is sometimes it will go from a longer short to an exit. You'll see an exit flag. Sometimes it'll just go straight from a green to a red or a red to a green. Any change in color means you should exit completely. There are no yellow bars here, but if there were yellow bars, it would mean you should not be long or short at that point. You should be on the sidelines waiting for a new setup to come together. Okay. You'll also notice that once we do go long, every candle or every bar here, I'm using open, high, low, close bars. You can use Japanese candlesticks or whatever you like, but everyone will be colored in green until we get a different type of signal. That is intentional. That is to make sure that you remain disciplined and stay in the trade as long as you can. We do encourage users of this add-on to scale out along the way at certain points with this add-on. Should you decide to use it, you'll also receive a training class with it, where we will tell you exactly how we like to scale out, how we set our targets and where we take profits, etc., and go from there. Now, the other part to this is there's a couple of ribbons down below. You'll see here that they're marked weekly and monthly. Now, these are, for example, if I go to the daily chart, we want to look for 2 higher time frames that are confirming what we're seeing on the daily. So for example, if we were to look at this re-entry here, we were going to decide to take a trade here. What we'd want to make sure of is that the 2 higher time frames, the weekly and the monthly, are also green. These represent the color of the price bars on those particular time frames. Okay, so if I were to switch to a 5-minute chart on the S&P here, you'll notice that right now it's still set to weekly and monthly. What we need to do is right-click anywhere on our screen and go to Expert Advisor. I'm sorry, that's not it. Go to templates is what I was looking for. Apply template here, and we'll have to go to the bottom. These are in alphabetical order here, all of mine. Here's the Vora Victory 5-minute. So if we add that and apply that template, now you notice that on the 5-minute chart that we're on, there are ribbons for 15-minute and 30-minute. Again, 2 higher time frames. So here's a nice short trade that we would have taken here. And you'll notice that both are red, meaning they're in line with this. So you're trading in the same direction. You have the same trend on all 3 time frames. That's what we're looking for, okay? And we'll go through many examples as we go through this. Now, the last thing is the blue line that you see here. And that, as you notice, as I'm hovering over it, is a 20-period simple moving average, not weighted, not exponential, it's a simple. I've been trading with the 20-period simple moving average for almost 40 years. And if I could only choose one indicator to ever use, it would be this, for one simple reason. It helps us judge the amount of momentum behind the trend. So what we want to see from that blue line is a slope in the direction of our trade. So if we're trading to the long side, we want a slope higher. Now, what degree of slope are we looking for? I just judge it visually. For example, something like this, approximately a 45-degree angle, I consider to be a significant slope. You can use a lower slope. Any slope counts, but the higher the degree of slope, the better. So when you see a slope similar to this here, that's a very, very significant upward slope. That means there is a lot of buying pressure behind that move. And so ideally, the setups that happen along those slopes are the ones that we want to lean towards. So as I'm going to go through many charts here, I want you to focus on the ones that have significant slope in our favor. Now, there are 2 conditions that we will accept and trade if we don't have slope in the direction of the trade. Otherwise, this is a must. We must have a slope in the direction of our trade in order for us to take one of these signals. The reason for it is we want to avoid those consolidations, those sideways markets. That is where people lose money. The bulk of the traders out there that lose money because they get trapped in a range and they go long and they get stopped out. They go short, they get stopped out, and it's back and forth and it just chews them up. What you want to focus on are trends. If you think about it, anywhere along these lines, pretty much anywhere along this section of the chart, you could have bought just about anywhere and made money. Why? Because there was a strong trend with strong momentum behind it. Now our algorithm here, the add-on, helps you identify areas to buy in that it just pinpoints it better than just selecting anywhere. What we don't want to do is buy away from that line and then have it snap back on us and find ourselves in the hole right away. So we do want to buy along that 20 during a strong trend. And again, remember, we're confirming that trend with 2 higher time frames, right? That 5-minute template I showed, there's a 15-minute template, a 30-minute template, an hourly template. There's a template for the different time frames that you might trade on that will show you 2 higher time frames here. Okay, so there's one last thing that I want to show you, and then we're going to get to examples. And I want to make this as interactive as possible. So please, any symbol that you want me to bring up and show you a chart of, type it into the chat, and I'll bring that up for you. What I like to do when I start to trade is I like to take a top-down approach. In other words, I'm going to go to the monthly time frame and look at the trend on the Dow Jones, the S&P 500, the Nasdaq 100, and the Russell 2000. Those are the 4 main equity indices. And so I want to see what kind of trend is on the highest time frame, on the monthly here for me. So if I'm looking at the SPY right now, this is looking pretty bullish on the monthly. Okay, it just gives me an idea of where the overall market is, and then I work myself backwards. So I tend to take most of my trades off the daily time frame. Okay, but I want an idea of what the longer term trend is, what the medium term trend is, which would be the weekly time frame, and then the trend that I'm trading on, which is the daily. Now, one very helpful thing that you can use, which Jeff and his team created for me when they created version 2.0, is this right here. Oops, let me show you. There it is. Okay, now you get to this, I should say before I do this, you right click on your chart, you click apply template, you go back to the list of Vora templates here, and you're looking for the Vora market overview multi-time frame. There is Vora market view overview, which is just one time frame, or we can do the multi-time frame. What this is going to show you here is this. Okay, it's going to bring this up, and you'll notice that the left column here is the daily time frame. The right column is the weekly time frame. Now you can change these time frames to whatever you like. You can use 1, you can use 2, doesn't matter. But what you'll notice is there's a number of ETFs here. They are the ETF for the 4 main indice charts, the Dow Jones, S&P 500, Nasdaq, and the Russell 2000. And then there are the different sectors. So communications, consumer staples, energy, financials, etc. Right? And the colors that you see here represent the colors on the bars for the Victory add-on. So the idea behind this is that when you see a lot of red straight down the line here, that means we are in a significant downtrend. If there's a lot of green all the way down, or for the majority of this, then we're in a significant uptrend. So it just gives you one quick visual snapshot of where the overall market is, the different sectors and so on. It also helps you identify which sectors are the strongest. For example, communications has been very strong for a while, right? While, for example, energy has been fairly weak, right? You also have retail, which is weak. Out of these sectors, you usually have 80% of them heading in the same direction on a very regular basis, but there's always 20% that buck the trend. So just like your portfolio, think about it. If the market was in a long trend and you were to have 10 positions in your portfolio, you'd probably want at least 8 to the long side, but you always want 1 or 2 to the short side. This will help you look, find those. If we want 1 or 2 to the short side, we can go to energy and retail, break down the list of stocks in those sectors and find those short plays. So this is extremely handy for me. So that's where I start. I take a look at that. and then I go back and either break down those strongest sectors looking for trades, or at least I have an overall idea of what direction I want to trade in for the most part. And then I go back and I start picking off these trades. Now, in a little while, I will show you a scanner that will find these opportunities for you very, very quickly. But just flipping through charts, you can find these here. Now, again, you can look at a 1 minute, a 5 minute chart. It works the same. So let me explain first. Let me go back to the daily. Let's choose, for example, IBM. Okay, let me give you the criteria of the trades that we're looking for, the ideal trades that we're looking for. So if you look at this one down here, this high probability buy, what we're looking for first and foremost is a victory setup. So there's the arrow, we have that. Number two is we are looking for the bar associated with that arrow to be close to the 20. Okay, we have that. The third thing we're looking for, and I'll zoom in a little, see if I can help you see it right in here. Where was it? Here? I don't know if you can see the little tick to the right of that bar, the closing price. We want it to be near the high of that bar, so the top half of the bar. Okay. In this instance, it happens to be right at the top, which is ideal. The reason for that is normally the higher it closes to near the high of that bar, the more likely it is to follow through and continue in that direction. Now, in this case, it actually settled back for 3 days before it continued. That's rare. Usually, you'll see it take off right away. So we look for that as well. The next thing we look for, excuse me, is the blue line, is the 20-period moving average. Is it sloping in the direction of our trade, right? If it's sloping in the opposite direction, we generally don't want to take it. If it's flat, we generally don't want to take it. Again, there are a couple of instances where we would to try to identify a bottom or a top, and I'll go over those as well. But generally, this is the kind of thing you're looking for. A nice clear signal, all right? Having the bar near the 20, having a close in the top half of the bar, and having slope in the direction of the trade. The next thing we look for is the ribbons. They need to both be green and match the color of the signal here. If they are, like in this case, then we're good to go. Now, a couple other things we look for is we look to our left to see how much prior activity is above here. We don't want to run into resistance. We want a clean road ahead. So the ideal condition is you look to your left and it's all blank, which means that we're near an all-time high. That is the absolute ideal condition. There are times where we take trades where we're not near an all-time high, but we're looking for areas where there is not a lot of overhead resistance. We'll also teach you in the training class I spoke about earlier how to identify support resistance and how to work with that. Okay, but otherwise, this would be an ideal setup. And then all we do is we wait for that bar to close and we mark the high of that day. And then we wait for a trade 1 tick or 1 penny above that high. Now, normally we get it on the next day or the day after. Sometimes it might take 3 days like here. Okay, so we would not have actually gone long until it tripped that high right here. And then it becomes very easy. We're just looking at the color of these bars. That's all we're doing. And we're waiting for a change in color to exit. If it goes our way, like here, we're also identifying areas where we scale out of some of these trades. Okay, we start to take a little bit off. And then if we get another entry here, we can add to that trade some more. And then we exit at the change of color. Now, I'm not sure if this was an earnings gap. If it was an earnings gap, we would have been out up here. We also pay attention to the earnings date. We do not want to hold positions through earnings. They are unpredictable. They can gap in our favor. They can gap against us. We don't want to deal with it. So we identify that earnings date and we get out a day before earnings. So if this was an earnings gap, we would have been out up here. If not, if it was just some kind of news or so on, so be it, we got out here. That in a nutshell is victory. Very simple. Okay. Let's go and look at, say, a shorter time frame. Let's go back to the 5-minute on the same chart here. Now, when you see mess like this, bars that are very wide range from high to low and all over the place, this is the kind of chart you want to avoid. Now, on a 5-minute chart, there's going to be days that have less volume and you know, will look like this, and there are days that are trending a little better, like such as this. And these are the days that you want to really trade in. Now, remember I said we want to avoid the areas with a flat 20, right? They can also be used to our advantage, though. A lot of these will turn into channels and we'll have a series of highs in a similar spot. They will also have a series of lows in a similar spot, right? So you can use these to your advantage. A trend like this or a consolidation is good in the long run for us. Reason being is the longer a stock consolidates, the bigger the move will happen coming out of it. So instead of feeling frustrated when you see this, you should get excited and be waiting for a break outside of either the high or the low. Now, again, when it does break, you want to understand whether there is going to be resistance overhead or support below. You look to your left. If you see nothing but blank space, then great. You have a clear road ahead. Now, again in here, this is why we want to avoid these signals. If we had gone short here, we would have been stopped out, right? We go long, we would have been stopped out and back and forth. We would have been chewed up and lost all sorts of money there. Instead, we avoid that and we wait for some slope and a setup that meets our criteria. So right here, this one would not have met our criteria. We had no slope, okay? Here, we have slope. So on the reentry, we could consider this a valid signal. Why? We have a victory signal. We have a bar that's close to the 20. We have a bar that closed in the top half, right? If I go back and change the template to a 5-minute here, we'd likely see green and green. If we didn't, if we saw one green, one red, we would skip that. And then we'd probably get in up here when they were both green, okay? And then we wait for one, a trade above that high, and then we enter. Then we could add here, we could add here, add here, add here, add here, exit everything here. Now, you don't just continue to add, you have to take into consideration your money management rules. In other words, we will teach you a set of rules that I've used for years that I don't make a lot of guarantees. Hardly anyone can make any guarantees in this business, but I will guarantee you one thing. If you follow the 5 simple money management rules that I will teach you in that training class, you will never take a big loss again. And that is one of the most important parts of being a successful trader. If you can limit your losses, you can make money in this business long term. Why? Even just getting lucky catching a runner. But with something like victory that helps you pinpoint your entries, it becomes much easier. But coming back from a big loss is very difficult. Recovering from a small loss, very simple. So you can only put a certain amount of money in every trade. You don't want to overexpose yourself. So you're not just going to continue to add and add and add and add and add. You're eventually going to hit a cap where you can, you can't add any more to that one trade. But again, what we do is we enter after a certain amount, we set a target overhead after a certain run, we scale a piece out. If then it pulls back, say I took a third off here, pulls back, I add the third back on. So I'm still at the original amount, right? If I take another third off here, I add another third back here. So it goes back and forth, and that's how we do it. But whenever we change in color, we see a change in color, we want to exit completely the full position, okay? So it works the same way. And it works the same way on a short position. So if we were going to look at one of these trades here, for example, okay, you know, we're looking at the same criteria except in the opposite direction. So we want to see some kind of short signal. We want to see the bar near the 20. We want the 20 be sloping downward, right? Closing near the low. We want to see red ribbons. It's the exact same thing. It's just in the opposite direction. Okay. Now, going back to the scenarios where we don't have slope. So the two conditions that will allow us to take a trade down here are these. If we get a signal here, and say this bar was much longer and the close was up here, so that we could say, hey, we have flat 20, but we have a close above a prior high. Okay, that would be one condition. Okay, and if it's a channel and it closed out here, yes, that counts. Okay, the second condition, which is an even better one to monitor, is a successful retest of the 20 simple period moving average. What I mean by that is we move from one side of it to the other, then we come back and we bounce off it, right? We don't break down again and then cross it. We hold it, which means the 20 acts as support. Now, in this particular case, this reentry happened to show up at the same time as the retest, okay? And when you're retesting it, it means a successful retest means you not only bounce above there, but you close, you move above the high, you close above the high of that initial move when you crossed the moving average. So right in here. So when this bar triggered, meaning we got to trade above the high, we accomplished both things and we were in there and off we go. So those are the only other two conditions that you could use, and you see them a lot at highs and at lows. Okay, let's look at Walmart here. And again, please let me know if you have any questions or any symbol requests. Let's go back to the daily here on Walmart. Again, here's a chart that at first look, at first impression, right? It's very clean, very orderly. Remember those big crazy bars, the you know, wide range bars from high to low and all over the place? You don't really see that here, do you? What you do see, and this is very, very common, during a strong trend, the bars are all very similar in size, all right? And then it's easy to tell what the trend is. We're going from bottom left to top right here. Obviously, we're in an uptrend, right? You can also tell by the slope on the 20, right? So any of these areas in here, any of these symbols, you could get in on. Now remember, here's the channel, right? Here's the sideways. The 20 is flat. We don't want to trade that, right? But what can we do? We can mark the highs, right? And we can mark the lows. Now, we wait for a breakout one way or the other, right? Well, we have a break here with a long symbol as well. Okay? Do we have slope? We don't, but we do have a close above prior highs, so it's valid. But now, we are a little further away from the 20, right? So we have to reassess, do we want to take that one, or do we want to wait for an entry near the 20? Now, the distance is not just visually on the chart that we measure the risk. So we would look at the entry point, which would be a move above the high of this bar, and we compare it to where our stop would be, which would be below the 20 down here. So on a dollar, from a dollar perspective, here the high here was 64.41. Say down here, these lows are around 59 or so, 60. Let's call it a 5-point risk. If you're okay with that, then great, you can take the trade. But if not, there's no need to rush in. We'll get other opportunities. And for example, this one here was right near that 20. We had significant slope, right? We look to our left, there's nothing there. The ribbons are the same color. Everything lines up. We get in and we take a nice easy trade. We could add, and we exit everything here. Nice winner, right? And that's what we look for over and over and over again. Trading should be boring. It should be very simple. Once you find that set of criteria that you're looking for, make a list of it, keep it next to your laptop, Make sure you can check off every box, and you just rinse and repeat day in, day out. Here's another one. We get in here. Okay. Do we have slope? We have some slope. I mean, we're in a strong trend, but let's again say, you know what? We don't want to risk it. It's too flat here, right? We're kind of consolidating. We're going sideways. Let's just wait till we're either out of this consolidation or we find slope. Well, here's one, right? Nice small bar. Look to our left, blank space, ribbons, green, in, boom. We can add, we're out, right? Nice and simple. Why do you see this over and over again? For a simple reason, trend and momentum, okay? You find a stock that's in favor, you'll know it. You don't have to follow the news. You don't need to look at forums or other chat groups that try to pump certain stocks, right? You can tell by the chart if it's clean, if there's volume behind this, if there's a nice strong trend like that with momentum. Again, you can buy just about anywhere along there and make money. Well, we help you pinpoint the areas that work to your advantage here. And again, you can start at the higher time frame, right? Make sure you're in a strong trend. Look at here, for example, Walmart. Way back in here at the start of 2024. This is January 2024 in here, right? We were consolidating, right? So if you had drawn a line across those highs, what would you be looking for? You're looking for an area where you see a breakout, okay? Now, the breakout was over here. We did move a little forward, okay? And then we pulled back. We get a signal right here, okay? There's absolutely nothing else overhead. This was the prior all-time high, right? And look what happens next. So it doesn't mean you have to trade off the monthly and get in here and stay in it for the next 12, 14 months, whatever it is, right? If you're managing a retirement account, if you have, say, a full-time job, a family to take care of, and you want to trade on a higher time frame because it's less time consuming, less in and out, by all means, if you're an investor, I would highly suggest you use this on a weekly or monthly time frame. If not, once you see this break, you know that for several months in the future, we should be moving higher on Walmart. So all you do is you go back to the shorter time frame, you put Walmart on a watch list, and you sit and you check it and you wait for that signal to appear. It really is that simple. The other thing I will tell you from channels is that you can measure the channel, okay? Once you get a breakout, you'll know exactly where the channel started, where it ended, you measure it, and that same length, you can expect a move similar in size in the direction of the break. So at the time, I would have put it like this, right? Similar in size. It ended up going way further. That happens. That's fine. But right here, I could assess how big of a move we should have seen, which was significant. I would have reverted back here. So again, this was January of 2023. Go back to the daily, right? And if we go back to January, right, which was further back here, January 2024, we could have started taking the signals after that. Look how many we would have had. Look how many were winners compared to losers, right? It's as simple as that. Let's see, there are a couple questions here. Vince was asking he's left and I was asking for the top-down approach. I think I covered that. Vin is asking, am I doing breath analysis? No, I'm not. I mean, first of all, that I maybe look at that if I was trading off a 1 minute or a 5 minute time frame. If I'm day trading, I trade mostly off the daily time frame, so I don't bother with that. But it's always a good thing to look at that if you're day trading, but it's really not necessary. When there's a lot of buying or a lot of selling, it will show on the chart, right? The trend and the momentum. What you want to see, whether it's on a 5 minute chart or a daily or a monthly, is you want to see the bar is similar in size, You want to see a nice significant slope on that 20. Those are the two main things, and the higher time frames to be aligned. That will automatically capture any strong trend. So whatever the reason is, whether it's a strong news story, whether the fundamentals look great, whatever it is, we don't care what the reason is. All we care is what is happening right now on that chart, and it will identify that for you. What time frame do you use to execute the entry, and do you use a stop loss? So again, I trade mostly on the daily, but you can use any time frame. The stop loss, I don't actually enter a hard stop loss. I'm looking for a change in color for my stop. That's it. So if I see a change in color, then I would exit. Now I will tell you that these signals and these colors can change while the bar is open. So if you're on a 5-minute chart, okay, and say you're 2 minutes into that 5-minute bar and the market's moving, you could see it go from green to red, right? Or see an arrow and then disappear and so on within that 5-minute bar. But once that 5 minutes elapses and that bar closes, whatever's there is there for life. So this doesn't repaint later, nothing like that. These signals are there forever. But while that single bar is live, you could see some changes. Just want to let you know that. Joan is asking to cover the scanner. Absolutely, I will, and I'll cover the expert commentary as well in this. That's another part of this. William saying, can you use this indicator on Thinkorswim? No, it is not available, unfortunately, on Thinkorswim. It is available on Metastock and on TradingView. Metastock has its advantages, mainly the scanner, expert commentary, all the things I haven't shown you yet. The multi-time frame view that I showed you at the beginning, this here is not available on TradingView, only on Metastock. So let me show you a couple other symbols, and then I'll get to the scanner and expert commentary, etc. Again, I said earlier that you could use this on any market and any time frame. So I'll show you. This is the Nifty 50 in India. I don't know if anyone trades on there, but the other thing too is if you see a strong market, say the Hang Seng in Hong Kong is looking very strong right now, right? It doesn't mean that you have to open an account over in Hang Seng and try to trade equities there. You can just trade a Hong Kong-based ETF here in the US, right? So you can take advantage of these moves, whether you're in that country or not. So I just want to show you that whether you're trading on a different exchange, okay, or for example, a different market completely, like here's Bitcoin, right? Some of you may love to trade it, some of you may not believe in it, and so on, whatever. The victory add-on you can use the same way. So here was a buy where we had the bar near the 20, right? We closed near the high of the bar. We had significant slope, higher time frames aligned. We looked to our left, there was nothing there. This was the prior all-time high. We trade 1 tick or 1 penny above. We get in and off we go. We could scale out along the way. If we get another entry, we can add to it, exit the full position here. It's that simple. Any of these others might not be valid for several reasons. For example, let's take this one that looks pretty good here, right? There's slope. We have a strong arrow. We're near the 20. It closed near the low of the bar, but we had 1 higher time frame red, 1 green. Not valid, right? We also didn't have any follow through. We never traded below that low, right? We get another one, same thing. Still green here, not valid, okay? We get this one green, right? But both ribbons are not green, so we can't trade. You see how it rules these out? Okay, and that's fine. Then we finally get one here, a slight slope, not much, but it counts. And we're all green, and we're moving above prior highs, and then off we go. And we take that one. This one, super clear. There are many, many setups. So you can be picky here. You can be selective. You don't have to jump into the first setup that you see. What your main job is going to be as a trader, if you're using this add-on, is to run that scanner and then compare one setup to the other. What I'd like you to do is spread out your trades and only pick the best 1 or 2 trades on any given day. That's it. You don't want to jump in 5, 6, 7, 8 trades in one day and then have the market do what it did last Friday, just drop suddenly, and you find yourself in a huge hole on 7 or 8 positions. That's not the idea here. And again, we're going to teach you all this in the training class as well. But I just want to show you that it works the same way on all market. If you're a currency trader, right? Let's say you want to trade the USD JPY pair, the Japanese yen pair. It's the same thing. You're looking for those trades that match the criteria, right? So sometimes you'll see a move like this where this doesn't qualify, okay? And then it ends up going to run, and it's a while before it comes back. If you miss it, you miss it. We don't worry about what we miss. We worry about what we catch, okay? And we go from there. But when we catch a nice setup, it usually covers many, many small losses, right? So what you should ideally find with victory is that not only should you have more wins than losses, but your winners are much greater than your losses. Okay, that's the formula that we follow here. Let's see. Is there a relationship between high-low range of the channel and a legit consolidation and the craziness of wild fluctuations that you described early on? You know, channels come in different forms. Of course, there's tighter channels and there's wider channels. If you look at something like crude oil, let's look at crude oil. This will allow me to show you also a futures market. Okay, so let's look at crude oil here. Crude oil has a very messy, and you'll notice it more on the weekly here. Okay, see this range here? Okay, that's a wider range on this channel than you might see on most charts, but it's still the range. You would still trade it the same way. Okay, so channels and consolidations come in different forms, but your goal as a trader is to avoid them. That's it, avoid them. Now, you may look at this chart and say, wow, I would not have traded crude oil since Q4 of 2022 until now. We're in 2025 and I'm still not trading it. I'm missing out. Okay, if you were trading this on a 5-minute time frame, within here there would have been many trends on a lower time frame that you could have taken advantage of. If you're trading on a daily or weekly, you wanted to avoid this, and that's fine. When it eventually breaks outside of these lows or outside of these highs, that's when you're going to see the big moves like here. So it'll be worth the wait. But there's always other stuff to trade. So let me go back. We're running out of time. Let me quickly show you the 2 other things that we have here. If you go to view, top left, go to expert commentary, it's going to bring up a little box here that's going to tell you about myself, trading wins, and the victory add-on. More importantly, it's going to show you a little triangle here that always defaults to the most recent bar. Now you can move that above any other bar you want. You can use the arrows back in here up at the top left of the box, or you can just click on any candle here and move it. Now what I want to show you is that in here it'll give you some direction. If you trade options, it'll give you an idea of what kind of expiry you want to look for, which kind of delta and so on that you want to look for. But more importantly, it helps you trail a position if you can't watch the market consistently. So say you're trading on a daily time frame, you put on this short trade, and you have to go to work, right? And you can't watch the screen. So in that case, you may want to actually enter a stop loss order, right? This gives you an idea of where to place that order. So initially, when it's on the bar that gives you the signal, it's going to tell you that the victory system is signaling a short sell opportunity. And when you go to the next bar, it is now going to tell you that you should look to exit this position if the price of the security closes above 71.60. Okay. Now watch if I move ahead one bar. Now it's 71.40. See, move it again. Now it's 71.15. So it will trail it for you. So if you can't watch it, you need to go out, need to go to work, and you need to place a stop. This will help you. It'll hold your hand throughout the life of the trade. Okay. So it's very helpful. Now, the other great thing is if you go to the power console button up here, top left, the little P, there's tabs on the left. Go the third down to explore. And this is where the scanner is. Now, there's all the different add-ons that you can scan for. Again, they're alphabetized, so mine would be at the bottom. What you can do is right-click on any of these and click Add to Favorites, right? So you should only scroll once. Then on your Favorites tab, here they are. And, you can look for the Vora Victory entries, the high probability ones, or the re-entries. You can separate them or look at them all. There's also a feature where we filtered the slope. So the ones that say Vora Victory filtered and the Vora Victory re-entry filter, that means it will only give you the ones with a slope on it. It'll avoid the consolidations, okay? So you select the ones you want, you come down here, you select the market you want. I usually do optionable stocks, 5,600 of them. Then you come here and you select your time frame. Again, whether it's 1 minute, 5 minute, whatever you want. This will confirm what you're searching for. You click Start Exploration, and it will bring up this window. And it will immediately tell you how many charts it is going to review. Up here, 5,666. It'll tell you ongoing how many it's already reviewed. There's 87 here, and so on. Okay, I'm gonna cancel this for now because I'm not gonna. I'm a little pressed for time here. Okay, and what you'll see when it's done is something like this down here: a list of the stocks that have qualified for those scanner results. Now you're gonna see several columns: new long, new short. The ones with zero means it's not this. For long and short, the ones with a number 1 is the type of trade it is. So all 5 of these are actually new short setups. They're not long setups, okay? Then we have the degree of slope, okay? That filtered amount is anything over 5, okay? So what you want to see is the highest number, highest positive number for longs, highest negative number for shorts. So if I click on this column, I can sort them, see? Now it's minus 18, then minus 10, minus 8. So I can quickly identify the ones with the strongest slope on that line, okay? I also have here a weekly trend and a monthly trend. So I can quickly tell whether those ribbons are in line with this. So if you see a negative one and a negative one, that means they're both red, right? And now here's the price. I'm not going to short a 70-cent stock. So I'll look at this one here, ALB, right? It's an $80 stock. And, we have a significant slope, both negative. So I can cut and paste this into a watch list. I can print this, I can save it, or I can highlight one, click the little chart button here, and you're going to see the chart here in the background. And so you'll see here, I'm going to cancel this so we can see the chart, that we have been trending lower. We have some pretty significant slope. The bar is right near the 20, isn't it? We have both ribbons red. We look to our left, there doesn't appear to be much in the way. So this might be a trade that once this bar closes, we want to mark that low and trade 1 penny or 1 tick below, that would be our entry, and we go from there. Okay. So that is it. I think I'm out of time. I'm going to ask Jeff to come back in. I'm happy to stay to answer questions if necessary, but I want to give him a chance to let you know how you can grab a copy of this yourself. And again, if there's any other questions, I'd happy to stay and answer them.
Just one more real quick. I think you did a good job of keeping caught up with them. Emmanuel says, generally, how many securities can a trader follow?
That really depends on your level of experience. But what I found is that the most successful traders follow a short list of trades. They don't keep dozens and dozens of trades active. I cap mine at 10. I don't follow more than 10 symbols at a time. Okay. Although I search for over 5,600 of them daily to find the ones I like, I'm very selective in my process. And again, during the training class that comes with this, we will tell you exactly how to compare one to the other so that you're only trading the highest probability trade setups that should work in your favor. So yeah, try to keep your list short. It's just easier to track, and you'll have more success that way. I can promise you that.
Cool. Thank you, Vince. I'm gonna go ahead and talk a little bit about how to get it. And thanks for showing the scanner too. I love scanning. Yeah. My favorite part of it. So. All right, very cool. So as you can kind of see here on the box, on the screen, we've got the Vora Victory box. Vora Victory has been one of the most prolific add-ons. So we released it back in 2020. It's been well liked, well used, and if you haven't tried it yet, you should. When we were sitting down with Vince to kind of figure out what we could do to kind of improve it, because it's so popular, we came up with some. It took us a little bit of time because it was pretty cool initially, but we came up with some really good ideas. And I really kind of like what kind of went into the Victory 2 package. If you have Victory 1 and you haven't gotten Victory 2, you can get it for pretty much half price. And so we'll talk a little bit about what it costs and kind of how to get it and all that kind of stuff. But I just want to talk a little bit about what's included. With the system, Vince talked a little bit about the new stuff that we've added. The higher probability buy setups are new to 2. The take profit suggestions, the multiple time frames for daily, 5 minute, 30 minutes, the market dashboard, the explorations, the expert advisor. I love how it kind of goes in there and says, well, okay, if you're conservative, you can go ahead and look at this. If here's kind of your stop loss, here's the signal, all that kind of stuff. It spells it out for you in a really good, easy to understand manner. The scanning, though, is something I use every day. You can go in and scan a market, and it doesn't matter. I know we had a gentleman from India. I was going to remember his name, but it's too early. Wanted to use this with Indian stocks. You absolutely can. We get a number of Indian customers. So all this is included in the package. And we've actually kind of updated it a few times since we released it. We've added an Indian market view, an Australian market view. We've added new templates to kind of for the 1 hour and 1 minute, and added a neutral state to it. So Vince talked a little bit about the market dashboard, where it tells you how the markets are doing and how all the industries are doing. I think that's cool. It's very, very unique. It's the first time we've done anything like that in MetaStock. Vince talked a lot about how the signals are kind of generated. You've got the weekly and the monthly that are here automatically, so you can go and look at those higher time frames if you want, but you can just also see at a glance. And so if you have Victory 1 and you get Victory 2, you'll get the take profit suggestions, high probability buy setups, that multiple time frame analysis. All that stuff has now been included. We added with scanning, you can scan for just any entry signal. You can look for the filtered entry and exit signals, where it just looks for the buy setup and the proper slope, either positive or negative. That was something I thought would be a good idea, and it's the scan I run. You can look for re-entries, the filtered re-entries, and then just high probability. So all of those are available as well. So the expert advisor Vince talked about, you get the slope right here, the long position, all the kind of good stuff there. System testing, we do have the ability to go in and test this if you want to see how well this works in whatever market you can. Our system tester is actually probably one of the more robust out there on the markets. It allows you to go in and you can see we tested Victory against thousands of stocks here all at the same time. And you can do that with kind of like all of the methods that are in the software. it's available. It's something you can do. So one of the things that we decided to do, Vince has been creating methodologies that have been very, very popular for years now. I think we've been working with him for close to 2 decades, but we're also including as part of the package, if you get it today, his winning momentum strategy and his very, very popular veracity add-on. The winning momentum strategy we sold for about $500. It's included. The veracity system, we sold that for $2,000, is actually included in the package today. Both of those are complete systems. They include the experts, the explorations, the scans, everything that you need to go ahead and get started. And another thing that we're going to throw in is 1 year of Trading Wins Pro membership. So with this, you get daily trading ideas. You get 3 live weekly training sessions that you should go to. They're very, very good. On-demand technical analysis training videos, option trading ideas, that's all included. We also sat down with Vince and we did a training course. We did a boot camp. He did a session where he kind of talked about trade identification and kind of how to kind of look at the trades. He did a really, really good job with that. In the second part, if you're new to Metastock, kind of the idea was we're bringing on a lot of customers that aren't familiar with Metastock, and I wanted you to know how to use the tool right away, because I know if you know how to use the tool, it's going to be more useful for you, and I want it to be useful for you. So in that second part of the bootcamp session, I talk about how to set up your charts, how to easily switch between charts, how to set up any watch lists if you want them, and most importantly, because I think it's one of the things you'll get the most value out, how to scan, how to go in and say, okay, here's the list I want to scan against. Tell me what signals exist. And for me, that's the most powerful feature in Metastock, like the ability for me to weed out all of the noise and just focus on the opportunity. It's amazing. So that bootcamp's available immediately with your purchase, and I'd recommend you go through it. If you're new to Metastock, go through that second part, because it's really going to help you configure the platform and really start to get good use out of it. So in total, we're going to throw in Vora Victory 2 that normally retails for $19.97. We're going to give you the veracity that also retailed for about $19.97. We're going to give you the winning momentum strategy. That was an add-on that was $500. The pro membership, which is $97 a month, and well worth it at that cost. In total, all of these stuff, if you just bought them separately on the website, would be $5,657. We're going to do a $997 as your introductory price. We're also going to give you a money-back guarantee on it, so you can try it out. If it's helpful for you, you can keep it. Yeah, we want you to keep it, of course. If it's something that isn't helpful, if it doesn't add to what you're doing, you can get a refund. We're going to give you a pretty good risk-reward ratio on that. So so $56.57 is the one-time cost. At the conference today, we're going to do $747. It's another $250 off. That's going to give you that bootcamp class, the Vora Victory, 12 months of that trading win service, Vora Veracity, the winning momentum strategies. If you haven't used Metastock, I talked about how it's the highest rated software in its price category for 32 years in a row. One of the things that we did this year is we had an end of day and a real time. Even with our DC program, which is only $75 a month, you can run scans during the day. You can get results for stocks that have an opportunity today. You can even open up the daily chart version of Metastock and get streaming delayed updates where they're 15 minutes delayed. You can watch the bars form during the day. You can run the scans during the day. Huge upgrade. And guess what? If you're a Metastock user, we just gave that to you for free. So if you haven't used Metastock before, you can now get that for about $75 a month. It's all. So we'll also give you a free trial to Metastock if you haven't tried it before. And it's just all part of this package. We are going to back it with a money-back guarantee. You can go to metastock.com/conf promo to do that. You can give us a call at 800-882-3040, or you can go to metastock.com/sales chat as well. So very, very good offer. There's a reason this has been such a highly rated add-on. Go through it, get the training. If it's helpful for you, keep it. In any case, 800-882-3040. Give it a go. All right. I do want to say thank you to our one of our sponsors right now, the American Association of Individual Investors. Hugely well-respected, well-known nonprofit. You've probably heard of, the AAII investment sentiment survey. They do a lot of stock watch lists. They do a lot of market research. They do a lot of market analysis. Very big supporter of the conference, a sponsor of our event today. You can find out more about this and what they do at aaii.com. And of course, we're Metastock. All of the promos that we're doing here today, you can get at metastock.com/conf promo. You can go to metastock.com/sales chat. You can give us a call at 800-882-3040. I did check. We are behind on time. So we're going to hurry and go right into our next presenter. And then the next time we come back, we're going to do a prize drawing, I promise. So our next presenter is Ray Rondeau. Ray Rondeau has given tons and tons of speeches and talks. And he's a chief analyst, the investment strategist, I should say, for the AAII. He's a market technical analyst. He does video education and suites developers. Couple hundred, I think, by now, educational trading investment series over the years. Ray, let's go ahead and bring you on here. How you doing today?
Okay,
Hello?
Jeff, can you hear me now?
Yeah. I can hear you now. Let me go ahead and send this. How you doing today?
Good, how are you?
Good. Let me go ahead and make you the presenter.
Okay.
Right.
I gotta see where I am here. Let's try this one right here. Yes, Jeff, or no?
Let's see. I can't, let's see. I can't see.
I do see his screen, Jeff. I'm not sure why you don't. The one that says Raymond Ray Round right on the top.
We can see you. I was actually looking for your video. Okay. Yeah, we can see your screen, Ray. We can hear you.
And can you see me or negative?
Let me send a webcam request over. I don't see that it's turned on, but it's easy to, you should just get a prompt right now.
The slides are much more interesting to me, but we'll give it a go anyway.
You look great. All right, very cool. I'll get out of the way.
Are you open, ready to go?
Yeah, it's all yours.
All right, Jeff. Normally I get you back on time, but I don't think I'm going to be able to get you quite back on time this time, but I'll be within my time.
Hey, it's all good. We'll catch up at some point today.
Okay.
All right, it's all yours.
All right, guys. Well, welcome to today's presentation, Evolving Your Approach to Today's Investment Markets. It's an important topic about evolving with the markets. And to keep this interesting, we're going to have a few giveaways. We'll have some questions. And we're going to do some current chart analysis, which is a little bit different. We're going to look at NVIDIA and Tesla, Citigroup. We're going to look to try to apply some of the theory that we'll be discussing. To begin, I want to thank Kelly and Jeff and Metastock, of course, for having me here today and congratulating them on their newest inversion, Metastock 19. As you may know, AAI has recently partnered with Metastock to help traders and investors. Excuse me. And one of the benefits of this partnership is we're going to be sharing AAI's flagship educational offering, the EI video course, with Metastock customers, including AAI's fundamental-based stock scans. And I have 4 slides on this, and as soon as we get through these 4 slides, we'll get right into the educational components. The course has 17 classes right now and over 12 hours of material. The classes in the course are not simple recordings of an instructor or the repurposing of some type of webinar. They're professionally produced, studio grade, full-featured, interactive, excuse me, recordings, and it really features on essential investing principles and strategies. The course is housed in a professional learning management system, the gold standard for online learning, contains dozens of instructions and navigational documents. The course includes an exam, and if you pass the exam, you get certified, you get a certificate of completion, an extensive list of AAII course certification benefits, including free membership. The primary educational content, which you can see here, are full-featured scorum. They have jump to table of contents, keyword searchability, they're ADA compliant. It has everything that you can imagine we could put in. This video here shows you what's in each individual class. And we could go through this just quickly here if the video decides to run, which it doesn't seem like it wants to. Okay, we won't. Oh, there we go. It starts with a snapshot tab right here. It gives you some preliminary information about the credits, the time. We have an instructor tab. Most instructors will answer your questions if you reach out to them about something that you have in their class. We have preliminary learning materials. We give you keywords and definitions. We give you all the slides. We also give you articles that the instructor recommends before actually taking the video or going into the class. Then we get into the primary components. We've already discussed the video, but there it is right there. We give you presentation learning objectives and key takeaways. When you finish the video, it unlocks the quiz. When you pass the quiz, this will unlock additional bonus videos. It also unlocks a segment called Words of Wisdom, the single most important piece of advice from the presentation. It will also give you free other free resources, like perhaps a book or a free service, and then it gives you a certificate of completion. And again, remember, this is at each class level. Then you have all the benefits at the entire course level. Following that, you can see right there, we give you tools. A lot of times you'll get tools or spreadsheets. We'll give you additional articles to do further research. Then we have a survey. There's a discussion forum where you can share ideas or ask questions, and a help section. That gives you a basic idea about the course. One thing to keep in mind, the course is not static. We've already recorded future classes. They come out every so often. We have MACD fame, Marvin Appel. He already recorded his class. Louis Navalier has a class coming up on how to pick winning stocks. Marty Fritzen on fixed income investing. And we actually, the next one we have coming out is Fidelity's Director of Quantitative Research, Denise Chisholm. Her class is going to be coming out, I believe, in 2 months. So you get the idea. You're really learning from the best of the best in their respective fields. We give you a full year to complete the EI course, and it even includes a 60-day money-back guarantee. And it took us literally 5 years of effort to put this course together, and that's not an exaggeration. So if you're interested, you can find it directly on Metastock's website. I'm hoping Jeff can post the link. It's listed right there, and it'll kick you out to this page where you could go, and it's www.ai.com/affiliate/Metastock. And if you go there, you can even get a free class, and you can just try a free class to see if you like it. All right. That's enough on that. Let's get to the investing and trading and why we're all here. And these are the general areas that we're going to look at today: gaining an edge, volume and conviction strategies, and improving system performance, which can be applied to any system, any trading or investment system that you're utilizing. Now, I've been doing this full time for decades as a researcher, a tool developer, but more importantly as a trader also, right? I ate my own cooking, and if I didn't trade well, I guess I didn't eat, you know. But as detailed in this Kiplinger article that came out a few years ago, I have a few core beliefs like everyone does, and I want to just touch on these. Belief one, to be successful, you need technology. Others have it, you need it also. I think we agree. Metastock, great product. That's why we're here. Belief number two, you need proven approaches. Proven. What we will look at today are certified results by a third party. And we're going to give you these results trade by trade. Anybody can say anything in this business. I think it's important that people can prove what they're stating. Number three, that's probably my biggest thing, you have to evolve with the markets. I'm going to show you numerous examples of this. It's great that there's indicators available that were made 40 or 50 years ago and they're right in an investment platform, but are they really made for today's market environment? I'm going to show you some evidence to suggest they're not. And number four, belief, you have to have an edge. This is only article. Your edge may be different. Everybody has an edge, but to be successful, you have to have an edge. My edge is back testing, and I let computers do the bulk of my trading for me. To save some time here, as I'm talking about back testing, you're going to see me running a scan on the conviction systems from the date of the release of the conviction program on 5/8/2023 with Metastock. I'm going to show you 10 years worth of data that's certified, but what has it done since the program has been released with Metastock? That's what I'm showing you here. I'm actually running it live, although I condense it a little bit because it takes a while. Now, as this runs, a large portion of my findings and research, and what you're going to see here today, is evidence-backed. And as you can see in this screen, indicators, tools, and strategies are programmed, sometimes with thousands of lines of code. They're tested over decade-long time periods on hundreds of issues, and then we optimize these to establish factors, and then we synergize these factors to create the most efficient trading systems. In my opinion, this is the best way to do this. And I'm going to just jump to it. You can see us generating it. Since we've released this with Metastock, you can see it's had 24 trades, this system. 87% of them were profitable. The profit factor is unrealistic at 10.85. It's going to be more around 4 to 1. And it's returned about 3.42% every 22 days. Consecutive wins was 13 in a row, and it's never lost more than once. So at least we're trying to establish credibility here and showing you that we have data to back up what we're saying. Now, establishing factors is critical in strategy design. And here's an example of this. It's a simple example, but I want you to take a look at this. In this table, you can see backtesting optimizations of bar length, again, excuse me, for our reversion, which is a new indicator that's going to be coming out in the spring with Metastock that we have. But I want you to see here, see how as bar length increases from 20 to 80, how the total return right here also increases up to a point and then stops to diminish. And this is a classic Gaussian relationship. And this is what we look like to establish if a measurement has relevancy, and then we would look to incorporate that. Now, here's another example here with the same indicator, and look at how important this is. What I'm showing you here is the backtested results of something with an exponential moving average and something with a simple moving average. Basically, one letter is being changed in the code. And look at the difference in how much it increases performance. And this is similar to Bollinger Bands. And John was right that simple moving average works better, even though exponential seems to be more logical. The point is here that you don't guess. We don't care about our 20 years of experience looking at a chart. You back test it. And this is the best way to find the answers. And if you think this doesn't matter or make a huge difference in returns, I'm going to have a little fun with this. The first person to type in the number of dollars closest to the answer will win a free class. Okay? And Jeff is going to be the judge, jury, and executioner on this. So we're going to ask you a question. Type in the answer to this question, what you think it will be. How much do you think that improving your return by, say, $10, we're going to say 5 cents on 200 shares on a buy execution would improve your financial situation 35 years later? If I could save 5 cents on the 200 shares on a buy execution, how much is that going to benefit me? We're going to say at an 11% annual return 35 years later. And 11% is the average return on U.S. equities over the last 90 years. And we should all be able to do that. All right, I'll give you a second to type in what's the dollar amount. How much do you think you're going to save or improve your return 35 years out? 11% annual return. Okay. And the answer is $375. $375 for every $10 gain on an entry or an exit with these parameters due to compounding. That's $750 more money 35 years out in your pocket at an 11% return. Right? This equates to hundreds of thousands of dollars for the average trader. So by backtesting this stuff, it's important because these small amounts, these additions really expand down the road. So we need an edge, we don't guess, and we use technology. And this is the primary theme of this presentation, as I discussed. On this screen, you can see certified results on a large study over 10 years in the S&P 500 between Bollinger Bands, stochastics, RSI, and that new indicator that we have coming out called R reversion. And you can see the differences here. If it's green, it's better. And it's almost universal by incorporating newer technology and evolving with the market. And this, our reversion uses conviction, which I'm going to be talking about now, how it really can improve performance. And these results have all been certified by an independent third party. And we're talking, 20 to 35% increases in potential return on simple buy-sell executions, in this case of vans. All right. One of the factors that makes our reversion, as I mentioned, is called conviction. And it's really what we're going to focus on the rest of the presentation. And even if you don't want to use our conviction indicators, you can certainly utilize the theory in your own methods. Now, with conviction, the question becomes, can we design consistent systems with 85% hit rates, and we prove it, with 3.5 profit factors? Is it realistic and attainable? And is there evidence to support this? And this is what we're going to look at. We're going to start with volume. And if you don't know what volume is simply the number of units or shares of contracts transacted in a given time period. It's a measurement of the intensity associated with the price move. And we display this amount at the bottom of a chart. And to keep this simple for this presentation, all our charts will be daily, okay? Now here we can see an example of some daily volume bars, and the amount of volume is represented by the height of the bar. And volume can be plotted as a single color or two colors. Red if price finishes down from the open, and if green if price finishes up from the open. I think most of you know this. Believe me, we're going to expand this quickly. And it's an important point to remember that volume in conviction, as you will see, levels are only relevant when compared to the issue's historical levels. The levels are not absolute unless you're using them for liquidity analysis. So for what's high for Tesla may not be high for GE. It may not be relevant. So now that we have volume displayed, how do we use it? Well, it's believed, and it's logical, that price movements on days with relatively high volume are more important and more relevant than price moves on days with lower relative volume. Just think of it like a significant other, a teacher, or your boss. The higher their voice volume, the more serious or meaning with the event and the message that they're trying to translate. And we see relatively heavy volume for a variety of reasons, like with a new unanticipated revelation about a security. When it occurs, it causes a price shock, right? The big boys are coming in and they may know something. We see their footprints. This is what we're looking for. Now, another reason that we can see volume is with technical events. Here we can see this with this breach of major support on gold a while back at points J and K. The point here is that technicals have relevancy, and they're often reflected in the intensity of the volume. Don't anybody tell you differently that there's a lot of computers and a lot of people moving money off of technical events. And that's what you traders are doing. Now we're going to expand this theory to volume, and we're going to expand it to trends. And we were taught that volume expanding with price moves in the same direction of the trend is supportive of the continuation of that trend. And we can see this with the green arrows. And we're also taught that similarly, lower relative volume levels and diminishing normal natural price retracement back towards the trend are considered to be supportive of the current trend. And this is logical. We want to see volume expand with the trend and contract when prices are just kind of gravitating back. It's straightforward. It's been around for a long time. But unfortunately, our markets have changed dramatically since the tools that plot and analyze volume were first developed. On this slide, you can see several of those reasons, and they're all legit. And that's what we're going to look at now. Not necessarily a paradigm shift on the analysis techniques, but adjustments to the way that intensity is measured and displayed. And this can make a real difference in your returns. This brings us to the term conviction. To be clear, this is just a term that we're using. In fact, in its most basic form, conviction is almost identical to dollar volume, with both values representing the approximate total dollars exchanged over a given time period. We're not going to use volume, but we're going to use total dollars. So how does conviction differ from total dollars? It's really simple. A dollar volume just uses the close. With conviction, we're using the high, low, close, and open prices. That's all we're doing here to give a better representation. This is a key slide. Here we have single colored volume bars plotted in the middle pane and conviction dollars with the RCM indicator plotted in the lower pane. And I should point out that RCM stands for Relative Conviction Momentum, and it's a tool in the Metastock platform. Now look at point A. Notice the amount of selling pressure seems to be increasing with the volume bars on this downtrend. And because of this, we would conclude, according to traditional theory, that the downtrend intensity in the trend is likely to continue. The intensity is increasing as the price is moving down. But when we look at the actual dollar volume, the true conviction at point B, we can see that the intensity is actually decreasing from a total of around 100 million per day to 80 million per day from the start of the downtrend. Yeah, the volume may be increasing, but that's only because the stock's prices during this period are now less than half of what they were when the downtrend started. By using volume, it creates an intensity illusion. Well, why does volume come with every chart? Quite frankly, because it's cheap. It comes direct from the exchanges, and it doesn't have to be processed. That's the reason. Now, here's another example with Tesla, where the price dropped from $300 to $100 between the yellow vertical lines. Notice volume at point A, again displaying the increase in intensity illusion. But when you look at point B, we can see that the selling intensity as measured by dollars is not increasing, and hence the turn in upward prices right here. And this obviously works both ways when prices rise dramatically. Here's a long-term example of this with PBF, where prices went from $5 to $50. It's a good trade. But notice RCM at line B is supporting the continuation of the 18-month upward trend, showing supportive or increasing intensity. Whereas volume at line A is skewing the intensity view, displaying a decrease against the continuation of the trend. With volume, it looks like the buying pressure is decreasing, get out, when in fact, it's really not decreasing, right? The sheer amount is decreasing only because the price is going higher. Now, unfortunately, this phenomenon has hurt many investors who attempted to use volume analysis in this manner. It's not because a trader or investor doesn't know the rules, but it's because of the visual volume skew that occurs on large price movements, which conviction in general specifically addresses. Now, we're going to dive into a little deeper what exactly RCM does, or what you should be looking at for intensity reasons. This is a chart of AT&T, and the primary signals that you would find in Metastock's RCM are the green dots right here. And the green dots show areas of potential bullish turns. What they show is the slowing of diminishing prices on less conviction, dollar conviction, right, dollar volume. But we see buying pressure seeming to be losing steam on the downtrend. And we can also see this right here, where it's plotting the red dots saying, yeah, price is going up, but the intensity seems to be decreasing. And it's a way to try to identify turns. Intensity readings in RCMs can also be used as secondary signals for reinforcing the primary direction of the trend. And these appear as small plus or tick signals with our tool right here. And you can see on this uptrend that kind of continues, you can see these plus signals saying, yeah, the underlying nature of the intensity is supportive of the move. We see up moves over here that suddenly reverse, and you notice the absence of the green tick marks. It's measuring at a deeper level. Now, RCM doesn't only display if the security finishes up or down, but it adjusts the intensity of the color to reflect the magnitude of the price move. It's not just red or green. Brighter green colors highlight large relative upward price moves, and brighter red colors highlight large relative downward moves. The height of the bar reflects the intensity, but the color of the bar represents the magnitude of the price move up here. And this makes it much easier to identify important price moves like blow-offs, high volume, large upward price moves, and selling climaxes. A couple more things on this, and this will help you with any intensity analysis. Now, even if you only use primary intensity signals, it's important to remember that RCM, again, or any intensity momentum readings are best as short to intermediate term trend retracement signal generators. This is an excellent example of the cues. RCM definitely does a great job calling these short-term reversals here and bottoms, but you can see it only brings it back to the downward prevailing trend. This is important to keep in mind. Now, it's critical to note that RCM and all intensity-based indicators only display areas of potential change in trend. It's not an absolute, and this is true with all conviction indicators. More evidence is definitely needed. With the same chart and on the same theme, we have another important guideline, again, for all intensity-based studies. One or two dots with an established trend are noteworthy, as price often continues onward when we see this. But to get a true trend reversal, we need to see multiple dots for any considerations of a true change in trend. And here's some current analysis on NVIDIA. And you can see right here, I think very interesting, right? Price is going up, but what do we see? Downward conviction. So this would imply that based on this one measurement, that this upward swing back into resistance right here may not be as bullish as it may look, that the conviction isn't here. So if we get a gap down here on high volume or high intensity, with the next indicator we're going to look like, this would be a nice shorting opportunity where we look to short here, place our stop right up here above the peak, and then our first profit target will be right down in here. So I'm going to try to sprinkle in some current analysis with these tools. A second study for intensity readings in Metastock is called OBC, or Optimized Balance Conviction, and I'm pretty sure you know where we're going with this. RCM looks at increasing or decreasing volume in relationship to trend. But for trend continuation or trend reversal appraisals, there's another way to do this, and it's by evaluating up volume versus down volume, or up conviction versus down conviction. And again, we call this optimized balance conviction. Now, OBC analyzes up versus down intensity, like Granville's OBV, or on balance volume. But OBV was created literally 60 years ago in a completely different market environment, and really in an era when we're using pencils and papers for calculations. So as you would expect, OBC first is going to use modified dollar volume, which has the same advantages over volume to prevent price skews. But OBC does something else that's very important. It proportions the amount of the intensity to the magnitude of the price change to calculate its values. And this is the most complex part of this entire webinar. It's only a couple slides. You can tune out. We're going to get into more stuff later that may be of more interest. Here's a brief example of the calculation differences. Here we can see how OBC calculates the proportionalizes the adjustment amount based on the magnitude of the move, and OBV just says, well, I don't really care what the size of the move is, I'm going to subtract or add the same amount. The key point here is with OBV, the stock could drop 0.1% or 50%, and OBV subtracts or adds the same volume amount in both circumstances. From another perspective, if a stock finishes up a penny, OBV would say, oh, we're going to add that all as positive volume. But if the stock finishes 2 cents lower than that, it would say, oh, we're going to subtract all of that as negative volume. Obviously, that doesn't make sense, and we can kind of prove that by measuring it. Now, that table showed an extremely simplified example to illustrate the base calculation concepts. But the truth is, the development of OBC took a long time. For people that really want to understand and know what it is, I'm going to give it to you in a sentence. OBC proportions a percentage of the dollar volume up to a certain ATR threshold. and then it takes a linear one-to-one measurement up to another ATR threshold, and then it buffers extremely high readings to prevent outlier skews. I know, it's complex, but the program designed and optimized it to be the most effective it could be, at least based on past historical analysis. The takeaway here is with this approach, accumulated conviction is more representative of the intensity of the up and down moves, as moves on higher dollar volume and large price moves are just going to give more weighting than the vice versa. And this measures it on up and down moves. Now, here's another example with another indicator called Chaikin's accumulation distribution, because OBC does something also different. Now, with Chaikin's accumulation distribution, the catch here is that this indicator doesn't include overnight price movements. I don't know about you, but those count, in my account, right? I'm not kidding. A stock could lose 30% in a day, but if it closes 1 penny higher than the open, this indicator would say that's positive volume and positive intensity. It only calculates from the open to the close, and that really doesn't make sense. With OBC, it includes overnight price action. So we're not going to do any more math here. So how do we interpret OBC? The good news is we interpret it just like OBV. We plot it over price, and its interpretations are the same. In this chart, we have OBC in white and OBV in magenta. The primary signal is the divergence from the price action. Now, you're not going to find a lot of them, but when you do, they're often meaningful. Okay. For those of you who are unfamiliar with the concepts of the divergence, this occurs when a price and an indicator head in different directions. An OBC bearish divergence occurs when price is heading upward or sideways and OBC starts heading downwards. Here's a good example of an OBC bearish divergence on KLAC. You can see price moving up, but look at OBC saying, no, when you start to look at what's happening in the up volume versus the down volume or dollar intensity, it's not supportive of the move. Something is happening that's not bullish. Now, an OBC bullish divergence occurs when prices are heading downward or sideways and OBC starts moving upward. It's just the opposite. Here's an excellent OBC bullish divergence on Tesla, where you could see prices were heading down, but look at OBC right here. Started heading up, forecasting the move going. Unfortunately, not all of these are this obvious. I'm going to just jump on this quickly. What you just looked at right here, I'm showing you another view of this and what's happening here. In the blue square right here, you can see that we're showing the close on price as dots. You can see there really wasn't a lot of change in the prices. So what OBV was doing, it was saying, oh, it was a down day, it's a down day, it's a down day. It keeps subtracting that volume, but the down days were so small that they really weren't relevant. OBC filtered this out and proportionalized it, and you can see how OBC took off, forecasting the upward price move much earlier. Here we have a chart of the S&P 500 or the ETF SPY. Again, at point A, you could see price going up, but look at OBC saying, yeah, but not really. And it correctly forecasted a 6-month decline in prices. And just to show how it works both ways, here we can see the same where prices, were heading downward still, but OBC is starting to head upward on the right, forecasting the turn in prices. So that's kind of what you're looking for there. Like RCM, if you're having trouble spotting diversions, we have an expert advisor, and it gives you the analysis, and it literally describes it right here. Here we have a chart on Kellogg, again, showing prices dropping and OBC rising, forecasting right here, the upward rise in prices. So we give it to you even in written commentary. OBC also provides a divergence strength rating when a divergence is occurring, based on the concept that larger, stronger divergences are more meaningful, and they are. In this tool, higher positive values are more representative of a possible bullish turn in prices from a current downtrend, and lower negative values are more representative of possible bearish turn. But again, we need more analysis, and that's where we return to price. If you're going to use up-down intensity indicators, there's a few tendencies that you should be aware of. This is with all intensity analysis, with the most important being that bullish divergences are harder to find, but they also tend to be more reliable. And why is this? Simply because downward price moves typically have more intensity due to fear being a bigger motivator than greed. There's some other general elements of OBC that you should understand, but to save time, we're just going to skip these. If you want to learn more about OBC and RCM or intensity, and you should, it's an important study. You can get both classes for free from AAII. They're a lot more in depth. You can learn at a slower pace, and then you can test yourself. Here's some current analysis, and this one is on Citigroup right here. And here we can see prices rise, but we see OBC starting to question it, actually heading downward. And we have two large down days right here on high intensity, which we will see in our next indicator. So this might be something, you know, where you may want to consider perhaps taking a little profit off if you were long on this gap, which was a beautiful trade right here. And then we had a gap here, retesting of support, forming a resistance, the gap over resistance. This is a trade I would have taken. But at this point, you know, you may want to take a look at it. We have beautiful support here, 1 touch, 2 touch, 3 touches. Any breach of this support right into this void would probably a sign reinforced by OBC. So that's how you would try to use this as a secondary reading. Kinetic conviction, our third and final tool before we look at the strategies, is another indicator of the series, and we need to define the problem. High frequency trading distorts intensity readings like volume and conviction. It's a fact, unfortunately. And although I'm not sure anyone knows how much HF activity there is, we know it's a lot. And it's hard to quantify, but we have to accept that this exists. I'm not going to cover the math in this example. You can go back through this if you want. Just look at the bottom here. The point here is because of high frequency trading and because it distorts the true intensity that we're trying to analyze, it creates a huge denominator right here. So what kinetic conviction is trying to do is it's trying to eliminate the high frequency trading aspect of that. That's again distorting our intensity-based readings. And we're trying to do this by increasing or decreasing the denominator in the measurements. And to do that, we're going to look at differentials. The differential, I'll explain it in a minute. Dock pool activity. Dock pools are private exchanges for institutional investors that allows them to trade large blocks in a security with adversely impacting or shocking the market price. They exchange shares where the public can't see them, at least at first, and they're controversial, but there's pros and cons. The point is they do exist. For our purposes, the key thing to keep in mind is with dock pools is that they do not disclose their intentions, so our order books right here don't show them. But the results are reported, albeit on delay, after the completion of the entire block trade to the consolidated tape. So we do see the intensity at some point, just not in real time. Now, dock pools account for a large number of total shares traded. Again, with estimates varying so widely, I'm not going to even touch on them, but we do know they exist and we want to incorporate them in. So that's kind of the theory and the reasoning and the basis for this tool called kinetic conviction. And kinetic conviction is an indicator that highlights important activity by increasing relative sensitivity through the means of measuring price, volatility, volume, and conviction dollars. And it does this by calculating, displaying the difference between the current bar's conviction and its exponentially weighted average conviction differential. You're not seeing the amount of the intensity, you're seeing the difference of the intensity from its average and from its recent average. So it has a more recency bias and it gives us a more representative, accurate measurement. It's much easier to interpret to and explain, but I think I did a pretty good job explaining that. So here we have standard volume bars in the lower pane and kinetic conviction right here in the middle pane. With standard volume bars, it's not always easy to see if the day's intensity is noteworthy or even if it's important to the recent levels, because we're looking back too far. And this is what kinetic conviction does. It tells us if it's above or below average, and more importantly, it does it to its recent price action. It gives us a better representation of relevancy in which we're looking for. So evaluations, if KC values are above the 0 line, they're displaying the bar's conviction differential is above its conviction differential average. If KC values are below the 0 line, they're displaying that the bar's conviction differential is below its conviction average. KC price moves with intensity values above a standard, it's a green standard deviation band, is considered more relevant and meaningful. The move is of great importance. This is where you want to take notice. And this deviation band is a deviation band of the differential. Again, it's not a deviation of the conviction. KC price moves with intensity values below the lower red standard deviation band are considered less relevant and meaningful. Price movements are less important. Bottom line is, if the moves go outside the bands, you may want to take notice on it. Now, not only kinetic conviction beneficial for single day evaluations, which is its primary purpose, but it can be used for trend evaluation. Here's another example on Tesla, where we have, you can see high supportive conviction on the uptrend, okay? And then, but we see it has low conviction right here on this stabilizing, which is interpreted as bullish. Yeah, price isn't going up, but it's, you know, or maybe even coming down a little, but it's not doing so on high conviction. With kinetic conviction, it really defines this with the 0 line and the measurements of the differential. Then sure enough, we know it's just a consolidation. We see the price break and the gap right here. And then we see this huge conviction breakout right here, saying that the upward trend is intact, and now it's going to likely to continue. That's another way that you would lose it. Here's a recent chart with Tesla right here. And notice how we have standard deviation breaches right here. Price has been stable. Look at, we have the gap right here. You can see the green dot showing. And here's a signification right here. Hey, this is high intensity. This is high relative intensity on the differential. And we can see the breakout. And then we can see some right here in the red, right here, saying, boy, these are pretty noteworthy compared to its relative price action. And we can see the start of the downtrend. So there's an example of how you might incorporate this. KC has the expert advisor and a commentary reports, more statistics than you're ever going to want to know, but we tell you everything. One key measurement that I do want to point out is the KC dollar intensity. It's showed right here, the blue arrow. And this is probably the most important of all the readings if you're going to look at one single number. A value of 0 represents the bar's Dallas conviction is equal to its average. A value of 100 indicates the bar's dollar conviction is twice its average. Okay, so it's an important one-step measurement if you want to look. Now that we've covered all 3 indicators, this is the money slide, and here we have the recommended setup for a complete conviction view. And this template is already set up in Metastock. It's called the Conviction Trilogy. And at the bottom, we have RCM for classic trend analysis. In the middle, we have kinetic conviction to highlight important moves. And on top, we would have OBC to look for the divergences. And those are really important from a longer term perspective. All right, the conviction systems. Here we look to validate the indicator and use them to reinforce our investment analysis. And for traders, this is where we would generate ideas in the Metastock Explorer, and where you can create your own. Before we start a little housework, the screen basically tells us don't steal our stuff. This screen basically tells you all the reasons why the material might be not be 100% accurate, even though we back test it and show it to you, and why it may not be suitable for all investors. And the last one here is, I don't know, but Jeff wanted me to put it in, so I'm putting it in. You can ask him on that one. Okay. All of these results that you're going to see from a single 10-year study from 2014 up to 2024, to January of 2024, on every component of the S&P 500 at the time of study. When a signal occurred, investors said to purchase $5,000 worth of whole shares of stock, and they always rounded down. Interesting, all the signals were generated ELD. So you got the signal on Monday, you took the trade on Tuesday. This is the results for the long-term scan or the LT scan. Highlights here is a good number of candidates at 1,766, a strong profit factor of 2.66. And by the way, profit factor is just total wins divided by total losses. LT generated an average trade return of $215 at 4.35% with a modest holding period of under 11 weeks. Results over a 20% non-compounded return. An incredible 48 consecutive wins, but it also lost 13, and that's the problem with having a long-only strategy and having to hold through the COVID downturn. Here's the equity curve. Did have a minor drawdown during COVID crash, but held well recently. All right, let's look at the next one here. We're going to go through these quick. This is already like a 3-minute section. And I'm going to show you some ways to improve investment returns regardless of the strategies that you use. Here are the results for the ST scans, which stands for short term. Highest number of candidates, 1873. We're now at a hit rate of 77%. Negative here is it had the lowest profit factor, although still 2.5 to 1. 9 consecutive losses. We're not looking for that, but it did have 35 consecutive wins to help offset some of that pain. Here's the equity curve on this. Pretty nice, right? And these are exact from the program, okay? I'm just copying this from that back-tested program that I showed you. These results show after the closing of the position. These are not day-to-day adjusted. I would say short-term is more for investors or traders with an intermediate-term time horizon, looking for a system to identify a list of potential positions. For optimal performance, you'd probably want to apply additional analysis methods to refine a larger number of candidates. Okay, here are the results for the PF scan, profit factor scan. This has extremely impressive results. Baseline 81.7% hit rate. It was even more since we've released the program with Metastock. At a baseline, it had a 3.73 profit factor. But on the downside, it only generates 3.5 trades per month, and that's on 500 stocks. Here's the realized equity curve. This is the exact equity curve. Because this system is so selective, it generates very consistent returns and never had a losing year during the 10-year period, and it never even lost more than twice consecutively in 10 years. But I would not expect that to continue. I would say this system is probably best for investors or traders with a shorter term time horizon who prioritize risk and consistency of returns and who are willing to scan a large universe of stocks for potential candidates. If you're interested in the conviction systems, we provide each convicted user extremely detailed performance reports for all 3 systems so you can review them and make an informed decision. We give you the system parameters, hit ratios, projected returns, every transactions and efficiencies, drawdowns, etc. We show you in the worst of times and the best of times. And as we mentioned, we had all 3 system performance reports certified by an independent third-party company called QuantKey. They're a leader in systems design, development, appraisals, and evaluations. But it gets better because now in our last section here, and this is just showing you right here that we give you manuals. There's like 70 pages of manual with these, with examples to help you learn how to do it. And of course, you'll get the classes on it and with testing and certification if you decide to try conviction with Metastock. I will let Jeff talk about this aspect because I have one more section. I should mention that if you buy conviction, you will also get AAI's proof. And what this tool does, it helps you identify and tells you how many shares to purchase. What it does is it volatility adjusts position sizes, and it tells you to keep all your risk in proportion. You don't buy equal dollar amounts of the same position, right? That doesn't make sense because the volatility of issues is different. What this does is it tells you it volatility adjusts it, and it can be used for new, and it can also be used for rebalancing positions. This can be used for stocks, it can be used for ETFs, it can even be used for mutual funds. We kind of threw that in to there. All right, improving system performance. I'm going to try to get back, Jeff, Jeff back on time, but this is about a 6-minute segment, so I'm going to be close. We're still short of the 85% hit rate and the 3.45 profit factor goal that we said that we could hit. So in this section, we're going to look at 6 methods to improve the performance of these systems. And again, these can be used to improve the performance with any system, investing, or trading approach that you decide to use. Our first method to improve performance, you don't even have to do anything at all. The conviction studies in the results don't include dividends, which would greatly increase your returns. Studies show that 40% of the total returns of the S&P 500 are dividends. That was our study group. Performance measured, and the returns was only measured on price appreciation. Dividends would only enhance this. When you add back in the dividend amounts, not only does it increase returns, but many of the convictions system smaller losses, as you can see here, 0.01, 0.02, 0.04, would then turn into gains by putting in the dividends. And this would have propelled us from 81.7 up to the 85% hit rate that we were looking for. Number 2, there's no market timing mechanism in this, which is absurd. For me to develop the system, I had to show entries and exit even over bad times. I could have did an overlay of another system or incorporated it, but we didn't do that. Okay, the bottom line is here, don't do this, don't fight the tide, right? I mean, my hope is that you would not be looking to execute long strategies in a bearish market environment. But regardless, this was not incorporated. Our third way is other technical elements, of course. I think this is how you would benefit the most. This is certainly how I do. Scans are built from systems that are designed for research purposes and to identify factors, right? From an execution standpoint, scans' purposes are to identify securities that meet the system's criteria and to reduce a large number of securities down to a manageable size for further evaluation. Even someone with modest trading or technical analysis skills is going to be able to filter out the bad setups, improving your performance results significantly. So certainly use your relative strength, your other indicators, your support and resistance are the things that you're more comfortable with. Overlay it with candle patterns, you will definitely improve returns. Fourth, these systems did not incorporate fundamentals. And anyone who gets the conviction package, as I mentioned, gets a complimentary 1-year AI membership, and you get all of our fundamental scan tools. And you can see right here, this video showing of these scans based on the philosophies of some of the world's all-time greatest investors. My favorite scan here is called the My Screen scan that shows you the individual stocks that appear in the largest number of fundamental systems. Show me the one that meets 7 or 8 fundamental scans or systems, and then I'm going to overlay it with the technicals. But so for people that believe or like to use fundamentals, this could further improve long-term performance. We didn't incorporate that. Number 5, compounded returns on the profit factor system backtested to well over 40%, right? But for professionals that would like to be more aggressive, integrating options is a consideration as these systems target very quick, high probability executions. Now, obviously, the effectiveness of this method is dependent on the skill of the investor, but I would not rule out using options if you're experienced and comfortable using them, and especially with the LT, the long-term system, which tends to hold where you can start to generate positive theta. Or look for the trifecta, right? The dividend and the price appreciation, and sell the option. Number 6, money management. Believe it or not, everything we showed did not compound returns. Compound returns make the big difference for the system. Reinvesting profits would have greatly enhanced these returns. Additionally, you can increase returns by incorporating money management techniques like moving stop losses to assure profitability, or scaling out of your position so you can let some profits run, increasing overall returns. Here you can see 2 conviction trades where profits probably could have and would have been extended. It got you in at very nice areas right here, but there was probably no reason to get out. The trend was still intact. What I would recommend is taking some profits, getting into a position where you can't lose minus gapping, and then just letting your profits run. So don't be afraid to use money management techniques. If you'd like to learn more about conviction, you can just email me and I can send you some free classes on the topic. And you can still get the free class from this offer by going to that website right there, ai.com/affiliate/Metastock. And Jeff, I did it again. I got you back on time to the minute. My sincerest hope is that you learned something in this presentation that you can use to improve your trading and investment returns. Remember, we have reversion coming out with Metastock in spring of 2025, an indicator that is better than any conventional or traditional indicator, at least back tested. My name is Ray Rondeau. I'm an investment strategist and senior technical analyst with AAII, and I like to consider myself a friend of Metastock. I thank you for your time, and I hope you got something out of this presentation.
Well, we consider you a friend, so we could even make it Facebook official. We do have a question. Can you put up the link for the classes again?
Yeah, Jeff, again, I just want to make sure that everybody can access directly from the Metastock website.
They can.
Yes, we have an affiliation with them. We value our relationship with Metastock. We think they have a great product, and you know, we want to make sure that Metastock gets credit, you know, for this.
All right. One more question that we have is, has this been tested in international markets?
We get that a lot, and we have not, in fairness. But I think we all believe, I would say most people on this call believe, that markets are fractal, pricing movements are fractal. In general, they're a representation of human behavior. Most human behavior is going to be somewhat consistent, even though it's over a geographical border. And I think that when we're establishing factors, I do know that that is true, although the synergy of those factors and synergizing them, I doubt that they would be different internationally, and we would project they would be the same, but I cannot produce evidence, third-party certified evidence to prove that.
Yeah, well, that's generally what we see. As long as it's a free market, generally, any technical analysis will translate well. And we do offer a money-back guarantee too, if you want to try it. If it doesn't work for you, that's why we want it to be valuable for you. So
absolutely.
Anyway, yeah, thank you very much, Ray. I'm going to talk a little bit more about this.
I'm sorry, I'm just going to end with this. If you got one thing out of this presentation, I'm just going to end with this. It's just that how markets evolve, and you have to adapt and evolve with them. And a lot of the tools that I know that are common and they're on all the sites and stuff, they're not really that effective. And there's certainly ways to synergize and make them better. And that's why I like Metastock, because they're constantly bringing new, evolved tools to the marketplace. And that's really important, Jeff. You agree, right?
Oh, yeah. And that's one of the things. It's actually right here on my first slide.
Okay.
Absolutely. Well, it's a unique approach. It's not your grandfather's volume analysis. You did a great job with it.
All right, Jeff. Well, thank you for the time, and thanks to everybody at Metastock, and we'll see you soon. With reversion.
Thank you very much, Ray. I appreciate it.
Good luck to you.
Yeah, of course. Greg, please let me know if I'm sharing the wrong slide or the wrong screen. I can't seem to. Oh, here it is.
I see the one with the AAII conviction.
Right. Yeah. Cool. It's not a YouTube link, so that's good. All right, very cool. Do want to talk a little bit about this and just kind of recap. Ray does such a good job actually showing this stuff and talking about it. But I like how he's gone in and kind of, not only does he kind of show everything, he backs it up with solid math. If you're putting money into something, you want to understand exactly what your drawdowns are, what your consecutive losses are. And Ray is probably one of the most, if not the most, best system designer when it comes to actually providing numbers. And that comes with the accreditation that they offer and all that kind of stuff. So I like how he's kind of gone in and accounted for kind of the fact that we have a more volatile market. And all of that stuff goes into the work that he has. So he did highlight 3 different indicators. I'm not going to go into a great amount of detail on them, but you've got your optimized balance conviction, the kinetic conviction, and the relative conviction momentum in there. It does include 3 methods, a long-term, a short-term, and a PF method. With the long-term, your average trade length is about 82 days, and it's perfect for those investors that have a really long-term horizon. You've got your short-term system. Has all of these systems have explorations. They've got expert advisors. They've got scans, everything you need to kind of run with it. For the shorter-term system, you're looking at an average hold length of about 35 days. And Ray went through all of kind of the performance metrics and the maximum wins and the most consecutive losers and all that kind of stuff. He does a really good job of it, and he backs it up with math. You've got your PF system. This was the most selective of all of the systems. It's got an average hold length of about 27 days. And this is fully built into Metastock. It's fully integrated with Metastock. You get the expert advisor, it tells you when to open, when to exit, what your stop losses look at. Of course, you've got scanning. I think, for me, the ability to go in and say, okay, there's 5,600 stocks. Show me the ones that have a good opportunity based on this system is very, very helpful. I want to pay attention to the ones that have an opportunity. I don't really want to look at 5,600 stocks a day. So tell me which ones kind of have a good opportunity. So all in all, this add-on, Ray Rondeau's Conviction Plus, by the AA, or in cooperation with the American Association of Individual Investors, includes 7 indicators, 4 explorations, the expert advisors, the templates, everything you need to get going with it. It also includes detailed training courses on how to use it, 1 year, as he said, of AAII membership, access to their learning research module portals, all of that stuff's included. So normally it's only $14.97. That's a one-time cost. And normally, as always, we back it with a money-back guarantee because we want you to use it. We want it to be valuable for you. We want you to buy it and have it help you make better trades. So we're going to back it with a money-back guarantee. If you haven't tried our award-winning software, it's won 32 years straight, best software in its price category. You can do it now. And we'll include a trial. We'll include a money-back guarantee. I don't know of a better risk-reward scenario that you've got. Give it a go. You can do that if you want to give us a call, 800-882-3040. You can go to metastock.com/saleschat. You can go to metastock.com/conf-promo. You'll get the systems, you'll get the expert advisor, you'll get the scanning, you'll get the access to AAII for a year, you'll get the access to the learning research modules. All that stuff's going to be included. And if you don't find it's helpful for you, we'll even promise that it's helpful, or we'll give you your money back. 800-882-3040, metastock.com/saleschat, metastock.com/conf-promo. Give it a go. All right. Oops. Actually, accidentally clicked on the sales chat link right there. We're going to go talk to him. I want to say thank you to the Traders Forum, a sponsor of today's event. Go to thetradersforum.com. You can join a live market chat. You can talk about ideas. There's a lot of free education up there. It's a community of traders helping traders. I think right now there's about 850 members. We'd love you to be 851. I invite you to come join us at thetradersforum.com. So I hope to see you there. Of course, we're Metastock. Greg, I know we are just a little bit behind, so let's quickly give away a prize. While you're coming in here to help me, and hopefully you're around.
I'm here.
Okay, good.
I'm always here, Jeff.
We're going to give away a couple books and a mouse pad. So Steve Bigelow, huge friend of Metastock, the late Steve Bigelow. We've got his book, Candle Profits, Eliminating Emotions. The major signals, candlestick major signals mouse pad. This one, unlike this one, doesn't have any coffee stains on it. I'll send you the coffee stain free version. And then high profit candle patterns. I would say Steve was a great friend of ours. He had a huge impact on the way that I trade and the patterns that I trade. And we're going to give you away those 2 books and that mouse pad if you're lucky and if Greg makes you random. Greg, do you feel like making somebody random?
I believe that the coffee stained trackpad, mouse pad may be worth more than a new shiny one.
Yeah. Well, let's make somebody random.
Okay.
I need a number between 1 and 6369.
And that number would be, excuse me, 123.
Oh, wow. Your random number generator went low today on that
Hey,
one.
I'm just saying I'm using the Google random number generator. Google's usually pretty good at, being random.
All right. Well, the gentleman that just won is from the USA. We do our best not to totally dox you on the internet. Kelly doesn't like it. The winner is Charles P. And Charles P has a Gmail address. So Charles, congratulations on winning that prize. If you are a Charles P, you probably did win. I'll send you an email just to confirm we've got an address for you, or get one if we don't, and send it back to me. And I'll go to the post office personally and drop it off. So there you go. All right, very cool. Our next presenter is John and Jack Kosar. We love having them on. They've been on a number of events. They always do a really good job of kind of talking about kind of the strategies that they use. And let's go ahead and just get them on here. John, Jack, how you doing?
Okay.
Hello?
Can you hear me?
I can hear you now.
All right. Okay, let me see. Webcam.
Okay.
We're working on webcam. Okay, show screen. Here's webcam right here. No one can see you. Huh? All right, give us a second here. With live television. Yeah, I can put this and plug it back.
I can see the screen now.
That's right. Our presentation's definitely more interesting than our face.
I disagree. I mean, they're both interesting.
So we need to do this. Where?
If we can't get the camera working, though, that's not that important. I mean, we can go without it.
Okay. Let's see. Please close on. And try again. I'm going to try this one more time, and if we can't, okay, for whatever reason that we cannot seem to figure out for the moment, we are, let me try one more thing.
All right.
This won't be any longer than a minute.
John and Jack, sometimes, this is Greg in the back, sometimes it is because your camera is used by another bit of software that might be turned on.
That's what it's saying, but I can't see what that piece of software is.
And as Jeff said, we would love to see both of you, but if you can't get the camera going, we can see your screen.
Yeah, and we can hear you, which are two really important.
Those are
Yeah,
really
that's
important things. Those two things.
Yeah, our faces are a distant third. So, okay.
All right, I'm gonna get out of the way. It's your turn.
All right,
We'll
great.
see you in a minute.
Good. Thanks, everybody, for spending a little bit of time with us today. What we're going to do today is kind of go through our approach to markets. Everybody has their own approach depending on what walk of life they came from. Mine was, I think my path was kind of dictated by the Board of Trade that you could see right there in the background, and the Chicago Mercantile Exchange. I spent almost 20 years on the trading floor in the 80s and 90s, and that was kind of my introduction to markets. And how we look at markets, I think, has a lot to do with that, which was more the practical side of the market rather than coming from the academic side. So what we're going to look at today, the market's up 75% over the past 27 months. It doesn't seem like that. I had to do the math 3 times to make sure that it was right, but it has. From the peak that we had about 2 days ago, that's a long way to go in a relatively short period of time. The markets are basically a mean reversion animal. So what tends to happen during these periods, as infrequent as they are, is that people get really complacent. You know, who needs to look at research, or who needs, you know, to have a defensive plan in place? You know, we've made a whole lot of money over the past few years. People tend to forget that the further that the stock market drifts away from the mean, the more stretched out the market gets, as it is now, the more likely that you are to have a pretty nasty correction. And the stock market's a unique investment in that it has an inherent upward bias. I come from the commodity space where it wasn't that way. So once I started focusing on equities full time, it was different. It was a different approach. It was not so much as what to buy, but when to get out of the way so you could protect whatever you were able to catch when the market was going higher. So let's advance. This is just a little bit about us. So now you can see what we look like because our camera's not working. So I've been doing this for 40 years. And my son, Jack, he's my business partner. He's the legacy to this business, and he's the math really behind Asbury Research. Over the course of doing this for a lot of years, I've accumulated a lot of metrics that worked for me when I was in the pit, and they've worked for me since. But when you look at markets, unless you back test, and I was watching Rondeau, and I like the back testing strategy that he has. Well, we do the same thing here, but what we have done is taken a lot of the metrics that I've used during my career, and we started back testing them in sets of 2 and sets of 5 to try to determine, to try to build models that are going to allow us to get good entries into the market and then be able to stay in the stock market I'm talking about. I'm not talking about commodities here. And then be able to ride those trends as long as we can and avoid the significant changes in trend lower, so we can buy them at lower prices. The best way to make money in the stock market is to avoid a drawdown and then be able to reapply those assets at a better level. So Jack's, I'll let Jack tell you, but Jack's comes from the academic side. My kind of plan all the way along was that Jack was going to go into business with me and be the legacy for Asbury, that he would have the academic chops that I don't have.
Yeah, so I got my master's degree in finance after going to school on a baseball scholarship, and I've really just been around this business for a long time. I probably started helping out at home, looking at charts, reviewing articles when I was 10 or 11 years old, and it's kind of it's in my DNA at this point. So I took all the things that my dad, all the experience that he brought, went to school and kind of got the accreditation so that we can take Asbury to the next level and really bring a two-pronged approach, the academic side with the practical side, and it's been working out pretty well.
So what we're going to do today is we're going to go through, so I try to simplify things down to their essence. And basically there's two things we need to know if we're investing in the stock market. We want to know if the environment is risk on or risk off. In other words, should I be buying the market? Should I be buying stocks? Should I be buying more stocks? And then the second thing is, what should I be buying? Because nirvana is if you can buy the market at a good level and you could catch a trend higher. And then rather than just being in a vanilla index, you can be in the right sectors, the right subsectors, the right spots in the market, so you could outperform. For me, that's the white whale. If you can catch most of the trend and you could be in the right parts of the market so you can outperform the S&P 500. It's hard to do. It's hard to beat the S&P 500. It's extremely hard to beat that consistently, but so that's what our models are built to do. So we've got a half a dozen of them, 7, 8 different models. Our CPM model is the correction protection model, and that's a simple risk on and risk off model. We're going to take a look at that one. The Asbury 6 is kind of our daily health check on the market. I'm going to show you what we use for that. I'm going to show you the metrics. So hopefully at least you can walk out of here today and have an idea of how we tell day to day if the market is healthy or if it's unhealthy. Our CEF model is our sector selection model, sector rotation model. That is one of the tools that we use to try to be in the right places at the right time. If you can get the direction of the market right, which is mostly up, and then you could be in those 2 or 3 sectors that outperform, that's when you have great years. The best years that we've had here recently have been 2020, 2021, and 2022. Ironically, they were opposite types of markets. 2021 was when the Fed kind of went full tilt into bringing the market back after COVID. And I think our CEF model outperformed by 20% that year. Then the following year was a major downtrend in 2022, and we outperformed by almost 30% that year. Why? Simply we were in the right sectors in those years. Our CARP model, I don't know if we're going to cover CARP today, but CARP is our cross-asset model for domestic asset allocation. If you're going to be in the market, if we are in a risk-on scenario according to our CPM model, then we want to be we want to know which parts of the general U.S. market to be in, and that's large cap or small cap, tech or the broad market, growth or value, high beta or low vol, things of that nature. Again, being in the right place at the right time. Our U.S. versus the world market, we are going to look at because that model has been really starting the year off making a lot of money. It's not something that happens all the time, but there are times when global markets outperform our markets. And if you're aware of when those times are, you can really get an opportunity to make money in a period where really since the beginning of December of last year, the S&P 500 has been relatively flat. It's been hovering between 6,100 and 5950 for that whole period, but a lot of foreign markets have been really killing it, and so we'll take a look at that one. Our ETF trade ideas for short-term trading, and then we are just going to touch a little bit about how we've taken these models and blended them together. It's like the latest thing that we've done. We're starting to manage money now. We're managing money for other RIAs. Asbury's an RIA, and for individual investors. What we've done is blended these different models that we have built over the years into different model portfolios that create different risk reward scenarios. So here's where to find us. We also have a premium research product, and we have a Substack. We have a free Substack. So if you go to asburyresearch.com, Substack, asburyresearch.substack.com, you could sign up for a free piece of what we do via Substack. So we talked about CPM. I'm an older investor. I'm in my middle 60s, and as such, I have a lot of older investors as our clients. And what most guys that are in their 50s and 60s are looking for is they want to play the game with less risk. When you're 30 or when you're 40, you're kind of in a dollar cost averaging mode, where if you're working for a company, you invest in your 401k and you take whatever your company gives you for a match, and you make sure you're buying stocks every time that you get paid. So in 20 years, you've got a nice dollar cost averaged foundation for what's going to get you into your retirement years. Once you get to be middle to 50s to 60s, the game changes. And I always equate it to football. In the first half of a football game, which when you're in your 30s and 40s and 20s, that's your first half of your investment football game, so to speak. That's when you could throw some balls down the field, you could do some trick plays, handle the ball, and you could recover from a mistake because you got a lot of time on the clock. Once you get into the fourth quarter, which I think is really where I'm at now, once you get in your 60s, 70s, certainly the game changes. You don't want to go into the fourth quarter with a lead and then cough the ball up, have a fumble, make a mistake. And that's where something like CPM has been very good over the years. So we've back tested this going back to 2017. It's completely data driven. There's 6 different ingredients in there. That's our secret sauce. But basically, it's risk on or it's risk off. When it's risk on, we are in SPY. SPY, of course, is the ETF that tracks the S&P 500. When we're risk off, we are in BIL. And BIL is, I'm going to botch this name, but it's effectively the Lehman 1 to 3 month Treasury bill ETF. It produces a yield close to maybe 8 to 13 week T-bill. That's probably close enough. For conversation here, it's yielding about 4.19 right now, 4.20 maybe for a yield. So what it is it's a dynamic stock and bond portfolio. If any of you have ever used a advisor, first thing the advisor does is he asks you about 10 questions, and then he says, well, according to our model, you are a 60-40 bond guy. So that means you're going to be 60% in stocks, 40% in bonds, and then they may give you a little international and a little bit of gold to round out your portfolio. It's set it and forget it, and you cross your fingers and you hope that one of those pieces that are in your portfolio over time is going to help you make money. What CPM is it's a dynamic stock and bond allocation. When the model says risk on, we're in SPY. When it says we're risk off, we're in BIL. So this chart here that we're looking at, this goes back to October of 23, and it's been a pretty straight up, I mean, outside of the past little choppiness that we've had, but you can see the green arrow is risk on, red arrow is risk off. You might say, well, John, how come you got out here when it only dropped on April the 15th of 24, when you were right back to risk on May the 3rd? Because I didn't have a crystal ball that told me that this was going to be the extent of the decline. But what we're trying to do is get similar performance to the S&P 500, but with less drawdowns. Because if you have less drawdowns, when you get back into the market, you're effectively getting back into the market with a lead. Let's say the market has a correction here between now and Memorial Day where it drops 35%. And we're out of there after a 20% drawdown where the market goes down 35%. So we effectively have a 15% lead on the next time that we get back in the market because we were able to avoid that final 15% on the way down. To me, that's the most careful and easy fourth quarter plan to trade the markets with less risk. It's meant to be a wealth preservation tool, and it's binary. It's either risk on or risk off. On average, since 2017, there's about 5 round turns per year, so a little bit more than once a quarter. We're moving from risk on to risk off, and then back to risk on. 5 round turns a year. There's no short positions or derivative. It's really on and off. It's as simple as it can be. And in our back testing exploits, the simpler you make these models, the better they work. The more bells and whistles and caveats that you put in them, in our experience, and I've heard this from other people who do this, the models become less reliable. So if you're building models out there, simpler is better. CPM's annualized total return is nearly identical to the S&P 500, but with significantly lower risk than the S&P 500, according to standard deviation, beta, and maximum drawdown. And it's got better risk-adjusted numbers according to Sharpe ratio, Sortino ratio. If you're not sure what these things are, Investopedia.com is a terrific online glossary of financial terms. CPM can become an alpha generating model. If we use leverage, we'll have a look at that. So this is CPM going back to, this is going back to 2017. And you see the risk, the standard deviation is lower. It's 12.1 for CPM versus 16.9 for the S&P. What does that mean? That means your P&L is going to be less bumpy than the S&P 500 is. If the S&P is volatile, this is going to be less volatile to the S&P 500 than the S&P. Beta is another way to measure volatility within your account. The S&P always has a beta of 1 because it's the benchmark. You can see the beta here is 0.61, so less bumpy and less volatile inside your P&L. Sharp ratio, a little better, 0.83 versus 0.65 at the S&P. And here's the one that's the most important to me, the maximum drawdown, 33.9, let's call it 34% for CPM. Or I'm sorry, for the S&P 500. And that was during COVID, which is effectively, I think it started the last part of January, early part of February in 2020, and it bottomed on March the 27th. So just in those couple of months or 10 weeks or whatever it was nasty. I mean, it was 34%. The CPM model during that time, it only drew down by 20, and then CPM moved to bill. So when the market started to go up again, you were effectively 14% ahead. So you started in the next rally 14% ahead of the S&P 500 by avoiding that 14% chunk in the middle, that last part where it dropped into the March 27th low. This is what the chart looks like. Here's CPM trading it with SPY, again, about 5 round turns a year, starting in October of 2017. And notice how the two lines are really close together. Here's COVID right here. Hopefully you can see my mouse here. It's in about the first third of the top chart. And you can see that about halfway down right here, CPM, it goes flat. That flat part of the line here means that we were in cash. We were in bill, effectively. So when the rally started on March the 27th, effectively the beginning of April, we started from a higher level. And that means we could have got whipsawed a couple of times and still been able to stay right on top of the S&P. So that's the moral of the story there. This is what it looks like from 2018 if you look at year by year by year by year. So generally speaking, we're staying close to the S&P but with less risk. Here's if we use it as an offensive strategy, and all we did here is instead of using SPY, we're using SSO. SSO is, what is it? It's a ProShares product, I believe.
Yeah, 2-time leverage.
It's a 2 times leveraged S&P 500. Susan Oscar is the ticker, SSO. You can see now our standard deviation in CPM goes a little higher. It's a little bumpier than the S&P. Not a ton, but a couple of percentage points higher. Here's a Sharp ratio, 0.8, better than the S&P. Sortino ratio is another way to measure risk-adjusted returns, and the maximum drawdown goes to 31%, still about 3% less than the S&P. But look at the difference in performance. Over that period, the S&P was up 132.15 here on the right, and CPM Ultra is up 204. It didn't double it, but it did a heck of a lot better. I think about 4 or 5% annualized relative outperformance a year, again, with a little less risk than the S&P 500. Not a lot of trading, but all we're doing is we're taking advantage of the S&P's inherent upward bias, and we're getting out of the way when our metrics, when our internal metrics tell us the market's getting weak. This is the Asbury 6. Did you want to talk about the Asbury 6? I will take the Asbury 6 and I'll let Jack have the rest because I think I went out of sequence and Jack should have had the CPM. The Asbury 6 is our daily metric that measures the internal health of the market. I built this for myself because for those of you that have been around the markets a while, you've noticed that the volatility in the markets, the daily, the day-to-day volatility in the markets has really increased. Thursday, I think we were up. This past Thursday, I think we were up a little bit. Friday, we were down 100. Friday was hair on fire day, and now today I'm looking, and S&P is up 10. There's a lot of day-to-day volatility, and I don't care how long you've been doing this. When the market's down 100 and you're long, you start making mistakes. So Jack and I built this tool with 6 diverse constituents to try to give us a better idea of what the real health of the market is, and not the way the algos are twisting us into a pretzel on any given day. So these green and red arrows here are showing you the ins and outs since February of last year. So this is 1 year. You can see it's a lot more active. It's that way by design. The S&P 5 or the Asbury 6 has about 11 round turns a year, 11 and change. So it's like once a month. So if you're an active trader and you don't mind this, what this has done historically, back testing this back to 2017, is it has stayed right on top of the S&P 500, just like the CPM has. But the difference is the maximum drawdown here has been 13.6% instead of the 34% for the S&P. So we're basically getting S&P-like returns, again, looking backwards because we can't see forwards. It hasn't happened yet. We're getting the same returns as the S&P, but with a third less risk, which means you could actually use some leverage here and be able to take advantage of that. I do that for my own account. So here it is. The A6 have been a relative performer versus the S&P since 2017, but with its 13.6% max drawdown versus 33.9 for SPX. We use 6 different indicators that we back tested together because there is no indicator that works all the time. Every indicator that I've ever seen in 40 years has an Achilles heel. So we found 6 that work together as a group. They're the rate of change in the S&P 500. They're the relative performance of stocks versus high yield bonds. We're going to look at charts of all of these in just a minute. Investor asset flows and SPY, volatility, trading volume, and market breadth. You need 4 in one direction in order to give a directional signal. Last week, the A6 was green up until Friday. After Friday, it turned red. You can see all of these dates in here are all from 220 and 221. That was Thursday and Friday of last week. It turned in a hurry. It was sensitive, and we want it to be. This is telling us that the market internals in the S&P 500 or in the stock market right now are negative. So even though the S&P is rallying up, it's up 12 right now, unless this changes back to 4 or more of these constituents turn back to green and end up in this column, it's time to be careful. It's time to tighten your stops. It's time to not put any new money to work and maybe think of taking some of your money out and putting it into another asset, be it gold or the dollar or wherever you go when the market's weakening. So here are those 6. You can get an idea of what I'm doing. This is the monthly rate of change in the S&P 500. When it's above its 21-day moving average, it is positive. It turns out green on the Asbury 6. You can see it's been negative down here underneath the 21-day moving average since February the 20th, and it's even dropped below its 0 line. So this means that from a momentum standpoint, the S&P 500 is weak. This is one of the Asbury 6. Here's relative performance between stocks and high yield bond prices. Stocks we get from SPY, high yield bond prices we get from JNK, which is the Spider Bloomberg Barclays high yield bond ETF. That is JNK. When stocks are outperforming high yield bonds, the market goes higher. The S&P down here in the lower panel goes higher. You can see it edged below its 21-day moving average. This relative performance chart in the upper panel, that gives us a negative signal there. This is ETF asset flows. This is the total net assets invested in SPY. when they are expanding above their 21-day moving average. Notice that I'm using a 21-day moving average across all Asbury 6. When you're building a model, when you're building a strategy, you need to be looking at different indicators through the same lens. If I want to use a 35-day for this indicator and a 21 on that one and a 15-day on the next one, chances are I'm curve fitting. You want to be looking at different metrics through the same lens. You can see this just edged below its 21-day moving average on Friday, indicating assets shrunk on Friday. Money came out of SPY on Friday. Why? Because it was a weekend, the market was down 100. But look at this, going back all the way to the middle of December, it's been flat, just like the market. That means there's no real conviction right now to buy SPY and hold it. That's why we're whipping back and forth through this 21-day moving average. But for right now, this is a negative indicator. This is the VIX, volatility. It measures fear. When the VIX is above its 21-day moving average, like we were between middle of December and middle of January, the market doesn't like it. It goes lower. S&P 500 up in the upper panel goes lower. You can see we had a big spike up in the VIX. That is also negative. Notice that all of these are at tactical decision points. This is really close to the 21-day moving average. So is this. So is this. And our next one is the same, volume. This is cumulative volume, but it collapsed below its 21-day moving average on Friday. Prior to that, it was up above it since January 12th. And that gave us all of this in the S&P 500. So we're turning lower, but we're not crazy lower. We're just starting to turn the corner, but all of these 6 metrics are doing so at the same time. That means unless we get a quick recovery from where we are right now, and the S&P 500 is sitting right on its 50-day moving average, this thing is going lower into March and April. So this week directionally is really important for the market. Our CPM is still risk on, but the A6 is telling us that the market's weakening, and unless it can kind of turn things around quickly, the market's got more, there's going to be more pain coming up this quarter. Finally, this is market breadth. This is the NYSE advanced decline line. You could see it collapsed below its 21-day moving average on Thursday and Friday of last week. So right now, all 6 of the Asbury 6 are negative, which is telling us the market is sick. It's vulnerable to having more weakness in the next weeks and months to come, unless we can turn back to positive on all or on 5 of 6 of these, which are all sitting within a very close proximity to their 21-day moving averages. From here, our SEAF model is sector rotation model, and here's Jack with that.
Yeah, so our SEAF model is our sector rotation model. What we're really tracking is the velocity of money through 3 time periods. So we have our 3 main time periods, which is our trading week, tactical month, and our strategic quarter. And we have our own little algorithm to calculate the velocity of money for each time period. And what we're really trying to see is building up of momentum of the asset flows. We want to see, where there's a lot of speculation and things if you watch financial television on what's gonna be the next big sector or what's gonna happen next. At the end of the day, we believe that asset managers vote with their dollar, and that's by actually putting money into certain strategies versus what someone's speculating crypto is going to do next tomorrow, or that we're going to see a big boon in healthcare because of some advancement that nobody can quantify. So we've built this table to track the velocity of money through the 3 time periods, and we do so by scoring them in each individual period. A scoring of 1 is going to get your best score. It's kind of like golf. And a score of 11 is your worst. That's where the money is flowing out of. So we've collected those scores over the 3 time periods to give it an overall SEAF score. For the model, the way we trade it, the top 3, we back tested at the top. We always are trading in the top 3. We've gone through various levels of back testing and found that getting the top 3 really gets you where you want to be in terms of investing. The reason is those flows aren't directly related to the pricing in the nature. So you want to know where the money is flowing directionally, and the top 3 kind of gets there. For our investors or our research clients who are not directly trading this model, we kind of tell them that you can use it in multiple ways. You know, if you're an investor and you're really into real estate, you might only be watching this line item, and you can say, hey, right now we're in neutral. You can see flows aren't really trending in any one direction, so I'm going to hold off on real estate, or I'm going to hold my position. But you can see as if it drops down, you're in healthcare. Money is flowing out of healthcare right now. Money is flowing out of consumer discretionary. Those are not good places to be. So this model does multiple things. It allows you to trade it as a tradable model, but also allows you to look at your portfolio and see where is your risk, and then, you know, where's your reward. And you want to be generally you want to be in the sectors that have a lower score or a higher ranking, and avoid the ones where the money is flowing out of. These are our rainbow charts. So, you know, using the table to try to tell people exactly what to invest in. Some people really love the table. Other people need to see it visually. So what we're tracking here up top is the daily CEIF score based on our algorithm. So, you know, a score here of 7 is going to relate to scoring up here toward the top. And what we have found is that when you are in this favored ranking, you tend to get some, on the bottom here is the relative performance versus SPY. So in this case, this is XLC, and we have our relative performance part on the bottom, and then our CEIF score at the top. So we've noticed that as the longer time you spend in this favored area, especially the upper favored, you tend to get some nice relative outperformance. In this case, on January 21st, we entered into favored. We did have a brief interlude into neutral, but we've been up 5% relative performance to SPY during that time period. And we, you know, weekly we produce these rainbow charts for all 11 sector spiders. We really want to give our clients a visual understanding of a nice higher CEIF score results often in relative outperformance. And through some of our back testing, what has CEIF done? CEIF is relatively, in terms of standard deviation, about that of the mirrors that of the S&P 500, which means the movements in CEIF are going to be daily price movements in CEIF are going to be roughly that equal to SPY. But where it really shines is our Sharpe ratio. Sharpe is our how much return that we get versus the unit of risk, which means, you know, we are really doing quite a bit better. My understanding is a Sharpe over 1 means your model is doing relatively well. We're doing all of this while keeping our drawdowns. You know, a company-wide initiative is making sure that our models are not only outperforming, but really specifically avoiding drawdowns or taking market risk. So whereas CPM was under in terms of maximum drawdown to kind of preserve your capital, what we do here with CEIF is we give you about the same maximum drawdown. In this case, we're slightly better over the time, tested time period, but with that, you get better returns. So this, again, these are all back tested. We're not looking forward. We're not projecting out cash flows for these various sectors. We're reading the data and putting ourselves in the position to be in the sectors that we believe are going to outperform, and CEIF has done that historically through our back testing.
So I'm going to take over from here, and I talked about in the beginning how knowing what's going on outside of the U.S. Is sometimes really important. This is called U.S. versus the world, and all we're doing is we're looking at the relative performance of the S&P 500 versus 25 different foreign equity markets that are grouped. We've got Chile, Brazil, and Peru here, South America. Then we've got continental US here with Canada and Mexico, Western Europe, Asia, Pacific. We've got the Middle East here, and we have Oceania, which is New Zealand and Australia islands, and there's a couple more in there. So the times that you use this, the times that I use this are infrequent, because most of the time the S&P 500 is in an uptrend because it historically goes higher over time. And most of the time during those uptrends, it's outperforming the rest of the world. There are times though, and this has been one of those unique times, that since January, since the beginning to middle part of January, I started noticing that it started out in Western Europe. First it was Germany, then it moved to Italy, and then it moved to Spain and France, and then here's Chile up here, Brazil down here. So basically what's happened over the past couple of months, while the S&P 500 has failed to rise and remain above its 6,100 high that it made at the beginning of December, slowly money started moving into other parts of the world looking for performance. It wasn't getting it here, so it was looking somewhere else. So during that period, so this is kind of like going to Vegas and spinning the wheel, right? If we get outperformance in 3 different time periods here, here's Germany that I talked about. It started outperforming well, here you can see the dates. Germany started has been outperforming on a tactical 21-day basis since Jan 7. Also, and on Jan 7, also on Jan 7, started outperforming on a strategic basis, which is a quarter. And it's also outperforming here. So if you get outperformance all the way across in multiple time periods, especially these two longer ones, tactical and strategic, are the most important, and you're not going anywhere in the US market, that's a good time to maybe take 10% of your assets that are targeted towards US equities, move them overseas. Since January the 21st, which was a couple of weeks after it really showed up here as being an opportunity, since Jan the 21st, Germany has risen by 6.6 outright, outperformed the S&P by 6.2%. When you're sitting in park in the S&P 500, 6.2% of relative outperformance in a month or 6 weeks is extremely good. Look at this one here, China. On 210, our model told us that we should be looking at overweight China. Here is China on the graphic. It's risen by 9.7% outright, outperformed the S&P by 10.2. So sometimes while you're twiddling your thumbs and waiting for the sun to come out in the S&P 500, understanding what's going on in a comprehensive model like this can give you some really great opportunities, especially if you're a fund manager, if you're managing money, if you're an RIA, and you're looking for performance somewhere. Now, these aren't trades that likely we're going to be in all year, but if we can pick up 10% of relative outperformance by being in China for a month or two during the early part of the year, that's a nice little pad in your portfolio to carry forward to the end of the year. Here's what that chart, here those charts look like. So here's EWG, which is Germany. Here's the outperformance date where it showed up on our model on January 21st. Here's that 7% of outright performance. Here's the 6% relative performance versus the S&P. Here's MCHI. This is China. You can see we've only showed up on our model on February the 12th. That's just a couple of weeks ago. It's already risen by 10%, and it's outperformed the S&P 500 by 10%. So again, ways to look at the markets globally to look for opportunities if there's nothing going on here. Here's our ETF trading ideas. These are individual trading ideas. We're more, I think, investors more than traders. But what we do here is we look for 3 different criteria to tell us that there's opportunity, maybe a little bit similar to what Mr. Rondeau was doing before us, looking for certain criteria that indicate opportunity. So we're looking for trend, we're looking for relative performance, and we're looking for asset flows. And when we get those 3, it tells us that there's an opportunity. So we scan about 6,500 ETFs every day, and it brings a short list to us. So we look at those, and those already are telling us that we have trend, relative performance, and asset flows that are all conducive to a good idea. Then I overlay some subjective risk reward parameters to them, and what we get is ideas that, and I'll show you how these have turned out over time, but this is currently right now we're in SPDW. That's the global stock index ex-US, which, like I talked about, that's where the action is right now overseas. This is EEM, this is emerging markets, part of that same theme, being overseas and not here. And gold, we've been long gold since January 31st. We've got a 5% lead there, and we're outperforming the S&P by 5%. Here's some historic trades going back here to the summer of last year. And Here's another one, just to kind of visualize. This one is one that we had going on at the end of last year. We had trend in IGV on October the 4th. We had expanding AUM as of September 10th, right here in the middle panel. And we've had relative outperformance versus SPY also from October 4th. During that period, IGV rose by 13%, outperformed the S&P by 10. So all we're doing is identifying specific criteria that we think is important for a profitable trade, overlaying some risk reward. You can see the risk reward here as we broke out of this pattern on October the 4th, and we keep doing it over and over and over and over again. And the result has been, and again, we're not short-term traders here, but a lot of our subscribers want this type of tool inside the toolbox that is Asbury Research. So since the middle of March of 2023 through the end of last year, 87 trades. We were profitable on 55.2% of them. Our average winning trade is 4.5%. Average losing trade is minus 1.9%. So our ratio of average winning trades to average losing trades is 2.4 to 1. Those are the ingredients. You want to be, most of your trades be profitable, and you want your winners to be bigger than your losers. And the third thing you can overlay, how long am I in my winning trade? So here's the average winning trade length in days here, 18 days. Let's call it a business month. 21 days is a business month. Average losing trade, 8 days, so less than half of that. So what does that tell you? It tells you if you're an options trader and you get a buy signal from our model, and we know that the winning trades are about 4.5% higher than where you bought them, and we know that the average winning trade length is 18 days. If you're an options trader, you could look to buy calls that are about 4.5% out of the market with 30 days or less that are left in the time premium. The most expensive thing about an option is typically time premium. So this allows you to buy options that are due to run out of time in less than 30 days. You have a target 4.5%, 5% above the market. Those things are going to be very cheap. You do that over and over and over again. We're in the process of back testing this. This is one of our projects for this year, but this is a way to use a thoughtful data-driven model to find options opportunities and to buy options for cheap when they're close to going off the board. I'm going to turn this back over to Jack. We're building some model portfolios now, which we use for our RIA money management business.
Yeah, so we wanted to be able to take, a lot of times this, hey, John and Jack, that's your model is really nice. How do I apply it to my portfolio? We're very much believing in sleeves. So, taking your money and divvying it up into various different sleeves. And for your equity sleeves, we wanted to be able to provide some options. So we have 4 model portfolios that really try to tackle different risk profiles. Everybody is at different ages and different levels of risk. If you're an older investor that is, kind of in your, we call it the 4th quarter of your investing profile, you've got be more trending toward an Asbury conservative or even an Asbury ultra conservative. Ultra conservative over the last 7 years has had a max drawdown tested under 10%. That's really specific to older investors that are potentially using their income that they built up over the year, or sorry, their investment amount over the years to be able to draw into their income. So they want to use an Asbury ultra conservative. For our maybe a little bit younger investors in their 50s or early 60s, really going into the Asbury balance or Asbury aggressive allows you to outperform the market and still, through historical back testing, we cannot predict going forward. Asbury aggressive takes on a little bit of leverage within its grouping. And the main thing too is by blending some of these strategies and we actually get some strategy diversification. So, some of our strategies actually have lower drawdown numbers than the individual components. And again, this is trying to make sure that we have a risk profile for every investor. So our hyper aggressive investors can go take on a little bit of leverage, and our investors that are looking to really hold on to their income can stick with the Asbury ultra conservative.
So to wrap it up, what do? We sell investment research and we are money managers. We just started managing money for other RIAs as well as a third-party investor. We have a premium research product that for individuals is $500 a quarter. We also have an entry-level Substack that's $25 a month. It's a very small piece of what we do for the premium. But if you go to asburyresearch.substack.com, there's also a free version there. So if you like how we look at markets, you can get a free chart once a week. It's kind of a chart of the week thing, but it'll kind of keep you in tune of what we're looking at and how we navigate the stock market. Our money management, we have the 4 different model portfolios as well as our individual models. 250K is our minimum investment, 1% annual management fee up to $1 million AUM, and we clear through Charles Schwab. What I hope to do today, and I hope we did, was, and here's a disclosure and disclaimer, you can contact us for a copy of the PDF. We wanted to show you what we're doing. Obviously, everybody here wants to sell their product or wants to promote their product, but I hope what I did was show you that if what's changed in my career is I've done this long enough to know what works for me. What I didn't know was precisely how it works and how these tools work together with each other. And that can be done by back testing those ideas. So I think the nirvana in this business, at least the one for me, was spending enough time on the trading floor and enough time around the business to have a pretty good overview of what are successful ways to trade the market, and then using math to create quantitatively certifiable ways to put these pieces together into a strategy that's going to keep your drawdowns low and enable you to do what the stock market has been doing for the past 100 years plus, is go up most of the time. So if there's any questions, I'd be happy to field those now.
We have two. So let's see. The first one we have is from Reginald on YouTube. Wants to know, how are you viewing the current Canada versus USA tariff situation?
This is a good question because that's precisely what we don't do. We're not looking at, I think it's three-dimensional chess of what's Donald Trump going to say next? Is it a 25% tariff, or is it nothing? Or what's that going to do to interest rates? And if interest rates go up, what's that going to do to stocks? And if stocks go up, what's going to happen? It's this parlor game that you can never win. We're just watching money moving in and around these various different places. So if I want to know about what's going on in terms of asset flows for Canada, I'm going to US versus the world right here, and I'm going to see what's going on in Canada. Right now, Canada is one of a handful of these 25 foreign equity markets that is not outperforming the S&P 500. So what I think of Canada, that's something that I might do with my friends if we're going to have a dinner party and we want to have a few glasses of wine and talk about world events. I do not use any of my thoughts on what's going to happen there are totally useless. And frankly, most other people's thoughts are useless too, because it hasn't happened yet. We're watching money moving around the board and trying to jump on those trends of money. We think that's the only intelligent way to trade this stuff, rather than try to forecast what 6 different world leaders are going to say on any different day.
Right on. Dominic wants to know, how does the CPM differ from Asbury 6?
Great question. We get it all the time. The Asbury 6 is meant to be a hypersensitive daily indication of what's going on in the market, kind of like an EKG for the stock market, right? You take your EKG and you see where the bumps are. You see if you're normal, if you're slightly abnormal, or if it's time to go to the ER. That's what the A6 is for. I've been doing this 40 years, and when the market's whipping up and down 100 points at a time, it's really easy to get thrown offside, to get thrown off of a good idea because the S&P 500 broke 100 points in an hour and a half, it's easy to spook you out of a good idea. The CPM is a model to be traded by older, wealthier, and more risk-averse investors that know that they're in the fourth quarter of their investment football game, so they can capture the S&P 500, close to the S&P 500, but with 40% less risk, smaller drawdowns. So if you're 65 or 70 and you experience a 35% drawdown, you might not be above ground by the time you get back to even. That's what the CPM is for.
Right on. So you can get more information at asburyresearch.com. You can get the perspective by emailing sales@asburyresearch.com. And anything else I should add to that, Jack?
Just that, I would not be a very good guest if I didn't mention that I've been using Metastock. I think Metastock was the first program I ever bought. I think it was in the 80s. It was either in the late 80s or the early 90s when there was Apple IIe, I think, was still around. I don't know. But great software, great people. We're big fans. The cool thing about Metastock is you can import all different kinds of data. Like you can go to Fred. Fred is the Fed's website where they keep all their data, all their financial data on jobs and retail sales, anything that you can think of. You could import any data right into Metastock, and then you could run a chart of the S&P 500 right under it or right over it. It's robust, and we're very happy to be friends with Metastock. And thanks for listening to us today. I hope you took something away.
Reginald wants to know if you like the answer to the question. He wants to know how to get an invite to the wine tasting.
That's
you can email me one too when it's up.
Yeah, that costs hundreds of thousands of dollars.
Okay, all right.
So and it's invite only, but thanks.
All right, very cool. Thank you very much. Sales@asburyresearch.com, asburyresearch.com, and big thank you guys. Thanks for coming in.
Thanks,
for
Jeff.
spending some time with us.
Jeff, thank you.
All right, I'm going to show my screen. All right, go ahead and kind of just transfer over real quick, and there we go. All right, I'm a little paranoid. Just want to make sure the correct screen is being shown. And since you can see a chart of AT&T, it is. Okay, let me go over here. Now, what exactly happened to my slideshow, though? There it is. All right, very cool. While we're kind of transitioning to the next guest, which is me, I want to say thank you again to AAII, great supporter of the conferences, great partner. We love working with them. AAII.com. Want to say thank you to Stocks and Commodities magazine. I haven't really mentioned Stocks and Commodities much yet, but they've supported our conferences and our events since we started them. We've been doing them for over a decade now. I think it's like 15 years maybe this year. It's been a lot of fun, and they've helped us promote and kind of sponsored and been part of the event ever since day one. So really appreciate that. www.traders.com. Great magazine too. Of course, the Traders Forum, you can find out more about the Traders Forum for free. You can just join tradersforum.com. We do sessions twice a week. We'll kind of sit down and just talk to somebody about how they started trading. John and Jack were guests. We'll do an indicator review, or we just talk about stochastics and how it works. We have people in there chatting, sharing ideas. It's a community of traders designed to help traders. And you can join. It doesn't cost anything to join, thetradersforum.com. So, and of course, we are Metastock. Greg, this is where I'm going to have you come in. We're going to give away another prize. So, Greg, if you don't mind, let's have you do that.
Oh, except I'm having a little problem with my camera, so I'll just come in audio only. How about that?
Yeah, no problem at all. So the prize, while you're getting in here, is we're going to give away a trade management planner from TechnoTrader. This is a trade management planner that you can use in either Excel. It also works with Google Sheets. And if you'd like to, you can order it off of their website for just $500. However, if Greg Lewis makes you lucky, then you might just win it today. So in that case, it's a trade management planner. Let me go over to my spreadsheet here, Gregory.
You got it.
What I need from you now is just a number between 1 and 6369.
Okay, and that number would be, that's right down the middle, 3963, 3,963, according to Google Random Number Generator.
Another winner from the US, and Andrea F. with a Gmail account in the USA. So if your name's Andrea, your last initial's F, there's a good chance you just won. It's not 100%. I'm not sure how many Andrea F's registered, but I'm going to go ahead and send you some information. Actually, what I'll do is next week, I'll send your information over to TechnoTrader, and they'll send that over to you. Greg, well, I'm copying this information over to my other spreadsheet so I don't forget later.
Yes, sir.
Somehow, tell the audience how they might be able to win if they're just watching on YouTube.
Oh, that's easy. All you need to go do is go to metastock.com. There's a big banner on the top. Select that. You'll go to our metastock.com Traders Conference website. You'll see you can see a schedule of all the presenters all this week, all 6 days, 44 hours, 40 presenters worth of live free education. And also, if you want to do what Jeff just asked, just fill out the form on the bottom and you will be included.
Yep. I need to refresh my list. I do it a couple times a day every day, so make sure you register before I do that. So, Greg, big thank you.
You're welcome, and break a leg for your presentation, Jeff.
All right, I will do that. All right. Of course, we are Metastock. How are we doing on the conference so far? I hope you're enjoying yourself. I hope you've learned at least one thing by now. I'm going to go ahead and just go into the next slide. It's my turn. So this is a brand new photo of ours. I think a few sessions ago, we were using a different photo and somebody's like, well, when is the current speaker going to start speaking? And then I realized I might just be catfishing you guys. So we updated the photos at that point. In any case, today what I want to talk about is, there's so many things we can talk a little bit about in Metastock. And we will be. We've talked about scanning already. We've talked about the ideas of system testing and things like that. With Metastock, it's a software company that I think started in like 82 or 87, something like that. It's probably on a slide that's coming up, but it's a software company that's been added to, and there's just so many things in there. I'm going to kind of highlight a few of things that even if you've been using Metastock for a while, you may or may not be aware of and might be helpful for you. Some of my favorite things in Metastock. So that's what we're going to do today. Before I get started, I'm going to read this again. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock should have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock does not endorse the purchase of a security, nor are we paid for the promotion of a security. No information contained in the presentation should be construed as investment advice or the solicitation to buy a security. I've said that a few times. 1982, I was right. Threw out two numbers, one of them was right. Okay. You can read this if you want to. I'm not going to really spend a ton of time on this. I started here at Metastock back in 1997. So I'm about to start my 28th year of Metastock, and it's been a good company. I absolutely love working here. I started at Inside Sales, which means if you have questions about how you can improve your trading, or if you're looking for a specific tool and you called us, you wanted to see what Metastock could do, there's a good chance in that decade that you got in touch with me. And so I really enjoyed that. I love talking about traders about what kind of challenges that they were facing and what they could do to kind of improve their trading. It was great. Since then, I've had a couple of different job titles along the way, but I organize all these events. My title right now is Director of Sales. I organize these events. I've worked with all of the presenters that are speaking over the course of the next week. I've learned a lot, and it's been a lot of fun. I've learned so much from working through with people and helping them design and get their strategies put into Metastock. So as we go, every time I look over here, I'm going to be looking to see if you have a question or maybe an answer. If you do, let me know. I'll be kind of paying attention to this. So the one thing that I will say about Metastock before we get going, and I always say this, 2 years in a row, it's been rated #1. I'm proud of that. For me, I use Metastock every day to trade. I use it to find trades. I use it to kind of identify exactly what I want to be trading. And I just love the ability to scan. We'll be talking about scanning all week long. But I think it's so valuable because for me, you know, I'm a fairly busy software professional. And for me to be able to just click a button and be able to get a list of the stocks and just see which ones I'm interested in, so helpful. I'd never be able to look at thousands of stocks at a time. And with Metastock, I can just scan for it. So very, very proud of the fact that we've been rated #1. The other thing I like to tell people as we kind of go into this, Metastock keeps more people in a support team than it keeps in sales and marketing put together. And if you ever have a question, if you need anything, you're going to be calling over here to these guys. They do such a good job. A lot of times they'll get like 100% support ratings on their after support surveys. And I think that's one of the things that we really offer. Every time we work with Metastock, I think we do a good job of really helping. So in any case, let's go ahead and go ahead and get in here. I just wanted to start with a question. What is the best profession for trading? And I put some multiple choices just to make it easier for you to answer. Is it a psychologist, an engineer, a teacher, a pilot, or an artist? What do you think is the best profession for trading? I want you to go ahead and let me know in the chat. And while you're doing that, I'm going to take a little sip of my tea right here. You guys are going to be quiet today, huh? Any guesses? What is the best profession for trading? Psychologist, engineer, teacher, pilot, or artist? All right, Ray, thank you. Ray comes in with B. All right, any other guesses? I think engineer is a good answer. It's not the one that we're actually kind of looking for. Another answer that we get a lot is psychologist. Psychologist, there's actually a number where Jake Bernstein started in a psychologist/psychiatrist role. He's going to be coming in a little bit later. Very, very smart technician. Dr. Alexander Elder was scheduled to be here today, but isn't. Another great technician. He was a clinical, I think, psychiatrist. Maybe a psychologist. So a lot of, Joseph, thank you for answering. E, artist. William, a psychologist. Michael, Jean, and Jürgen, and Peter, I'll say pilot. And then Camel says pilot, and Kelly says pilot, but Kelly knew the answer. So it is pilot, actually. And I always kind of think over the years, that's a study that I learned a long time ago. I kind of wonder why that was. And I think really it has to come down to one of the things I feel like is most important in the market, and that's discipline. I think with an airline pilot, you have a very, very disciplined approach. You have a checklist that you take off for landing, or a checklist that you use for takeoff and landing. You have, in addition to that, specific rules that you follow to the letter if there's an emergency, if there's something that you need to do. Very, very consistency with that. And so airline pilot is actually the answer I was looking for. And actually, we do have a couple of people that we work with that are actually pilots as well. Like Greg Morris developed a whole bunch of methodologies, designed manage money for stadium money management to the tune of something like $9 billion. Chuck Hughes, literally an Air Force pilot, does a lot of work with us in terms of options and options related. But I think the reason that is because of discipline. Richard Dennis, if you're not familiar with Richard Dennis, we'll be talking maybe a little bit about Richard Dennis and the turtle traders. The turtle traders was a very, very successful experiment back in the 70s and early 80s, maybe, about teaching people how to trade and rules-based. And they did a very, very famous experiment. But he said in the paper, I could always say, you could publish my rules in a newspaper and no one would follow them. The key to trading is consistency and discipline. So we're not really going to talk much about that, but I do really think that's why Metastock can be so helpful to people. Because when we talk about Metastock, we talk about technical analysis. And the thing I like about technical analysis, Charles Dow, the father of technical analysis, I just gave him that title, but I'm probably not the first one, always said that everything's discounted in the price. I love the answer about the Canadian tariffs. I don't know. I'm just looking at where the money is. What is the market saying? Steve Bigelow, another great technician that we used to work with, always said, the market, the fundamentals don't matter. It's the market's reaction to the fundamentals. I think that's so important in terms of what you're looking at as well. What I think you can do, what I like about technical analysis when you talk about it is generally it's objective, not subjective. It can be fairly simple, although it can also be fairly complex, but it's pretty easy to kind of look at. And what you're doing, even if you're just using a MACD indicator, what you're doing is you're analyzing what the price is doing, and you're looking at the reaction of price. You're looking at where support and resistance are. So, as I said at the earlier part of the session, I'm a little bit rambling right now. What I want to do is just kind of show you some methods that are very, very technical, they're disciplined. The thing I love about technical analysis in general is it's disciplined, it's rule-based, and let's just go ahead and kind of dive into it. Earlier today, actually, the first thing I wanted to show you is how to find stocks that are breaking through support and resistance. And a lot of times, even Ray was talking about, okay, well, if you kind of added some simple analysis to this chart, you can see that it's breaking through support and resistance. And I kind of thought that was pretty cool because I was like, well, that leads into really what I'm going to talk about today. And the first thing I want to show you in Metastock is how to find stocks that are breaking through support and resistance or trend lines. And so I've actually already kind of put up the chart here, but it's a chart of AT&T. And this is a template that's kind of put into Metastock. Somebody mentioned AT&T earlier. It's kind of, like communications is going up. The template that I want to show you is actually a template that's built into Metastock. It was initially an add-on that we sold. It was the first add-on that we sold. It was about 80 bucks. And then eventually we decided just to include it with Metastock. But what it does is it's going to look to identify a few key levels. Support and resistance, both on a long-term and a short-term basis, and then trend lines either up or down on a long-term or short-term basis. I've applied this template to a chart. If you have Metastock and you want to know how to apply this template, it's called Dynamic Trading Tools. And so if you just right-click on an open chart, you can go to Apply Template right here. You can add it. It's called Dynamic Trading Tools. You hit Apply right here, and then your chart will look just like mine. Okay. What this is going to do is it's going to look at and identify major areas of resistance. You've got one right here. Actually, this is a shorter term resistance. You've got a shorter term support level that's being drawn right here. You see this trend line that kind of started right here and has kind of been extended through here. That's a longer term support that's also automatically generated. And then you're also going to have like major supports of resistance and major terms of support, and they're just going to be drawn out for you. One of the things that I really kind of learned from Vince Vora over the years of kind of working is he liked to find stocks that were breaking through or breaking above, and this is an uncommon way to look at technical analysis, but he was looking for stocks that were breaking above a resistance level. Okay. In fact, one of the things he really likes to find, if you kind of talk or you kind of go through the boot camp that's included with this course, he likes to find stocks that are making a brand new all-time high or an all-time high low. Okay. But what I'm going to show you how to do is actually find stocks that are breaking out above support and resistance. So all of these lines are kind of automatically generated based on the algorithm that's put in there. And you can adjust them. You can kind of go in and there's manual ways to kind of play with them if you want. But since they're automatically kind of generated, we can kind of go in and find stocks as they're breaking through that major support or that minor support. Or if you want to find something that's maybe a short opportunity, breaking down through resistance. I said that backwards, breaking up through support or down through resistance. Or maybe you want to find something that's breaking through a trend line. Those are all, because of what we talked about earlier, those are all things that you can very, very easily scan for. And so let's do a real quick scan. I'm going to show you how to do it. We're going to open up our Power Console by clicking on this, this P right here. And what I'm going to do, I'm going to pull this over so you can see it. And then what I'm going to do is I'm going to come down here and you've got your charting tab here. I'm going to go to our scanning tab, which we call Explorer right here. Okay, I'm going to go do this. Now there's tons of scans that are built in here. You can look for stocks that have a MACD signal. You can look for stocks that are outperforming the market. There's literally hundreds of things you can look for that are pre-built. And you can even build your own. But the one I want to show you right now is DT. So all of the tools start with DT with the search functionality that we've kind of put into the modern versions of Metastock. You can easily find what you're looking at just by searching for it right here. And so if I type in DT, DT stands for dynamic trend. These are dynamically generated support and resistance trendline tools. And you'll see that there's a support and resistance longer term, support and resistance shorter term, breakouts longer term, breakout shorter term. These are all just scans I can run. Okay. Now I'm going to go ahead and run them. I've got two selected. Actually, let me kind of just turn this off real quick. Let me go back and we'll just run the one. Okay. Now I can run this against just about any market I want. If you're in India, you can scan the Indian markets, London. There's over 300 exchanges that are available in here. It's pretty easy to kind of find anything you want. If you're here in North America with us, you could go in and scan all the ETFs. Vince showed how to scan all the optionable stocks. To make this run pretty quick, because it has to go and calculate all of these, what I've done is instead of just doing all of the optionables, is I've got it set to scan just a couple index constituents. You've got the Dow Jones Industrials, which isn't selected. Now it is. I'm going to do the S&P 500 right here, and then the NASDAQ 100 as well. We'll take TASI out of here. I'm not sure why that's actually even in here. Probably because I wasn't the last one in here. Okay. I think that's it. Okay, so I've got basically NASDAQ 100, the Dow Industrials, and the S&P 500, and it's going to go through those. And you can see it's pretty quick. It's gone through, and it's eliminating about 45% of the stocks. What I want is to see stocks that have recently broken up through support. This will also give me a list of broken up through resistance. I need to retrain my brain around that, or broken down through support. Okay. Here, out of the stocks that we've got 295 results. I'm just going to go ahead and make this full screen so we can kind of look at it real quick. And here I've got the close. This gives me the close price. I've got whether it broke up, and there's a number here. Whether it broke down, there's a number here. And the volume on that breakup or the volume on that breakout. Now the number for breakup, that means how many bars have got. I scan this on daily. So 3M company broke up through resistance 212 days ago, which is almost a year ago. I'm not really that concerned about that. What I want to find stuff that is a little bit more relative. So I'm going to go ahead and scan that or sort that based on how many days or how many bars ago it broke up. And I'm just going to come down. We have a ton of stuff that has a 0 here, but maybe we'll just look at a couple charts here to kind of see which ones broke up through support within the last 4 bars. So I've got Sempra Ordinary, MELL, Hasbro, Analog Devices, and Paychex. All of those broke up within the last 4 days. With Paychex, it was 4 bars ago. With Analog Devices, it was 3 bars ago. Hasbro, it was 2 bars ago. And you get the idea. Okay. Actually, I'm just going to open up these 3 just to give you the idea, because I know we're running a little behind on time, and I want to show you the next part of the presentation too. So let me go ahead and just open these up. Okay. We do have, I did actually apply it so that we had all of these up. We'll just go ahead and kind of take a look at Hasbro. With Hasbro, we had a pretty big trend line for short-term trend line. So this actually would have come up on the trend line breakout that we had here. It broke up through this resistance level just a couple of days ago. It's settling back into it. And I'm just going to zoom in a little bit so you can see it a little bit closer. Here you've got that downtrend line. You've got the major resistance area, the longer term resistance area that's broke up, settling back in to see kind of testing it. We'll see what happens, but that's one of the ones that came up recently. Actually, I didn't mean to do that. Let's go back here. Okay. Okay, we'll go ahead and close this one out. Here's another one of one that's broken through. You can see this one's kind of been shooting up, and it has also kind of backed off a little bit over the last couple of days. And then we have paychecks. And again, very, very easy to go in and find those that are breaking up through resistance. And that's as easy as it is. So there you go. Let's go back in, and I just want to talk a little bit about something else. So that's called dynamic trading tools. If you want to play with it, it's available in MetaStock. Very, very good way to go in and find stocks that are breaking out or breaking down. Okay, I'm gonna talk a little bit about, let's go ahead and shift gears just a little bit here. Okay. Next system I want to talk about is one of our probably most famous systems that are in MetaStock. So the title of this presentation is Hidden Gems, and maybe it should come out of it just because we've been talking about it for so long. But I do want to talk a little bit about this. I probably don't have time to go into the third system, but it's okay. We'll spend a little bit of time on this one. If you have stocks you want to look at, let me know. Type them into the comments. We'll open up a few stocks if you type them in, and otherwise we'll just look at AT&T. I want to explain a little bit who Rahul Mohindar is. He's coming in, I believe it's Wednesday morning. He's going to kick us off in the morning. He is a partner of MetaStock for almost as long as I've been an employee, and maybe 1 year longer. I don't remember. He's a seasoned trader. His core business is to teach people how to trade in India. He's one of our most prolific dealers. Has been with us for a number of years. And one of the things that he wanted just to kind of talk about, Rahul, he has had a massive impact over the years on the MetaStock business. His years, there were years and years and years in a row where his sales would just double year after year after year. I remember this was back in the days of about MetaStock 10. So that's kind of goes back a long time ago. But we had him come into the office and we kind of talked to him a little bit, and we're like, hey, you're doing great. What are you doing? What are you teaching people how to use? And he showed us the system I'm about to show you. It's called the Rahul Mohindar Oscillator System. And we liked it enough that we bought it from him. This methodology is exclusive to MetaStock. You have to have MetaStock to use it. And it's one I've showed probably several hundred times, if not more than that. And usually what I do is I'll go in and I'll say, hey, what stocks you want to look at? Let's look at some stocks you're interested in. And we will just pull those up. And doesn't work on everything, but it does do a really good job of helping you identify the trend and trade in the direction of the trend. And as a lot of you have probably heard, like the trend is your friend, or befriend the trend, or like a rising tide lifts all boats. What this is designed to do is help you look at the trend and help you identify the trend. There's some reasons I like to show this. You know, with MetaStock, there's tons of stuff I could show. This is the very first system that I traded my own money with. It's also easy. So I'm going to show you 3 rules. I'm going to have to hurry now. It's simple to implement, okay? It's objective. So in other words, if I do a decent job of showing you the rules, you'll understand it. You'll be able to implement it. If you have MetaStock, you can start throwing it on the chart and make sure you like it, okay? I also like it because I believe as a trader, it's important to have solid money management practices in your trades, okay? And to me, that means one of the core components of that, without going to all the core components of that, is to have an exact idea of when you're going to get out of a stop before you enter a trade. I think that's a critical area where most traders fail. You know, they get into a stock, they have no idea when they're going to get out, and pretty soon they've lost so much money that they don't know. they don't want to close that position because they don't want to take that big of a loss, right? I think it's always important to have an idea of where that stop loss is going to be before you get into the trade. And with this, it's objective. Okay, you can use this on any time frame. I'm going to use daily today. It's typically what I'll do. I've done this in London. I've done this in Singapore. I've done this in, you just name the country, right? Typically, I'll just say, hey, give me some stocks. It doesn't always work, but it does work really well on stocks that have been in persistent trends. Okay, let's go ahead and look at it. And Aziz wanted to look at CLF. We'll do that. And let's just go ahead and open up some charts. We'll go ahead and use AT&T, but I'll also do CLF. So I'm going to go back into the Power Console here in Metastock. All the powerful tools in Metastock are in the Power Console. You've got charting. You've got the quote screen, which is just a quote screen. You've got a scanner, which we just talked about. System tester. I think we have one of the best system testers in Metastock. We won't talk about it just due to time right now. We've got a forecaster, which is patented, but right now and then we've got an option viewer. Okay, those are the core tools that are in Metastock. What I'm going to do is I'm just going to open up the chart here. What I'm going to do is I'm going to go ahead and put in T. I'm going to put in CLF. Thank you, Aziz, for that. And those are the only suggestions that I've got. So maybe just for the point of, let's look at GE as well. Okay. As I did before, you can see right here, I applied the template of the dynamic trading tools. I'm going to change that over. I'm going to make that the Rahul Mohindar oscillator. So right here, if we come down to RMO, there's a couple of different versions of these. I'm going to go with the RMO trade model shaded. With this one, I like it because it's kind of got the classic view. I'm very, very comfortable with RMO, but it also takes advantage of the new charting engine that we put together. And it just looks a little bit, I'll say it, sexier than the other one. So let's go ahead and open those up, and we'll go ahead and take a look at them. Now, I'm going to change the view on this just a little bit too. Okay, you go ahead and go into the tabbed view of these because somebody turned off tab mode and it's kind of messing me up a little bit. But we'll go ahead and just start on AT&T. Okay, I'm going to zoom in a little bit on this chart, and I do like the fact that I can just grab this slitter bar and just make it kind of a little bit more of a wider view. Okay, and we'll go ahead and get started. Okay, with this, I did talk about how this is a trend following system, so it's going to help us trade the trend and trade with the trend. I think it's critically important if we're going to do that we have a very, very clear idea of how we're going to evaluate what the trend is. Okay. And the way, when I start to talk about trends, when we're talking about the RMO model, we're going to talk about the primary trend or the long-term trend, the intermediate or the medium-term trend, and then the short-term trend. Okay, so primary being the biggest, intermediate, short-term. Okay, the first thing that we want to do is we want to evaluate the primary or the long-term trend. With that, we use the RMO oscillator right here. The way we read this, we keep it as simple as possible. It's either above zero, which is bullish, or it's below zero, which is bearish. Okay, all right, I just had a question that was a little bit weird. All right, the rule is simple. If we're above zero, we're bullish. If we're below zero, we're bearish. If we're bullish, we're allowed to go long, and we're not allowed to go short. Okay, allowed to meaning we're not going to go long just because we go from bearish to bullish, although that would have probably been a pretty good idea right here. Okay, allowed to meaning we're allowed to go long. Okay, there's 3 steps before we're going to get into the trade. For time, I'm going to go a little bit quicker. The second thing we want to do is we want to evaluate the short-term trend. Okay, and with the short-term trend, we're going to be looking at this. It's called swing trade number 2. It's this little pink indicator right here. Okay, we read it the same way. If it's up above zero, okay, right here it comes up above zero, we're allowed to go long. Okay, we're not allowed to go short. Okay. Now with the primary trend, you'll see right here, when it goes up above 0, you get a trend ribbon on the chart that says you are most bullish. Okay. With the secondary trend or the minor trend, when it goes up above 0, what you're going to notice is the bars start to go blue. Okay. So you don't have to necessarily look at the indicators. You can keep it simple. You can just look at the chart colors, but that's what you want to look for. Are we bullish long term? Yes. Are we bullish short term? Yes. We're allowed to go long. Okay. The third rule has to do with permissioning, or not permissioning, but really what actually gives us the signal to go long. Okay. And really, it has to do with the relationship between the short-term trend, which is swing trade 2, or the pink indicator, and the blue indicator here. Okay. And when we look at that, we're looking at the relationship. We're looking at it to identify a momentum movement. Okay. So for example, if we're looking at right here, you'll notice our pink trend is kind of coming down, and then it starts to go back up because price is starting to stabilize and go up. Okay. When it starts to go up enough where it crosses over that medium-term trend, right here is where you get a buy signal on the chart. Okay. If we're looking at this buy signal right here, okay, we're not going to go long because we're long-term bullish, but we're still short-term bearish. Okay. So it isn't until right here where we actually kind of go in and implement a trade. Okay. And obviously we could kind of play with this trade. I want to go back to kind of an earlier trade so I can talk about how to manage the trade. Okay. And I have to hurry because my time management wasn't great. But let's start right here. Okay. Right here, for all intents and purposes, is April 25th of last year. Okay. I'm going to zoom in on that one. Okay. And the reason I'm going back in time to kind of talk about this is I want to kind of talk to you about how you manage a trade once you're in it. Okay. All right. So maybe we ran a scan, or maybe we just was looking at AT&T. We came in, and on April 25th, we see that there's a buy signal here. Okay. What's our checklist? Okay. Are we long-term bullish when this buy signal comes in? Yes. Okay. So that we're allowed to buy based on the long-term bullishness or the fact that we're above 0 here. Okay. Short term, are we above 0? Not yet. Okay. Right here, short term, we're still bearish. So this particular bar, even though you have that change of momentum or that change of force, we're not allowed to buy yet. Okay. We're just allowed to watch. Okay. They have to match. All right. On the very next day, we go from bearish short term to bullish short term. We go up above 0, and this is the area where they match. Okay. So just to kind of be careful about the way I'm explaining this, if I'm looking at this on April 26th of 2024, I'm bullish long term, I'm bullish short term, and I do have that buy signal. Okay. I can structure a trade. Okay. Now, in terms of structuring a trade, Rahul is really, really specific. He wants another confirmation that this price is going to rise. I would recommend you do this too. What he's going to look at is he's going to look at, here's the bar I'm deciding to buy. Here's the bar before that. Of these two highs, this is a little bit higher. That's where I'm going to want it to go above in order for me to buy. So what I'm saying here is like all of the elements match up that we're looking for a trade right here on April 26th. But until it comes up above this high just a little bit, I'm not going to buy. Okay. The other thing that you want to do is you want to look for a stop. There's two ways that Rahul teaches about a stop. Either you look at the low of the current bar and the previous bar, and then in that case, this would be the lower low, and that would be your stop. Or he also says to look for a lower or a recent support area. Okay. The way I like to do it is I like to look for that recent support area. The way that I define that is using a fractal low or pivot low. A pivot low is a low surrounded by two higher lows. Okay. So if I'm looking back here, this is the day that we're deciding to buy. What I'm looking for is the most recent example of a low that was surrounded by two higher lows, which would be right here. You've got a low here. This is a higher low. This is a higher low. This is where I'm going to call that pivot low. That is where I'm going to put my stop loss. So I know if we come up above 1704 on AT&T, I'm going to go ahead and buy it. Okay. I'm gonna get it as close to that price as I can. If I buy it, I know I'm gonna exit it around 16.11. That gives me, and I usually make you answer this question, but I'm running out of time. So I don't have time for that fun stuff. That gives me an idea of where I'm gonna buy it. And unless it gaps really down hard, where I'm gonna get out, or it gives me an idea of where my stop loss is gonna be, okay? And that gives me a clean strategy to get in. I'm not trying to guess. I'm not getting married to AT&T because I think the future is in, you know, AT&T's business. What I'm doing is I'm saying, okay, I'm going to get in here. If I'm wrong, I'm going to get out here. This is my risk. Okay. The next day we get in up above here. Okay. It comes up above it. We would have entered in here. Of course, it pulls back down a little bit. Okay. And then it starts to go up again. Okay. And as long as it's going up, we're going to be okay, right? We're just kind of keep an eye on it. We have an open trade. I like to look at my open trades every day. Okay. Here we have that change of momentum or that change of force, except for this time it's to the downside. That's not uncommon. That happens all the time. The market usually doesn't go straight up. Usually goes up in steps. It'll take 2 steps front, 1 step down, 2 steps up, 1 step down, 4 steps down sometimes, right? But in this particular case, we come up here, we get that change of momentum or that change of shift warning. As long as we're bullish long-term and bullish short-term, we're gonna go ahead and hold on to that trade. And the very next day, we get that shift of momentum again, okay? So now it's coming back up above here. If we hadn't bought here, we could buy. But when we have this shift of momentum and we're already in a trade, there's 2 things that you can do. One is optional, you could buy more. 2, the other thing that you want to do is we want to reset your stop, okay? And I use the same method. If I'm looking to kind of look at the stop right here was that pivot low. You've got your low surrounded by 2 higher lows right here. And in that case, I'd be moving my stop right about to where I bought it at, okay? Price goes up a little bit more. Here you have that shift of momentum, but you're still bullish long-term, you're still bullish short-term. And it comes down and bottoms out, and we go up again. And that means we move our stop again. This isn't intrinsically complicated. It's not hard. It's not particularly sexy. And nor should your trading be that exciting. I don't think so anyway. Okay, what we're gonna do is we're gonna kind of follow the price movement. Here we get another direction to buy. Here we're going to put in a thing and we'll stop out here. If you stop out and the stock keeps going up, one of the biggest things I've learned in trading is if you're wrong, you can always buy back in, okay? And you probably would have bought in right about here where it's breaking out in that range again, okay? Very, very simple, very straightforward, very good strategy. One of the first ones I traded my own money with. There's some very, very detailed explanations of how to use this on our YouTube channel, but in a nutshell, that's it. Now, the one thing I will point out, because I am running out of time, I want to just kind of look at here we've been pretty much bullish long-term on AT&T since about where we started right here back in April. During that time frame, the prices went from 17 to about 27. And I would say just even the fact that we're not willing to take shorts while the stock is going up like that is going to put our odds in our favor. So let's take a quick look at CLF, okay? I'm going to kind of just narrow it down a little bit. CLF doesn't look like it may have performed super well, okay? In fact, I'd say it's a little bit sideways. And I did say it doesn't work on everything, right? But here you have a really good persistent downtrend. It's been bearish that whole time. It's been a little bit choppier lately. Looks like we might be entering into a bullish phase. There you go. Okay. GE, obviously, with GE, we've had some scenarios where GE has just run. And GE was one of my favorite stocks last year. But if you have something where you're just trading in the general direction of the trend, you're not taking counter trend approaches, my argument is that that would be helpful in terms of helping you put the odds in your favor. And if you can do that and manage your money effectively, those are going to be extremely helpful in helping you trade more successfully. So let me kind of get back in here. there are a bunch of stuff that I'm going to go through quickly that we're not going to really talk too much about, simply due to time. But one of the things I want to reiterate about Metastock is something I use every day to trade. I would not trade without it. I wouldn't know how to start. That ability for me to go in and just kick out all the garbage, focus on the stocks that have an opportunity, has been hugely helpful for me. You know, the other things that we really didn't talk too much about, but I think are really helpful is if you're learning about technical analysis, wouldn't it be cool if you had like the ability, like let's say you wanted to learn about something. We've talked about the expert commentary. There's about 300 different methodologies that are in the program. They're put together, they're ready to use. And you can go in there, like for example, there's a one that's built around candlesticks. It'll say this is a bullish engulfing. This is what it means. This is what it is on a chart. One of the core questions I'd always ask traders are, what are you looking to improve in your trading? Yeah. And a lot of times people would say, I'm looking to find better stocks. Scanning is perfect for that. I'm looking to be more educated. Well, the expert advisor and the scanning is really good for that. Another answer we get all the time is, well, I want to be able to understand what strategies work in the market. We didn't talk about it yet. We're going to talk a little bit more about it. I think Kelly's going to cover it tomorrow. But with our ability to go in and test trading ideas for you and help you understand, okay, on this particular methodology, much like Ray was doing earlier, this is how well it works. Here's what the drawdowns look like, all that kind of stuff. It helps you kind of not only understand what systems are working better, but then help you understand them with the commentary and then implement them. If you find something you really like, you can scan for it. And I think it's those kind of collection of tools that are the reason it's been rated #1 in its price category for 32 years in a row. Let me talk a little bit about how it costs. We've got a special offer. We've got 2 versions of Metastock. We've got a full real-time version. It's $265 a month. It includes a Zenith real-time service, which offers all kinds of news and broad market analysis. And it's an institutional quality news resource for you. It's $265 a month. That includes that news service. It also includes everything we kind of talked about today. There might be some exchange fees if you want to get full real time, and we can kind of go through that with you. The offer, and then we also have our Metastock DC. With Metastock DC, it's not full real time. It looks at daily charts. Those daily charts will stream all day. You can run scans during the market. It's super cool. And that's something that we just added for free. If you've been using Metastock and you haven't gotten that update, you should get it because it does allow you to go in and run a scan at like 15 minutes before the market closes and see what's available or see what your charts are doing during the day. And it's only $74.95 per month. And what we're going to do as part of our offer today is if you buy a month, we will give you the second and the third month for free. Okay, so it's about that would be about $25 a month to try the software that's been rated #1 in its price category for 32 years straight. Okay, we've seen a lot of software come in and go, and I could do a whole series. I've actually have a number of things that are, here's some other things you didn't know about Metastock. The thing I'll tell you about Metastock is it's a software that grows with you. It isn't like a lot of the softwares where they started making them a couple years ago. You're going to quickly grow out of it. The more you kind of grow as a trader and understand trading, the more Metastock can be helpful for you. It's not something that you're like, oh, I can't do that. So what we're going to do, buy 1, get 2 free. That's not all we're going to do. We're going to give you data for whatever region that you want. We're going to sit down with you. We're going to invest in you. We're going to spend some time with you. We'll sit you down with one of our support reps. They're going to do what is called a white glove installation. They'll walk you through how to use the software, how to install it, if you need help with that. They're going to kind of help you with it. They do a really, really good job with it. And then we're also going to give you a training booklet. It's a PDF, as well as a training series that you can go through and really kind of start to take advantage of the Metastock tools. Okay, and again, that's all for $25 a month. $75 a month. We give you 2 free months at the end of your first month. Basically breaks it down to $25 a month. And if at the end of 3 months, if you've played with Metastock and you just want to cancel, there's no commitment to keep going. But I hope that it's helpful for you like it is for me. I hope you're one of our customers that have been with us for decades, that keep voting for us year after year after year. Because if it's just $75 and it helps you find a better trade, it should pay for itself. If you want to get started, give us a call, 800-882-3040, metastock.com/sales-chat, metastock.com/conf-promo. So there we go. Can you check? Oh, Yogs, I don't have any more time to check the hymns. But if you send us a chart, if you send get in touch with our sales chat, metastock.com/sales-chat, they'll send you any chart you want. Let's see. Dominic said he was having a hard time viewing Vince's presentation. Dominic, thank you for that feedback. Appreciate it. All right, very cool. Okay. All right, give it a go. There's a reason it's been rated #1. It's such a cheap expense to try it. And again, the idea is it should help pay for itself. And 800-882-3040, metastock.com/sales-chat, metastock.com/conf-promo. So there you go. You can go ahead and kind of, let's see. If you haven't yet, join the Traders Forum, www.thetradersforum.com. And there's also some information for us. Gregory, let's give away a prize. Oh my goodness, I actually came in under time. Woo! I guess I could have spent a little bit more time. Are you there, Greg?
Hey, yeah, can you not hear me?
I can hear you great, yeah.
Okay.
Let me go to the prize list here. Ooh,
okay.
Ooh, this is a good one. So Sunny Harris, you know who Sunny is? She did Sunny Bands.
Sunny Harris, yes, of course I know Sunny.
She's only given away 2 of these prizes, but she's giving away a free Zoom session and mentoring for free. I can understand why she only wants to do 2. That sounds like it would take some time. Where are you going? Come back here, Greg.
My studio dog, Charlie, my studio Metastock mascot, decided she wanted to bark at me. I wasn't sure if that was coming up over the mic, so I thought I'd just
I didn't hear it.
Give her some attention.
All right. So what I need from you,
yes,
is to pet Charlie for luck. All
right.
Now give me a number between 1 and 6369.
1 and 6369. That's a lot of number. There can't be that many people that registered, really. How about 4640? 4640.
Okay. 4640. That is also in the U.S. We have not gone international yet. It's going to happen.
It will.
Dino V, also with the Gmail address. We haven't gone non-Gmail yet either. So
well, Gmail is a very large portion of our database.
You would know. You would know.
Google is slowly taking over the world.
All right, let me go ahead and just make a note of that. Okay.
By the way, great job. And your camera did randomly go off for about 10 seconds during your close. I don't know why.
That was for suspense. No, I didn't do it on purpose.
Oh, that just FYI.
All right, thank you.
Okay, see you later.
Okay.
Thank
you for the assist. All right. Okay, right on time too. Do you want to remind you of Metastock? I might have mentioned it. This slide's wrong. 32 years. Best software in its price category. Can help you scan markets, test ideas, forecast probable price movements. Starts at $75 a month. You can get 3 months. Metastock.com/conf-promo. Give it a try. I wouldn't trade without it. Our next guest is John Thomas. John, I love to bring on. He's been a guest of Metastock for a number of years. I kind of like his what I'm going to call a very unique take on the market. Has a great background that he's going to talk to you a little bit about, and he always does a great job. I always take notes. I've got a pen right here and a piece of paper right here. So I'm ready. Are you? I was like, throw it out.
Jeff, can you hear me?
I can hear you, John.
I just had to download GoDaddy again because I got a new computer.
Oh, okay. Here, let me
So
make
I'm
you
following in the great Jeff Gibby. How humbling.
yeah.
That's
I
like
don't
standing
have
in the
a
rain shadow of
response.
Mount McKinley.
I'm sorry, what?
That's like standing in the rain shadow of Mount McKinley.
Okay. All right. I don't have a real good. I actually wanted to just warm them up for you. You're going to do a better job than I did.
Well, I'm not so sure
I was
about
an opener.
that. Okay, since I've just downloaded GoDaddy, there may be a few tricks we have to do here to get this working.
Okay.
For a start, how do I share my screen?
I should have just sent you a request to share your screen. I'm going to go ahead and make me the presenter again, though.
Okay.
And then that way I can also then make you the presenter again. Now it should say you want to share your screen.
Okay, I'm getting, would like to capture my computer screenshot. Okay, open, says open system settings. I have to do a green light on GoDaddy, and I have to put my fingerprint in. How about that?
We'll see. It usually takes a couple of seconds, but that sounds like you did the right things.
Yeah, when you download a software, it can always get tricky.
Yeah. Let's see. I'm going to take it again. Okay, I'm going to send it back to you again.
Okay, I got a message here. Open system preferences. Go to meeting version 10.2.0 may not be able to record this content of
That's
your
okay.
screen. So later?
Yeah, it's okay. We're recording it on our end.
Yeah. Okay, now where are we? I see you bright and clear, but I don't have an option to share screen yet.
All right, let me try this again. Okay. Okay, did it tell you? Do you want to share your screen?
Telling me to open system preferences.
Okay.
Well, let's close that.
Have you already sent? You're on an Apple, right?
Yeah.
Okay. And did you set the system preferences?
I did.
Okay.
I enabled GoDaddy, but still don't see any option to share screens.
Okay. Do you see a button that says sharing?
No, I don't even see that.
All right. Let's see. Let's try this real quick. Let's see if I can get, well.
Okay, access to the camera. Oh, we don't want to give you access to my camera.
Okay, no worries.
No.
Okay. It should pop up with a message.
No,
it should say, you want to share your screen.
Yeah. Still nothing.
All right. I'm going to have you, I think probably what I'm going to have you do is rejoin. I just don't think it's going to, now that it's got permission, I think you'll have a better thing.
Where is the share screen command on the screen? Give me a hint on where to look.
You should see File Options View Help up in the upper left. And then you should see a sharing option right below that.
Well, yeah, no file options.
Okay. Ooh. Oops. I just closed my okay. Give me just a second here, John. Okay. I'm going to share my screen so I can kind of show you exactly what I want you to see. Do you see on your console, do you see something that looks like this?
Yeah, I did.
Okay. You see where it says sharing? There's a little bit of.
Okay, there are file options.
Uh-huh.
So how do I get that back up?
I don't know.
Here, wait a minute. File.
But what you're looking for is this thing that says sharing right here.
Yeah,
Jeff,
I know.
if I can interject, he might have gotten out of GoToWebinar and it being the desktop. So he has to go to the bottom and select GoToWebinar from the apps.
No, I see the control panel up here on the right.
Oh, okay.
Okay. So you, right under, you should see this sharing option, and you can click on the triangle right here.
Click on where?
The little triangle right by where I'm pointing.
Triangle, yeah. Sharing.
Mm-hmm.
Um,
Now I had to send this back to you.
on. I see show. Yeah, it keeps driving me back to system preferences. So let me turn that off. Stop showing screen is grayed out. Give me keyboard and mouse. Change presenter.
Okay, I just made you the presenter. That should ungray out this show screen option.
It didn't.
Okay. Did you get a pop-up that said, do you want to share your screen?
Nope.
Okay.
Make Jeff Gibby the presenter. I'll just say okay.
Yeah, that worked for me. I got a pop-up that said, do I want to show my screen?
Yeah, I'm not getting that pop-up at all.
I just sent it back to you. And I assume it's not giving you that pop-up either.
Well, wait, let me pull down some of these screens. Maybe it's hiding under something. Sometimes it does that.
It should also light up that show screen option.
It says stop showing screen, but that's grayed out.
Mm-hmm. Is the play button next to it not grayed out?
No, that's grayed out too.
Okay. See, I think you might have with Apple. You had to go in and set the permission, and you've done that. But
Yeah.
I think you might have to rejoin the room. So I think maybe what we might have you do.
Okay, I'll just come back. I'll go out and come back in.
Right. Okay. See you in a second. Hopefully that works. Hey, Greg, you want a joke?
Yeah, and I was going to suggest remind John not to.
He's on his way back. Yeah.
Okay, yeah, just make sure not to close out the session because that would make.
Oh yeah.
Not that that's ever happened before around here.
Never happened. It's fun.
I've been trying to Google a Apple version of GoToWebinar to see if I can maybe see what he's seeing or what might be the problem, but I'm not having much success with that. So
yeah, I think bringing him back in will help. He's coming back in right now.
I hope so.
So, Greg,
Yes, sir.
What did one nut say to the other nut that he was trying to chase?
Okay, I see two screens up here. How do I join the party?
Here, let me make you the
The
presenter.
only command that's out active is change presenter.
Okay. It should have asked you.
Show my screen. Finally got it.
That's okay.
Hooray!
Did you want to answer the joke?
Good
though?
job, John.
Yeah.
Oh, yep. You have to finish the joke though. You can't leave us hanging.
Yeah.
So
So,
I got to
John,
find my PowerPoint.
okay. Well, we are in, and I can see your screen, so that's a good thing. So
We're making
one-
progress.
You're getting there.
yeah. The joke again was, what did one nut say to the other? It was chasing it.
You're cracking me up. I don't know.
Okay, what do you see now?
I'm gonna catch you. And I can see your.
We can see your screen now, John, in the presentation mode. I think you're finally there.
Yeah,
Congratulations.
good to go.
And
Well, that was
I'll step
good.
away and break a leg to both of you.
Thanks, Greg.
Right.
All right, John, I'm going to go ahead and get
everyone.
away. Your turn.
Yeah, sorry for the technical delays. They launched a ton of new upgrades the beginning of this year. I'm still trying to catch up with them. So this is John Thomas, the Mad Hedge Fund Trader, and I'm going to teach you how to win from the next market crash. And I am now broadcasting from Incline Village in Nevada. Here's the highlights. A 5-year bull market is coming to an end. Economic growth will slow in 2020-25, and the risks are rising. Inflation is about to rear up its ugly head once again. Interest rate cuts are over, and the next Fed move may be an interest rate rise. Stock valuations are at a 26-year high, and on some parameters, they are at 100-year highs, and uncertainty is exploding. A toxic combination. We may have a few more months of the bull left. After that, look out below. Even bear markets can produce winners, and let Mad Hedge Fund Traders show you where to find them. Of course, we had the DeepSeek shock. Suddenly, the Chinese came up with a product that did AI much cheaper and faster than anyone else, and it was free. Of course, this didn't help NVIDIA, which was selling its chips at $65,000 a piece. So we've gotten through that now after a few people like ourselves tested the actual DeepSeek program, and there's more bark than bite. So take out your pen and paper to take notes. What I'm about to tell you will blow you away and change your life, for I am in the early retirement business. Your early retirement. Learn what to buy, when to buy it, and why. How would you like to earn 350% on Vertex Pharmaceutical in just 1 month? 394% with Palo Alto Networks, 412% with JP Morgan, 421% with Berkshire Hathaway, and 811% with NVIDIA. Of course, these stocks didn't go anywhere near that much up, but there are certain tricks you can do to greatly increase your leverage in rising markets. So why listen to me? Well, I have 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 17 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who's still working, and if you ever want to ride in a World War II fighter plane, I'm your guy. So the election had consequences, as we are constantly reminded. It means we'll get an earlier but higher stock market top, then an earlier recession. The market will start discounting that 1 to 3 years in advance. Earlier but lower stock market crash, more secular losers than winners, higher inflation, higher interest rates, much higher national debt, less regulation, especially on financials, full self-driving cars, and crypto. No environmental protection, extreme labor shortages at the low end, which are especially going to hit agriculture, restaurants, and construction, and punitive import duties, which we hear about almost every day. So these are the winners and losers on a sector basis. Winners of the new administration are energy, financials, banks and brokers, domestic manufacturing, crypto, and Tesla. Losers are all interest rate plays, all bonds, housing, real estate, construction, importers, precious metals, U.S. automakers, pharmaceuticals, agriculture, restaurants, cruise lines, and retailers. And of course, the list of losers keep increasing every day as these special measures are announced. So another reason to listen to me, an average annualized return for 17 years now of 50.03% versus 26% for the S&P 500. And if you don't believe me, just listen to one of my customers and see what he had to say.
Hi, my name is Wilson, and I've been with Matt Hedge Fund Trader and John Thomas since 2019. I caught the phenomenal returns in 2019 and 2020, somewhere in the order of the 80–90% returns on both of those years. I caught all of those trades, NVIDIA, the TLT, the Teslas, and so many more. And then in 2021, I started trading in some additional accounts, and I have caught almost all of those trades as well, and have been getting almost the entire returns that John has received, and it's been just fantastic.
All right, well, thank you very much, Wilson. And let's see exactly what Wilson did. He bought the Jan 17, let's go back up. He bought the January 2025 call spread NVIDIA, made 482%. He bought NVIDIA again, made 817%. Berkshire Hathaway made 421%. JP Morgan, he bought 412%. Palo Alto Networks, he made 394%. Vertex Pharmaceutical, he made 350. Silver, he made 113%. And JP Morgan, again, he made 87%. You can do every one of these trades if you follow my trade alerts. Of course, our secret weapon is the market timing index, which this morning was at 35. It's drifting down, and or not drifting, it's plunging down into buy territory. This is an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. It took a team of mathematicians 1,000 hours of calculations to come up with this algorithm. So why do you need an algorithm? Well, why use a toolbox missing its most important tools? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs fast, runs real time, and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. This is 3 years of our algorithm signals, and you can see we get a lot of buys at market bottoms, sells at market tops, buy, sell, buy, sell. It's like having a money-making machine. And I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. You can see I was walking on the Miami waterfront a few weeks ago, and I found this super yacht, and look what it's called, Algorithm. This is the last 12 months of our market timing index indicators. If you subscribe to our service, you'll get maybe 5 to 10 updates a day on where we are on the market timing index, depending on how many trade alerts we send out. And right now we're kind of rushing towards 30 level in the index, and the lowest we've seen in the last year, well, we got a 20 reading last summer for just one day, and of course we went 100% invested back then. So these big dips is where you pour the money in, increase leverage, and that's where the big money is made in the stock market. So why do we cover all asset classes? Sounds like a lot of work to me, which it is. Information about one asset class sheds light on all the others. For example, knowing what the bond market is going to do, and therefore interest rates, is incredibly useful advantage when picking stocks. Some asset classes will be doing great while others are dead in the water. It will point you to where to trade the winners and avoid the losers. Give yourself every advantage. Know what is happening all the time, everywhere. So there is a method to my madness. All of the 2025 gains have been lost so far. So far, the Total return on the S&P 500 is 1 or 2% or close to zero. Market has gone from a low risk to a high risk one practically overnight, with the lead names like NVIDIA and Tesla taking the biggest hits. At the lows, Tesla was down 34% from its December high. All interest rate plays are dead in the water, like home builders, bonds, and REITs. Deregulation plays will continue to be bought, including banks, brokers, and money managers. US dollar finally is taking a breather on falling interest rates. Big technology stocks got crushed on the DeepSeek and trade wars and have yet to recover. Energy is selling off on DeepSeek as well, as huge amounts of power will be no longer needed, but that is not true. Buy financials is the only safe sector to invest in this year. So what happens when the euphoria wells off? It's time for you to become a bear market expert. Of course, the favorite among the hedge fund industry is the SDS. This is a 2x short S&P 500. And as you see here, this chart goes up to the end of last year. And whenever the markets have big sell-offs, you get big rises in the SDS. So last July, when we had our 10% drop in the S&P 500, what did we get in SDS? A 20% rally. Here it is. The proof is in the pudding. Tracking error is almost perfect. So, of course, for the rest of the year, the market went up, SDS went down. I got a feeling we're going to start seeing a lot more rallies in the SDS. And if 2x leverage isn't good enough for you, how about 3x leverage? That's what the SPXU gives you, and you can see you get bigger rallies on the down markets. Here it was 30% in July, but then bigger sell-offs when the stock market recovers. You can also buy put options. For example, if you bought the Apple June 2025 240 puts for $11, you collect $100 for each dollar that Apple falls below 229, which is the break-even point, or $1,000 for each $10 move in Apple. Better yet, and lower risk, is selling call options against Apple. And in this example, if you hold the June 2025 260 calls for $10, you collect $1,000 for each option as long as the stock stays below 260. And in falling markets, selling upside calls is a great way to increase your profits and lower your cost basis. Buying volatility, also a great play, and we'll go back to the July example. Here, the VIX, the volatility index, went up 5 times from $12 up to 55. But you have to move fast because these VIX spikes are very brief. Usually they only last a day or so. And then after that, the professionals step in there and they start shorting VIX like crazy, taking it all the way back to its long-term support levels. We got another one of those again in December when we had nearly a 10% sell-off. It turns out that IPOs do much worse in falling markets than they do in rising markets. So another way to do this is you short the IPO ETF, and you can see last July we had a massive sell-off in that, about 20%, and then as soon as the market recovered, we had an immediate rally in the IPO ETF. There is also momentum. Many traders have noticed that over the last week, momentum has completely died. When momentum dies, when markets go down. And let's look at our July example. You can see we got about a 15% drop in the MTUM all the way down to here, and then it bounced back with the rally. So you want to be short momentum in falling markets, and some of the lead momentum stocks like Palantir have dropped 30% in just 3 days. So there's your big tell right there. Also, you can sell short beta. And beta also collapses in bear markets. Things tend to fall and then not move for a long time. And you see exactly that happening here in July. You had about a 20% drop in the beta index and then a big bounce in the recovery. Also, we have a bearish hedge funds, and one of those is the HDGE. This is a permanently short hedge fund, so you can rely on them for the market timing. And again, while we had the bull market, the HDGE was going down continuously, and it bottomed in July, and that is another great thing to be long in bear markets. So when all else fails, you don't want to try any fancy strategies. You don't want to do options. You just want to have a position you can sleep with at night. You buy 90-day US Treasury bills. And I'll give you a hint. Warren Buffett owns $300 billion worth of these things. They're now yielding 4.2%. Not bad to be paid to go away and not trade at all. These have a government guaranteed principal, endless liquidity. They trade like water. There are billions a day that trade, 100% collateral value for margin. So you can put all your money into treasury bills and then pretty much buy any stock or option you want. You just are buying on margin. And the differential between the 90-day T-bill rate and the margin rate is generally 1 to 1.5%. So it's really only costing you 1% a year to trade. You can lock in a guaranteed income while the market is dead and doing nothing. It can be sold at any time, and you get paid interest all the way up until the day you own it. You don't have to hang on for a coupon day or anything like that. It will survive any bull market. This is the ultimate safe security. Ask your broker how to buy them. There's no easy way to do it with an online trading platform. And you can see the yields have been falling perfectly in line with all the Fed interest rate cuts that we got last year starting in July. And we're now been sitting on the bottom here at 4.2%. So stocks have a new case of jitters. Tech stocks got destroyed on the rapidly deteriorating economic outlook. Biggest degrossing in 2 years has started with hedge funds cutting back on the total size of their positions, both the long and the shorts. That usually means volatility is increasing. Nvidia will tell all with their earnings report on Wednesday. Morgan Stanley is warning customers to cut back exposure, as is Goldman Sachs. The cruise business got slaughtered last week on warnings of new taxes. The cruise lines, and Carnival has 100 ships alone, picking up American money and customers and not paying any U.S. taxes on that. The new administration will figure out a new way to get that money. Defense stocks getting completely destroyed in the prospect of a 50% cut in defense spending. EV and hybrid sales reach an all-time high in the U.S. at 20% of vehicle sales, but all EV subsidies are about to disappear. Tesla currently is adrift with no leader. The stock has dropped 35% in 2 months. So who are the beneficiaries of deregulation? Well, deregulation cuts costs, increases profits, opens up new markets, grows the industry overall, increases innovation, drives stock prices higher. That's the last one I especially love. However, deregulation has its costs. It increases misrepresentations and fraud. It increases theft, increases bankruptcies. Consumers are left holding the bag, and don't forget to sit down when the music stops playing because it's every man for himself. And if you don't believe me, look how unregulated stocks behaved in the 08-09 crash. A lot of them disappeared, never to return, like Bear Stearns and Lehman Brothers. So we love banks for the deregulation reason. JP Morgan is a big one. They're the crown jewel of the US banking sector, and today is a good place to get in. In fact, we just sent out a trade alert to buy JP Morgan. Citigroup, another big winner, still in a major uptrend. Berkshire Hathaway owns tons of banks, and it had a major move up this morning at the opening on their latest earnings report. Goldman Sachs is one of my favorites. Again, they'll be making money both on increased M&A business and on overall deregulation of their business. Of course, we've been buying this like crazy for the last 6 months. And Morgan Stanley, another big winner. Every time you see these blue boxes, that is when we got a buy signal from our Mad Hedge market timing algorithm. And of course, we buy every one of these dips. Buy here, we buy here, and buying today. BlackRock, a money manager, also does very well in rising markets. We're targeting $1,200 this year in BlackRock. And Interactive Brokers, stock has nearly doubled in 2 years off the explosion in options trading volume, which is their specialty. Second half of the barbell is technology plays. Technology always comebacks. AI innovation is still the leader and the business is growing exponentially. Makes a great counterweight to deregulation plays. We could spend all the next couple of years rotating back and forth between the two groups. NASDAQ, of course, a big winner here. We expect 25,000 in NASDAQ by the end of the year, and we're looking to buy major dips here. And with current market conditions, you have the luxury of being able to wait for big dips and not hang on to the small dips. Tesla, we're looking to sell Tesla. We actually put on a couple of shorts since December. They've worked out very well. Basically the company is leaderless while sales are following. Not a good signal for investors, and they have no new products coming out in the near future, and sales of the Cybertruck, which I've driven, have been sluggish. So look for Tesla. I keep selling rallies in Tesla. Eventually we'll hit a bottom, then the stock rises to 600 next year in 2026. Microsoft, dead in the water for a year. I think the stock breaks out of that range and goes to new highs. By the way, these pictures to the right are World War II aircraft that I've flown in various air shows. This one is a B-17 bomber, and it is a lot of fun to fly. Meta, of course, had that 20 days a row remarkable run. It's selling off. We think it reaches a bottom at the 50-day moving average, which is right here, and then continues going up. And this is me in front of a B-24 Liberator bomber made by Ford Motors. Amazon, just had a big sell-off, looking to get in there. We've been long for ever since August. Had a buy signal here, and we see $300 a share by next year, and that is a B-26 bomber right there. NVIDIA, again, recently got hit hard. We want to get back in there after their earnings report. They often sell off on their earnings report, no matter how good they are, so there may be an entry point come up here. Of course, we've been long NVIDIA for 15 years, so we're quite happy buying dips all the way along there. We're looking for 180 sometime next year. That is a P-51 Mustang fighter, which is a fantastic plane to fly. And we have Alphabet here, looking to buy the dip. Looks like we're going to test the 200-day moving average, and that's an early generation P-51 Mustang here. You can tell from the square cockpit. Palo Alto Networks, of course, hacking never goes out of style, so all of the cybersecurity stocks are basically permanent buys for us. We've been in this about 10 years. We're looking for about $250 a share for this company, and that is a B-25 Mitchell bomber, the plane that's it's a 2-engine plane that did the raid on Tokyo. So bonds, let's talk about bonds for a bit. Bonds are toast. The deficit is the big election loser. National debt is about to explode from 35 trillion to 45 trillion. Interest payments on the national debt are the top 1 trillion per year, and will become the largest budget item. Government borrowing will become much more difficult than the last Trump administration when the national debt was only $20 trillion. All depends on inflation, which is likely to rise in response to increased spending, tax cuts, labor shortages, and trade wars. So the best case scenario for bonds is that they chop around current levels. The worst case is that the TLT drops all the way down to $79. So you want to avoid the TLT, junk bonds, REITs, and all other fixed income plays. This is what the TLT looks like now. It peaked out here right when the Fed started cutting interest rates, and it's struggling around here. We eventually see $82 for the TLT and then 79. And of course, here's the yield. We eventually see the yield on the 10-year Treasury reaching 5.5%. Foreign currencies, if you have high interest rates, that's great news for the dollar. Of course, the dollar's taking a vacation right now. It just had a 1-month drop in interest rates, so that's bad for the dollar. And we backed off from 488 to 440 on the 10-year Treasury yield, but we expect to go back up. Higher for longer interest rates is higher for longer US dollar. Don't sell the US and dollar until the next recession is on the horizon. Avoid all currency plays. So that includes the Australian dollar, the Japanese yen, the euro, and the British pound. All of them are sells probably right around here. Emerging market currencies, also a big sell. Energy, we're looking for a decline in oil prices this year. Drill baby drill translates into sell baby sell for the price of oil. Increased supply, lower prices. It's just pure simple math. DeepSeek also gave the industry a big hit with fears that power demands would decline. I don't believe that, but the market did for about 15 minutes. New AI programming only uses 1% of the existing chips. That's where the fear came from. The ban has been lifted on new natural gas facilities in 4 years, reversing the Biden-era climate initiative. Many analysts expect oversupplied oil market this year and demand growth slowing sharply in 2025 in the top consuming nations. And those are the US and China. EIA says it expects, EIA says it expects Brent crude oil prices to fall 8% down to 74 this year, and then further. $60 a barrel is in play. And this is just the beginning of a very long-term decline. This is a 20-year chart for the price of oil. One of the greatest double tops of all time is unfolding here. Our last top was at 120 in 2022. Since then, we've failed to break out of that range, and big oversupplies, I think, will eventually take us down to $10 a barrel when you add in the conversion of the US car fleet to electric vehicles. That means demand for 50% of the US oil supply is about to completely disappear. Of course, it may take 20 years to happen. Here's another energy play, Cameco, the world's largest uranium miner. They have also been slaughtered off those DeepSeek fears and is entering a very nice buy territory. We're looking for $100 a share in Cameco sometime this year. I'd probably be picking it up right now. Precious metals are enjoying a new leg off the back of falling interest rates. Opportunity cost of gold has suddenly fallen sharply. Central bank buying never stopped. And now silver is starting to play catch up. Gold is the favorite savings means by by Chinese individuals who don't trust their own currency, banks, or government. That's why the metals have outperformed the miners, and which is why the Chinese don't buy miners, they just buy the gold metal. And that's me at the Istanbul gold market doing some early Christmas shopping. So gold, after the initial election sell-off on fears of rising rates, we hit bottom at the end of the year and really been on a tear ever since. Goldman recently increased its target for gold for this year to 3,100, and that looks like a chip shot. So we're going to increase our long-term target for gold to $5,000. Barrick Gold coming off the bottom also. So is the Silver Trust. Nice rally there. And we see it eventually hitting $50 an ounce sometime this year. So the harsh truth is you really need my help to make money. The majority of individual traders lose money in the stock market. They lack the correct training and discipline to succeed. Most brokers, research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why do dead people do so well? They never sell. Not so bad when the index is going from 600 to 45,000, which it has done for the last 40 years. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10 times return on the great stocks, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. 87.93%, that is what we've done on the last 12 months. And you can see even the very sharp sell-off we got in July, we came back from almost immediately. You can see our biggest drawdown for the year here was only about 12%, and then we came roaring back. Richard made millions of dollars religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast, and occasionally he lets me fly them also. Greg turned $100,000 into $3 million solely on the basis of my trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, Tesla Powerwalls, and a Tesla Model 3, and still had enough money to send 3 kids to school. Guess which stock he made all the money in? It was Tesla. Back then, if you bought the stock, you got the car for free on your capital gains. Bob turned $500,000 into $27 million in just 2 years, and let's hear him talk about it.
This is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's Global Dispatch Service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it was 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
Okay, Bob, thank you. So what do we do about all this? Well, stocks, you want to buy the next really big dip, but sell rallies too. Bonds you want to avoid. Commodities stand aside. Energy stand aside. Currencies avoid. Precious metals avoid. We've just had a big run, but buy for the long term. So if you're not up 87% in the past 12 months as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. 50.07% is our 17-year average annualized return versus only 25% for the S&P 500. And we do this with half the volatility of the S&P 500. You notice that we tend to go up, sideways, up, and the S&P down here has these dramatic big sell-offs, which we miss because we, number one, have risk control positions, we offset longs and shorts, and we stop out of losers very quickly. You get those kind of returns, you get to do things other people can't do, like take the Queen Mary owner's suite from New York to England, and when you get to England, you can then take the Orient Express to Venice, although now you have to go to Paris to catch that train. Here's the very long view, and here's where the big money will be made. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That will create an economic boom that will last another decade starting in 2023. The last time we had an identical demographic setup to the current one was from 1982 to 2000. What did the market do? It went up 20 times in 18 years. Are you ready for a replay? If you count 2009 as the bottom, then our final target should be 120,000 by 2030. And if you think I'm crazy, we're already 2/3 of the way there at 40,000 right here. One more triple and we're at 120,000, and we have 5 more years to get there. Except this time it's different. We have the AI tech turbocharger, which greatly increases the profit opportunities for pretty much everybody in the economy. So who'll show you how to play the next 90,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top trade mentoring service in the industry, up 87% in a year. Follow my research and market beating trade alerts, and you will rake the profits in. We trade global equities, bonds, foreign exchange, currencies, commodities, and precious metals. This is a typical month for us. You can see we bought the S&P 500, 10 out of 11 trades made money. We made 16% on that, 8% on treasuries, 14% on the Russell, 12% on Amazon, 7% on Apple, and then we lost 21% on Biogen. We stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big hole, and after that, every trade for the month was profitable. So it's just a matter of time before barbell stocks break out to new all-time highs. Watch this space melt up going into the rest of 2025. Get ready to start bringing in those whoppers with Global Trading Dispatch as your guide. Here's how it works. Our algorithm spotted an imminent upside breakout in NVIDIA a year ago. So we sent out a buy signal, and this is what it looks like. Buy NVIDIA at 480 or best. That's a pre-split price. Opening trade, and to buy $10,000 worth of stock, you then needed to buy 21 shares. What happened? NVIDIA went up 45% in 22 trading days. So we sent out a sell signal to take profits, which almost no one else ever does. And this is what it looks like. Take profits. And on this particular trade, you made $4,515 on a $10,000 investment in just 22 trading days. So these are our Mad Hedge 10 baggers. We made 10 times return on Zoom, 10.6 on Lam Research. We made 25 times on Square. We made 40 times on Moderna, 70 times on NVIDIA, and on Tesla, we made 178 times our initial investment. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income, go from complete beginner to seasoned pro in weeks, learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime, supplement your retirement income with the satisfaction of booking winning trades by the hundreds. With your Mad Hedge Global Trading Dispatch, you get instant trade alerts, send out market sweet spots, about 200 a year, live bi-weekly strategy webinars like this one, special reports, invitations to strategy luncheons around the world, tons of educational videos, and access to a 17-year database. It's the one-stop shop. It's for individuals who want to understand what is happening with their retirement funds. It's for people who want to learn how to trade for a living. Get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford in-house research departments. Get in before the next melt-up begins. This is what you get. My global market comments in your inbox every morning, 5 days a week. You also get Mad Hedge hot tips, 5 most important things that happened today and what to do about them. This is what I'm not going to charge you for this service. I'm not going to charge $100,000. That's what I charge my high-end concierge customers, and they're happy to pay because I make them millions of dollars. And I'm not going to charge my concierge $12,000. That's what I charge my concierge customers. Here's what I'm not going to charge. I'm not going to charge you $3,500. That's the full price of what I'm offering you on my website. Creating this product cost me millions of dollars. With the best customer service in the industry running it cost me millions more. 6 months for just $997. That's a 71% discount to the website price. We only take 25 new subscribers at a time so we don't overwhelm the market with our trade alerts, so it's first come, first serve. Just click on the chat box on the right. That'll take you to a dedicated sales page to that's only available through today's webinar. Let me make the money for you. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just click on the chat box on the right. 6 months for just $997. Buy now and you will instantly receive a trade alert that you can execute right now. And today is a great entry point. Don't leave good money on the table. 90% of these trade alerts make money. And just to give you a tease, this is the chart for the trade alert I'm about to send you. What I'm not going to tell you now is whether it's a buy or a sell. For that, you have to subscribe to the service. I'll subscribe today. You also get my free video course, Options Trading for Beginners. That's a 12-chapter video course on everything you ever need to know about options, written for the basic beginner, for someone who's never done options in their life. So if you're going to work with me for the next 6 months, best to find out who I am. I grew up as the oldest of 7 children in a remote farm in Southern California, played Little League Baseball, was an Eagle Scout. Wasn't much to do in the old days, but hunting, so I picked up a job as a paper boy for the Los Angeles Herald Examiner. I found the stock pages, bought IBM at 20, sold at 30, suddenly found a far better way to make money than delivering newspapers. By the time I was 16, I earned enough money to go to Europe. By the age of 17, I had visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of research, where I learned how to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me to covering the stock market. And after 10 years of government service, all I got was this box of medals, which I trot out once a year on Veterans Day. As a foreign correspondent, I covered the Cultural Revolution in China, was the first American reporter to visit North Korea, and covered Asia all the way out to India. I figured out very quickly you didn't have to be that smart to make money in the stock market, so I got into the industry joining Morgan Stanley. And that is my original ID card from 1983. And unfortunately, the guy who signed my ID card died in 9/11. During Desert Storm, I flew planes and also commanded a tank brigade for the US Marine Corps. Our score, Iraqis lost 5,000 tanks, we lost 1. That's a great score. I love delivering performance. As I rapidly became the top hedge fund manager of the 1990s, originally bringing in a 1,000% return in a decade. Then the money really started to pour in. I now spend my free time delivering winning trade alerts, but I now do it from my 3 mansions in Zermatt, Switzerland, Lake Tahoe, and San Francisco. And the free time I have left, I fly vintage aircraft. If you've probably figured out, if you see an old plane flying loops over San Francisco or London, it's probably me. So when you make millions of dollars for your clients, you get a lot of pretty interesting invitations, $5,000 cases of wine, dates with movie stars, lunches on super yachts. So it's in that spirit that I traveled to the famed World War II fighter station in Biggin Hill in England to meet Mad Hedge concierge customer Peter Monk. Peter was a poorly paid pilot for Ryanair when he signed up for my global trading dispatch. After doubling his money and in his first year, Peter upgraded to my concierge service. Then the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, a Spitfire Mark IX, in his backyard, begging and borrowing and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which today are worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day when we took off and headed for the English Channel. Even though the plane was 82 years old, we managed to brisk 250 miles per hour over the English countryside. Spitfire could outmaneuver any plane the German Air Force threw up against it. This particular plane is credited with shooting down 2 Messerschmitts, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover between 2 big fluffy cumulus clouds, and I commenced a full-on aerobatic flight test. Pilots always want to see what I can do with these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wing overs, careful never to exceed 1 G of limitation, or the wings might fall off. Spitfires can dive like crazy. We dropped from over 8,000 feet to 2,000 feet in seconds. Then it was back to Biggin Hill for a perfect 3-point landing and a pint of beer. Let me make millions of dollars for you as well, as I have done for thousands of other followers over the last 17 years. I look forward to working with all of you. And until then, I'm going to thank the people who have already subscribed. I see we've had a Malcolm from Tasmania come in Australia. Thank you very much, Malcolm. Promise to work hard for your money. And we've had Dan come in from Wasaga Beach, Ontario. Stephen from Nair Warren in Australia. Paul from Wesley Chapel in Florida. Russell from London, England. We've had a Richard from Grand Haven, Michigan. So it looks like we're going to sell out our 25 in the next few minutes. If you're hemming and hawing and sitting on the fence, go ahead and click this link. That'll take you to the dedicated sales page. And I look forward to working with all of you. Okay, let me just take a look here, see, look at our store, and yeah, they're coming in. We just got another one. Actually, we just got a bunch. We've had a new subscriber from Weezak from Scotch Plains, New Jersey. Thank you very much, Rick. Look in your inbox for that trade alert. If it's not there, look in your spam folder. If you're a brand new subscriber, sometimes that's where they go. And we have another order here from Vincent in Armagh, Ireland. Thank you very much, Vincent. Please get that trade alert and get it into the market. There's an easy couple $1,000s there for you to make if you just act quickly. Elizabeth in Amherst, Maine has just subscribed. Thank you very much, Elizabeth. And what else is going on here? All right, well, I see that my time is just about up. So thank you, Jeff, for inviting me to today's presentation, and look forward to hearing from you.
Yeah, thank you. We do have one question from Kamal,
Yeah,
if you don't mind.
go ahead.
He's like, John, I'm a little bit confused. Are you bearish now for the next 4 to 5 months and then bullish after July?
Pretty much. It depends on how much the news flow is happening. This is what you need to keep in mind. We have price earnings multiples at an all-time high, the market at an all-time high, and uncertainty at an all-time high. That is a terrible combination and will only resolve with lower stock prices. The question is this a 10% correction, a 20% correction, or a 50% correction? We shall see. It all depends on how all of these measures unrolled by the government affect the real economy. So yes, I am bearish for now. I think eventually the technology AI story comes back and we enter another leg of a bull market. But until then, we have to digest a brand new form of government which has never been tried before. Usually that's terrible for stock markets. People would rather sell first and ask questions later.
Rich said he just signed up. He's looking forward to it.
Great. Well, look forward to having you on board. And again, check your inbox to make sure you have that trade alert. And now is an outstanding entry point for that particular stock, probably the best in 6 months.
All right. Thank you very much, John. Appreciate it.
All right. You have a great week.
You too. All right. Very cool. Let me go ahead and do this. And we'll do this as well. Okay. Oh, sorry, Neil. Okay. I appreciate your question. Thanks for coming, Neil. All right. Very cool. Want to mention the Traders Forum, www.tradersforum. You can come learn about the markets, learn about technical analysis, chat with other traders. Great site. Check it out. Hope to see you there. All right. Of course, we are Metastock. 32 years in a row. I need to correct all these slides. Been rated #1 in the software. We've talked about scanning, testing, the patented forecaster. We haven't really talked too much about that, but it's also cool. The offer we're doing today is $75 a month. We'll get you 3 months of access. It's normally $75 a month. If you buy a month, we'll give you the 2nd and 3rd month for free. You can do that at metastock.com/conf promo. You can do that by giving us a call, 800-882-3040 if you're in the US or Canada, or metastock.com/sales chat. So with that being said, oh, Greg.
Yes, sir.
Let's do a prize. I'm ready. I just updated my list, so I have a brand new fresh list. So hopefully if you're watching this on YouTube, you registered already, because that way you have a chance to win. The number I need, we're gonna go ahead and give away this book. It's called Around the Horn.
Yes.
A Trader's Guide to Consistently Scoring in the Markets. It's by Dr. Adrian Mantz, who's going to be speaking a little bit later this week. And I'm going to mail it myself. Greg, what I need from you is a number between 1 and 6757.
All right. Around she goes. That would be 148.
Huh.
Google random generators shooting low today.
Or I'd say really low. And we still haven't exited the US.
Well, but that does give an advantage to those who are enrolled. Well, a fair and random advantage to those who are enrolled.
I like how you backed off there.
Well,
Yes, he is using the Google random number generator too. So let's see. Here we go. Okay. Thank you for the assist.
You're absolutely welcome. I'm right here if you need me.
Okay. All right. Our next presenter is 2. We've got 2 presenters coming up. We've got Brian Latta and Jake Bernstein. Brian has really taken some ideas that he learned from Jake Bernstein. He's been coaching traders for a number of years, and he's really made them elegant and approachable. Jake, let's just first, well, he's actually been releasing a newsletter since 1972, is publishing nonstop since 1972, 2 years before I was born. Also, he placed his first trade in the 1960s. And a good friend of ours, Jake, I have nothing but respect for Jake and Brian, and we're going to go ahead and bring them on. Jake, how you doing?
I'm doing pretty good. Thank you for introducing me. So,
Yeah, of course. It's literally my job.
Appreciate that. Appreciate the opportunity to work with Metcalf. But pardon the voice. I've got some voice issues going on. So I'm going to let Brian do most of this. I'm very happy to be associated with Brian and with Metcalf. You guys are tops, #1 in the field. You guys do a great job programming all my ideas and making them work. And what we don't do is we don't do the news. We don't do fundamentals. We don't fly airplanes. We go strictly purely technical analysis, as Brian and I will show you. So I'm going to save my voice for a little bit later. I have been trading since the summer of 1967. If you don't know who I am, I've written 45 books, wrote the 5 best books on day trading. I'm not primarily a day trader, but I will show you some day trades and how to do it with our indicator expansion contraction. I'm going to turn it over back to you, Jeff, and then to Brian.
Okay. Brian, I can see your screen, but I don't think you have the right one. I can see connected to GoToWebinar. There we go. Perfect.
And I should have it on now.
Yep, that is correct. I can see it, and it looks much more like probably what you mean to be showing us.
Yes, it was. The other one was just my other screen, and that's one of the things about the having multiple monitors. I had a presentation up on another screen.
Cool. Yeah. Okay. I can see you. I can hear you, and I'm going to get out of the way. Your turn.
Fantastic. Thank you very much. And Jake, it's good to hear your voice again. I know you're a bit voice challenged, but anything that you've got to add in, just jump in anytime. Your comments are always appreciated. Since 2014, I still learn new things listening to you when you speak. So again, I do appreciate that and the opportunity to speak here. For those that are not familiar with expansion contraction, it's not a brand new indicator, but it's relatively new over the last few years, and it's been developed using Jake's moving average channel strategy. So on that, Jake, do you have some comments?
Yeah, we're all about specifics. It's purely technical. No interpretation. Everything is crystal clear. Keep it simple and you make money. If you don't keep it simple, you won't make money. It's that simple to me. So let's go ahead, Brian, and run the show. I'll barge in if I have to.
Great, thanks a lot, Jake. So I got to show the disclaimers because I will be showing some results a little bit later. Again, just want to be really clear with everybody that having traded for a certain number of years, having developed systems, I have seen out of sample type results. But that being said, I do determine that I've got to be a system trader. Personally, trading with discretion has always been a bit problematic for me. And so one of the reasons for developing an indicator like expansion contraction was to identify clear setups to get in, clear targets to shoot for, stop loss targets also. So ideally, right, we have taken a look at the back testing, which has been done, basically using a 15-year back test and seeing what the results are for there to be consistently positive return on a majority of the stocks, not on absolutely everything, but there will be some charts a little bit later for you to see how that works. Basically, you've got to have 100% objective rules, and expansion contraction is not only 100% objective, and we're going to give you the rules here for free today, as this is really for traders, say, rather than investors. Although, could you use expansion contraction on maybe weekly or even monthly charts as an investor long-term and still have clear rules? Yes, you can. So, and of course, Jake and I both have different ways that we use expansion contraction. Jeff did a pretty good job earlier about saying great things about Jake. I will say out of all of Jake's services, at least the one I appreciate the most is seasonaltrader.com. And that's just due to the numbers that will locate trades to take with specific probabilities of reaching their targets, exactly when to get in, exactly when to get out of loss, were to take a profit on all of that. And so Jake's services has actually been used by many of the huge institutions globally all over the world. And he might want to have a comment about that.
Well, we do have many clients that are very successful traders. And remember, for me, everything is about the money and the clarity. If you have to think about it for too long, then you're going to make a mistake. So we have very clear rules. And Brian has done a beautiful job expressing those rules. So don't get confused by the colors. For me, it's really simple. The expansion contraction indicator is going to be either red or it's going to be green. If it's red, you're long. If it's red, you're short. I'm sorry. If it's red, you're short. If it's green, you're long. And Brian will show you more about that, and I'll show you some real trades as well.
Thanks for that, Jake. Yeah, the main thing is about trading on this one. So again, as we're running through this, a little bit of background about me. I didn't get started in trading till later in life, a little closer towards 50. But I did have some on-the-job experience in Silicon Valley and reliability assurance, and was really good at databases and spreadsheets. So ultimately, we implemented a statistical process control program that saved the company quite a bit of money, and I've been using that process to basically replicate what I've learned from Jake to create additional systems. Sorry, Jake, go ahead.
You don't fly a plane, do you?
I don't fly, well, not anymore. I did learn to fly when I was 16.
Oh, that'll help.
Pre-flight checklist, in-flight checklists, everything, a checklist, which is great. You're welcome on that. And definitely jump in anytime. I'm sure people want to hear your voice get back to normal again, because again, that 50 plus years of experience in trading is just invaluable. And then of course, all of the systems you've built are also shown to be consistently positive, and that's what got me into wanting to develop my own. But as a coach, these are the things I've heard more than anything. I'm sure you've had a chance to read this through a few times. The main thing as I get to the next part here is that ultimately, whatever it is you're doing, you do need to prove it to yourself, because it's more likely that at some point, if you don't know the numbers, you're more likely to change your rules, change your plan. Kind of just going to go to the shiny object syndrome. A lot of traders see something out there and go, oh, that's great. And unfortunately, they keep looking and never really settle in. So ultimately, it is all about the numbers. As I said, everything should be back tested and even forward traded, which this will talk. Now, in the past, I had posted a little bit of developing a trading strategy from ChatGPT. I did ask Grok just recently because of its updates. And as you can see, I've just bolded out a few of the things in here. I would say, just like most AI answers, it's somewhat right. It's a little bit wrong. But the main thing is the key points here, right? You do have to know when to get in, where to get out at a gain or a loss. Now, those are your rules for trading, but you definitely need to know what your goals are. Why are you trading? Is it day trading? Any one of Jake's positive outcome trading systems for day trading are in the books already, as well as end of day systems or even weekly systems looking for different objectives. So markets you're going to trade, Jake's specialties are futures and stocks, and my specialties are options as a spread trader and currencies. So when Jake and I do some coaching together, individuals do get quite a bit of not only thorough help from different markets, but one-on-one help there too. So I'm sure you've had, again, a chance to read through this. I don't like reading through the slides because you can read faster than I do that. We'll say what I see is people are not willing to keep journals of what they're doing, track the trade. So if you say, hey, what's your win to loss ratio? What's your profit to loss ratio? And other statistics that we use to measure, say, consistently positive outcome, then if they're not going to know that, there's going to be some doubt in there. Now, so I got it right in here on that. I did just run down to copy that whole again, but rebolded this statement here. The best traders adapt without chasing every shiny new idea. It was a little bit about what I was commenting on, the shiny object syndrome. However, adapting, ideally that's proven from the results of 100% objective system. So simple a computer could do it. and has been back tested. I've made rule improvements over the decades from the data, and then at least in, say, a smaller stop loss calculated from actual data, I already knew it was better, and it was 10% better, and immediately started seeing a 10% improvement. So you do want to be consistent. You do want better entries. You do want better exits. And so ideally, if you're thinking about this, we don't have any problems. Looking at charts is simple. We could go to Metastock and just say, this is what it's going to do. And it does that. Well, I've learned when I tried to predict the future, I'm not very accurate. I'd say just like 50-50 at predictions of the future. And personally, with systems trading, I do know that whatever I know to be true today, I do reserve my right to change my opinion tomorrow when we get new data. So traditionally, up until now, we just usually have price and indicators at the bottom, and we might want to get in there and actually code in some sell setups in the bottom right or buy setups on the crossovers. This is basically just looking at a MACD crossover strategy that gets some bigger winners. It's also challenged over to the left side with choppy markets and consecutive losses. And if this makes sense, if you know your 60, 65, 70% win to loss ratio, there are calculated loss ratios in there where you might get consecutive losers. And that's actually 7 or 8 and possibly even 9 consecutive losers in a row on those win rates. Do you have a comment, Jake?
Yes, and by the way, this is not what we do. We don't trade this way.
Yeah, it says the problem at the top. So I will make a bit of a joke about the BS on here. I do like buy setups and clear sell setups. That is why we joke a little bit, but we'll say too much BS is a bit of a problem. And again, we're talking a couple of slides here on the problems. I brought up RSI and basically just coded in buy and sell setups here from say above or below 50. And once again, can get some bigger winners, but unfortunately there are times where we just get too many setups in a row, too many consecutive losers in a row. And these are not ideal with systems. So if we're back to needing that clearly defined process, and if your objectives are growth, hopefully, or even possibly income, if you're a day trader or a swing trader or a position trader, right, and you've got to know your risk tolerance in that case too. Ultimately, what we're going to show today is rules to get in, rules to get out at a loss, rules for taking profit in advance on the charts. And in that respect, ideally, they're clearly defined. We're going to do that. I'm going to at least go to defined as a keyword today. If anything you're doing in trading is not defined in advance, that's going to be problematic in the long run. Also, right, we want our rules that are getting out of the loss to be risk limiting. I personally don't risk more than 2% of my trading capital on any one trade, and that's what I'm comfortable with. As a coach, I do see people usually either over trading and or taking too much risk, and that is completely problematic. The rules for taking profit, we want them to be profit maximizing. Jake said one thing a long time ago, the big moves make the big winners. And if you'd like to get some big winners, you have to have some type of rules that are profit maximizing or keep you in for the long run and are clear. And as marked on here also, ideally, it's a written trading plan. And we know in advance because we've back tested it. And when I say walked forward, I might say, hey, I learned this 3 years ago and I've been trading it ever since. And these are the results I've experienced. And so that, of course, is the most efficient way of learning these types of systems. I'm going to go back and just say, show me the numbers once again, because just like some of the past presenters, phenomenally positive numbers, and that's always fantastic. And for those that want to follow someone else, we've got that kind of possibility in these programs. Or if you want to do it yourself, we have that also. I'm just going to revert back to the first slide you saw when we were basically talking about why expansion contraction is different from most indicators available. Most indicators lag price, moving averages lag. They need many bars to plot the current bar on that one, and expansion contraction is actually measuring price on every bar and only requires one bar to plot data, and as that is not lagging or at least concurrent, meaning that it moves with price and that's a little bit different than most indicators. Ideally, we'd have leading indicators or at least non-lagging indicators with the rules we're using in order to stay timely. So expansion contraction is also different merely because it has a second measurement that you're using as a trend filter. So with this platform in Metastock, which also has the expert advisor, it'll clearly show when we're short-term bullish or bearish and long-term trending up or down. So it's going to mark every bar on the chart with the current condition. As Jake was saying earlier, you'll see green bars, you'll see red bars. The idea there is to just paint it on the bars, and these don't repaint. They are fixed if you're familiar with the problems of repainting indicators. In the past, they're just not where they should be, or were, I should say. So if we can include the trigger bar to take the trade and it's clearly marked on the chart, in other words, a buy for a buy or an S for a sell, or it turns color, or it, has a marker that pops up, or an alert that shows or drops a brick on your head, you want a clear reason to get in and just take the trade. On that, this also measures strength, and I did use a standard deviation calculation to keep that simple. It just defines the normal range. Where should expansion contraction be over time? And in that case, it requires a lot of data for us to calculate the normal range of price right now. And so that'll help us with a clear definition of strong up, weak up, not trending, weak down, or strong down on those conditions. So,
Brian, can we show a chart real quickly and then come back to this slide?
You want to show a chart? Actually, you know what? It's on the next chart. I'm going to pop up the intraday chart example if you'd like, and I'll actually show what you'd like to talk about.
No, go ahead, you take this one. Go ahead.
Okay. Well, if you're talking top left, this is the cues. I'm just going to point out, if you're not familiar with Metastock's Expert Advisor program, it will show you the complete analysis on here. You can see it's showing a strong sell. Now I'm going to move over on the chart with the highlighter and show that there is an S set up on there, and the triangle actually relates to the Expert Advisor here. And so as you can see in here, this intraday chart, it was a 15-minute chart on the cues earlier today, had a strong sell-off, and it shows Jake's moving average channel, the 10-period simple moving average of the high, the 8-period simple moving average of the low, and it shows the color coding on here in the buy and sell setups. You may see a bit of a range in the background. I do personally like to use the Keltner channel with a 3-factor just to identify where price may be hitting some type of resistance. In this case, marked with some diamonds, right, or trade below an extreme support, and also a diamond. These are profit-taking rules on this, and we'll go through those clearly. So let's get back to the next slide, which I've got here is the Japanese yen. And as you can see with the Expert Advisor, I'm now way left over here prior to this bigger move up, where we had a strong buy. There was a weak sell on here. When we go through the rules, you'll understand why this wouldn't have actually triggered or filled short. So basically, we've got another opportunity here where we could have gone long on an intraday chart in this particular case. So Jake, did you want to just see some of your Trade Navigator charts and you want to share your screen, or?
No, this is okay. My approach is very simple. If we look at the expansion and contraction indicator at the bottom of the screen, when it's green, I'm long. When it changes from green to red, I'm short. That's all it is for me. So I keep it very simple. After being a trader since 1967, I've learned the rules are very simple for me. I don't complicate it. I don't let the computer make decisions for me, but I do clarify with the Expert Advisor to make sure that I'm on the right side of the market. But you can see that if you're in the green, you're staying green and staying long and switching when it changes from green to red. It's what expansion contraction is all about for me. Believe me, after 54 years of trading, I've learned to keep it simple. I don't think about anything other than the rules, and most of the time I know the rules in automatically. So I just apply them very simply. There's really nothing to it. I don't look at the news. I don't interpret the news. I don't care who's president. None of that matters to me. It's all about the bottom line, or as you say, Brian, show me the numbers, and the numbers are very clear. The unfortunate fact is that most people who start trading, whether it's stocks or futures, will lose their money. 90% of them will be wiped out within a year or two. Don't be one of those people. Back to you, Brian.
Thanks for that, Jake. So let's get over to the next slide on there, because I have marked out a little bit more on the with the expert advisor here, again showing the triangle on another buy. Put up a big green arrow here so it might be a little bit easier to see. Short-term, long-term expansion, contraction did trigger a buy. It's clear on the charts. Trades up to some resistance, so you take some profit and stay in. The system also shows some add-on, or if, let's say, you missed the buy, additional trades. These are called continuation, and I'll show a few examples of those. And if you're familiar with Jake's trading rules on here, we can apply those also. And at least for me, it's always what triggers first on here. So should be clear sell setups when they happen, or clear buy setups on the chart. And again, at least in color coding it, the idea was to keep it pretty simple and identify when the bars are darker green, we're strong up. When the bars are lighter green, we're weak up. When the bars are red, we're strong down. And light red, there's several here, we're weak down, and that helps us see that transition from, say, a move higher to some correction or consolidation that literally does reverse, that would give us a sell setup till we hit support and bounce a bit, and then finally do get some momentum changing and a swing reversal again. So idea is that you'd like to be able to sound like you know what you're doing and be able to identify all market conditions currently, if that makes sense, so that you know when to get in, when to get out at a loss. These rules, which have been back to this tested, as I said, generally on the triggers, depending on the period you're trading, should be some 24 to 34 periods of consistent bullishness or bearishness. As you can see, there are times that isn't true. Yes, it's an average, it's not an absolute. And can there be a one-day sudden reversal? Sure, and 1 or 2 or 3 day sudden reversals are typically where we might have a loss. Certainly I do. If I bought an uptrend and the trend reverses, that's going to be a loss. So as I said, it's all wrapped up in the expert advisor. If that's something you want, expansion contraction is free. We're not selling it. The idea here is to get something out to everybody that wants to take control of their own life and decide if they want to day trade or short-term swing or long-term swing or position trade. We just want to make sure that you've got the rules to get in and out of a gain or a loss. More definitions in the expert advisor of support and resistance are always helpful for other reasons on that one. So I'm going to show some examples on here, and this one helps a little bit when I'm saying long-term trend. We can see expansion, contraction, where the short-term lines, red and green, are identifying price movements compared to the moving average channel. We'll see red and green lines are short-term swings, and the color coding in the background, or the cone or green shading and cloud in the background, are green for uptrend, red for downtrend. So we get the two bits together here. Short-term swings up or down from the red or green line, whoever's on top, bullish or bearish, and the cloud or cone in the background, as you can see here on this chart that lasted quite some time on here. This is back in November. I believe that was the 3rd, and went all the way to, I think, to the 10th of April. No, 15th of April on that one, just going back. But you can see we had several corrections in here where price dropped, often 3 to 5 days, maybe a week or two, trades back towards Jake's lower band as a support, and that offers a reason to buy and an uptrend at support, basically get the dip or buy the dip. And that happened several times in here, and it was just being displayed with the change in the expansion contraction we see in the December period of time, where the red line went above the green line. So short-term price moved rapidly down through Jake's moving average channel and did stall out pretty quickly and then resumed the trend. So ideally we're seeing, short-term corrections and long-term trends. Go ahead, Jake.
A brief comment. You will notice the consistency of the indicator when it turned green at the lower left and stayed green all the way to the right. That's what I'm looking for. I don't want to have to come back and forth with every short-term correction up or down. That's what ruins performance. When performance is consistent, that's where I make my big money, and I give some back, and I make some big money again. And that's the whole idea here. Remember, it's not about how much you trade, it's what you trade and the quality of what you trade. So, in fact, most of the time as a good trader, you should be doing nothing. You should be in a position and not babysitting that position back and forth all the time. And please do excuse the voice. I just had some throat surgery from a childhood injury. I am not as old as I sound. Go ahead, Brian.
No problem, Jake. You still sound pretty good. I know that you just didn't have a voice at all while it was healing initially. So as I said, it's good to hear your voice again. So again, we can see we do have long-term trends as it's showing in the top and short-term swings. Jake said the big money's made in the long-term trends. So what I would say, when you got a buy setup, do you know it's going to be a big winner? Well, not when you have the buy setup. You know what to expect from knowing the numbers and the back-tested past. We would assume that it'll trade similarly in the future. The reality is, although every setup isn't a big winner, some setups are big winners. So if you take the setups and follow the rules, you should get some big winners. Obviously, based on regulations, I can't guarantee anything, but if you follow the rules, you should get a big winner if it happens in something you trade all the time. What I found is trading thousands of possible choices, it's hard to pick the ones that are going to get the big winner next. So you either know that it is a big winner and you take the trade, or it happens in what you trade all the time. So let's got range expansion and contraction. Obviously, that's the name of the indicator, and you can see when the general cloud is getting bigger, as I've marked with the green arrows on that, you can see that kind of correlates to the overall movement. The cloud also compressed in here in the middle and squeezed a bit, and short term was slightly bearish on that. We can see it price move back through Jake's moving average channel, and then will trigger a continuation trade in this case, or you could have bought at the lower channel on there with specific rules, and I'll show Jake's swing trades on there too. You'll also see where we have resistance and support, and it's typically where the channel, or the cloud I should say, gets to its maximum range and then starts to contract, and that will show us some significant or minor supports and resistances using the indicator. As you can see to the left, where we were in a downtrend, the support came as the cloud hit its maximum range and started to contract. I'll also see a period of contraction here of the cone or cloud in the background when the trend was weakening. And inside all these small dashed lines in here, of course, is where the market is just not trending. And so we had a strong move up, hitting some resistances and price extremes, continuing to new highs and starting to consolidate. And that's pretty clear in the indicators, and then gives us some clear setups. Initially a weak sell, a trend continuation buy, and then a strong sell on here that did manage to trade down to support and take some profit on that. So I'm going to pop over to the next slide. As we also mentioned that there's divergence and short-term breakouts. I'm going to pop down to the bottom left when the red or the green line pop up significantly. And of course, with those little gray lines on there, that's the normal range. And if the lines pop up significantly to the solid gray line on there, it's a strong move up. As often, short-term strong moves up lead to either a trend reversal or trend continuation. And ideally, if we have these calculations and they're expanding with strength and contracting with weakness, that's all measurable on there. And I've actually identified over 30 tradable characteristics with expansion contraction, and these are just a couple of them. So the idea is to keep it simple and not overcomplicate things. Another example here, at least of some divergence, when price is making new lows, and then we can see that the indicator at the bottom here, expansion contraction, is contracting over time. We're making new lows and we're not seeing an increase in momentum. that divergence would help us identify the potential low here or bottom. And of course, when price did trade a little bit lower, that just barely missed the stop out using Jake's divergence rules. And on those, and I don't think I included the divergence rules today, but they are available, and that's one of the best ways of identifying a top or a bottom for a significant potential move with some calculated risk.
Can I jump in here for a second?
Go ahead, Jake.
And
Did you want
by
me to
the
go
way-
back a chart?
No. This works in any time.
Okay.
Works in any time frame, stocks or futures. Doesn't matter. So you do daily, weekly, intraday. It's a beautiful thing. As I said before, I don't do all that interpretation whatsoever. I'm just red light, green light, and that's it. That's it for me.
Yeah, keep it simple. You and I are older. I'm 72, going to be 73 this year. I know you're a little older than I am. When you get older, it'd be nice to spend some more time doing other things. So I hate to say set it and forget it, but I just did anyway, because we don't technically set it and forget it. But if you know in advance, when it gets there, you know what to do. And if it hasn't got there and you do nothing, I'm just going to say I spend a lot more time doing nothing than I do trading. And I also spend more time tracking and keeping track of the records than I do trading. And I spend more time developing trading systems than I do actually trading, because once you've got the rules, how long does it take for you to place your order? Seconds, really, or maybe a few minutes. So this is not tie down, sit at the computer all day. However, if you wanted to trade intraday charts, I have had this right down to tick charts on that, and it's still consistent. So the idea there is that it's consistent on all time frames on that. And although admittedly not in everything, this is not some kind of panacea, but I definitely like Jeff Gibby's comment on it being a Swiss Army knife. It does really well in a lot of things, although not perfect. Don't want to expect any system to be perfect on that, but ideally, if we know the numbers, if we have proof, it's easier to take the trades. So again, I've just marked the expert advisor, just showing a strong buy. It's got the triangle above the B, would help us get this move up on this case with some add-ons. We're gonna take a small loss in here, just to make a comment on there. This is the gold chart on that, but we can see what it did do, and we may not know what the future is, but we're going to be trading reality at the right edge of the chart. If that makes sense, what we're looking at here, is gold is bullish. If you weren't in back in December and hitting these positions, ideally we're seeing price come back to support. As again, Jake said, in a strong trend up. His is defined by his 5 above setup. I'm more than glad to share that too. The next highest probability trade is a buy at support. And so that's just a tip and a trick to know in advance and to exploit. After the strong buy and price went up, as I said, we had a correction. We could see expansion, contraction, went sideways and never really expanded strongly out beyond its normal range. I like to use normal over standard deviation because math terms tend to get people to drop out listening. So if we know what's normal and we know we're above normal on that, or in this case, below the normal range on that, we've got a definition of an expanding market to the upside or downside, strong or weak, and at the right edge of the chart again, always knowing what's true. We've had a buy set up with a swing up and a correction that would have given some small losses, then another big move up and multiple add-on trades to get a bigger winner, then some corrective pattern with a small gain and a small loss in here, and then reverses again and continues to trend. So ideally with the setup conditions, when we are wrong, and we will be, because I said approximately 65% win to loss ratio from back testing, and in that particular case, that is not 100%. So we're definitely going to have some lost trades, and they should be small and acceptable. I'm marked on here. Oh, go ahead, Jake.
Are we going to have some live charts to show later?
I didn't pop up live charts in Metastock, but I can. But again, I'm not going to have the ability to change to a whole lot of symbols. Maybe when we get right near the end, we can have Jeff pop up his charts and just wait.
I wanted to show my biggest winning trade and how expansion contraction got me into that trade.
Ah, fantastic. Well, that's always appreciated. What was the symbol?
PLTR.
Oh, and Palantir. Yes, understandable on that. In fact, Palantir is my one big winner for the year. I've had small losses and small gains. I'm going to show some results from the basket. But does that make sense, Jake? We'll get Jeff on right at the end, and he'll pop up a Palantir chart and help us go through that.
Absolutely.
Okay?
Yep.
Fantastic. We'll put Jeff on the spot. He appreciates it.
I'm ready. It's funny because
You're ready. He is in the background, always lurking in the background. So just marking the continuation trades again. I'm a big fan. If we do get in and we get up and we have no risk, I'd rather add to a winning trade and build a position of maybe 1 or 2 or 3 or 4 add-ons if it continues to trend and we have no risk. Ideally, if we build a position in the same instrument, we're going to make a big winner bigger, all with the same risk we're taking now. And I'm all about making big winners bigger when I get them. I don't get them very much. I've only had one. Interesting that it's also in Jake's, but not surprising. So marking out the strong buy that again led to a bigger move up here. I'm just looking at the time and I'm not going to hang out on all of these charts too much. And upcoming when I get to the rules, you might want to have either a screenshot tool handy if you want to take screenshots, or wait for the recording and they're all there anyway. But again, we're going to just show everything marked out here, showing the expert advisor and marking the strong buy. We don't know when they're going to happen. We might be in a choppy market, get a couple of small gains and losses, and boom, again, we'll get the bigger winner when it does happen in what we trade all the time. As I marked on there, small losses in the consolidation, just looking at expansion, contraction at the bottom inside the smaller dash lines is not trending, slightly bearish in this case, and did the same thing, expanded to the downside and then just stalled out and stayed fairly weak through this whole process before again showing us a breakout type of a trade. So we're seeing a couple of periods where we had some small losses in this type of a position, and I'm just going to mark out the original buy, add-on trade, all of these as I've marked at the top, all at least hit the first profit target, in which case the rules say go to break even. So did want to at least show, although this is a strong trending chart and does show excellent results, well, that's what we want to trade. I know my objectives are growth. As an option trader, I want to see strong trends because markets that go up or down quickly, the deltas change quickly. It's basically gamma. In that case, if you understand options at all, I'm a long gamma options trader with option spreads. Debit spreads in this case, all with a statistical edge. If I could take them, and I pulled up the Japanese yen chart in previous presentations. I've showed from the setups where to get in at the price, all of that, labeled it on the charts with the targets. I'm not going to go into every one of these, but if you've got your rules and you go back in the past, this would basically be a little bit of manual back testing. And at least you could see, well, based on a setup, what would my risk have been? How many contracts might I have traded? In this case, I was keeping the risk to $5,000 or less. And in order to trade 3 contracts, right, that would determine that the stops have to be of a certain size. We get beyond that, it's no trade. But then you can see we had more winners, fewer losers, and price dropped up. And as I said, this was a chart that I showed on the previous session, and it just extended it a little further forward. So you can still see we've had a buy set up on here that went up and hit a profit target on the tip back into the range. It did stop the original trade out at break even, but triggered a buy on the market here. You can see there's a trend continuation buy on on February 14th. And it was bullish. And of course, what price has done has gone up quickly and hit another profit target just in the last 3 days now. So I need to update the charts. And as I was saying before, if you're going to trade, I just put up an example of a spreadsheet on those Japanese yen futures trades, and I will just say these are not trades that I've taken because I'm not a futures trader, but I want to track what works, what doesn't work, and at least have the numbers and say, well, here's the proof on average gains, average losses, and what the trades have done over time, and keep an eye on the profit to loss ratios on all of that. So if I were to look to trade another market and wanted to get into futures, at least I know I've got some proof of what to expect out of the Japanese yen. Now, as I mentioned before, I'm going to at least pop in some results here before I get to the rules. And I showed this last time, although I had to update Amazon because it was still in a trade and has finally closed out. So in learning from Jake, ideally we're trading a small basket of non-correlated instruments. And in that case, focus on those lists as long as they're strong trending. Do you have a comment, Jake?
Are those minus signs or are they dashes?
They're dashes. Minus will be in parentheses. So
Gotcha.
Microsoft did have a really small gain after a stellar result last year, and had mentioned once the weekly charts were no longer strong trending with Microsoft to rotate into Palantir. So as you're seeing, I'm usually 6 and 6, and Microsoft dropped out in March when it was no longer trending and had a small gain. And Palantir rotated into that because of it being an AI and, more importantly, a strong uptrend in tech on that. So, and then of course you can see the cross currencies. Now that was updated, and I just want to at least pop on what they're still doing. Apple up a little bit, had one small gain on that. Amazon up on a couple of trades. Here's the parentheses. So right now NVIDIA's had 3 consecutive losers. I have to recall that last year was up a lot, the year before even better. And so actually in the last 2 years where NVIDIA's been up over 100%, and being down 4.91 is with 3 losses is acceptable, although most people are not going to like to see minus anywhere. Q is also down slightly this year following the same rules, and Tesla and Palantir up slightly. On the currency side, Euro is slightly down on that, but I did show at least on the current legs. Some of these are up a little. Euro up earlier this morning, 27 pips on a current trade, and to as much as up 486. I put points in here for sizing. These are pips, but I'm okay with points, pips, ticks, whatever you want to call it. It's still the same thing. So as I mentioned, if you have a screen clipping tool, if you just want to get back to the presentation here, as we're down into the last 13 minutes or so, I want to just mark out here that I do have 2 different types of setups, at least personally, strong or weak. I know Jake has a slightly different setup rule, and the main thing is that you want to do what you want to do, and Jake's entry with at least 2 periods in a row confirming would be just a little bit more conservative, and that works for Jake. For me, trading options, I'm okay to get in on the first setup because I also have a defined risk, and worst case scenario, I could potentially hedge. But we got the setup, type of setup, the entry pricing, market on close. You can see that. And again, I'm going to read one of these, but not every one. We got the stop. This is Jake's moving average channel times 2. Also, there's also potentially an alternative in using the Keltner channel, which is based on average true range. And I do like to have an adaptive stop. Go ahead, Jake.
I have an idea.
What's that?
Let's put Jeff to work and look at some real trades. Instead of these rules, I think everyone who's had a chance to take a screenshot if they wanted to. So right now, let's not bother with this. It's all very boring stuff. Let's go to some real trades and see what it is.
Sure. Well, I was going to read at least one, and we kind of got through that. And all we're really saying here before we get to charts for the last 10 minutes, and actually I think it might help if we ask people, is there a symbol you want us to look at? And we can look at those. But ideally, we're just going to wrap it back up into here. If you're going to want to work with Jake and I, Jake has a number to call. And in order to be approved, first of all, we definitely want to make sure people are serious about learning this and learning to do it themselves. So Jake will have an interview process, and if you want to get one-on-one or group help, that's also available. But again, we just want to make sure everything's back tested. And when I say in liquid trending markets, what I mean, you're not trading like Bob's Pizza Parlor. We're trading Amazon. We're trading Apple. We're trading Tesla. High volume stocks, more than 5 million shares in the last 20 days, at least, is mine, which is similar to Jake's. Now that we've got to here, I'm going to just go ahead and ask Jeff if he wants to pop back in and show some live charts. And we're going to go with Jake and see what he wants to cover.
Yeah,
okay,
of course. Let's see. I think it's interesting. Marcia earlier was asking if we could look at Palantir. So I actually had that one loaded and ready to go.
Let's do it. And here's a stock that I bought not only for myself, but for my grandchildren as well. So they're very happy campers because we bought it very, very down at the bottom where it turned green. We used the weekly chart.
Okay.
Can we go full screen with this, Jeff?
Yeah, it should be full screen.
Okay, because I can barely see the chart.
You might need to maximize it on your end, Jake.
I see that. Yeah, let me do that. Sorry about that. So
Yeah, you're fine. No worries.
All right, it's maximized. So Jeff, Brian, you want to talk about where it turned bullish?
Yeah, it's all the way back in the April. Oop, that just moved completely. Oh, there it goes.
Right here.
It's a moving target, Jeff. There you go.
I just try to keep you guys on your toes.
It was definitely. Okay, and again, you can see the date on there, 5/12. It was a strong buy and has stayed bullish since then. So there are going to be times when we get some big moves long term. And how do you know they're going to happen in advance? You don't, again, but if you got a trigger and it's been strong trending, and that's something you want to stay with as long as it's trending strongly, right, Jake?
And yes, can we show expansion contraction indicator a little bigger?
Yeah.
I might not get it on the weekly chart here because
there we go.
Got more data on
Yeah,
it.
I had to go back down to daily to show expansion.
Yeah, not enough data in Palantir to load the standard deviation numbers.
Right. So that's Palantir. Who else? Everybody wants to see NVIDIA, don't they?
Yes, Kurt does, and so does Marcia. So I'll pull that up.
We can do the daily on that one.
Just to comment on something like NVIDIA, on Palantir that did manage to trend, that is this literally on the options has gone up thousands of percent on the risk itself. So very small risk. And, like I said, you don't know what's going to happen in advance, but you should know you're in it and don't get out. Optimize that trade by buying on the dip, and even Palantir is still a buy on the dip.
Absolutely. Absolutely. And what about Apple?
Sure. Ooh. There we go.
So you can see where it caught the current move up, and it's been long for the last couple of weeks, right? Oh, I will stop trying to talk.
Oh, you're doing really good. Like I said, it's good to hear your voice again. I know it was your voice challenged for several weeks. Very frustrating.
Yeah.
But yeah, this is hit the buy trigger, 6 days ago? And
yes,
has quite gone up from what I was looking at earlier. Hadn't hit the profit target on this yet. But again, we know where the stop is. We know where the profit target is, and or up at the price extreme. So currently, if you're not long in here, ideally you're buying support, and that's possibly the 8 SMA of the low, which is that gold color, or maybe mustard, whatever that is. Or I'm also happy if it comes down to the 20 SMA, which is the center band of the Keltner. If we're looking to buy on a dip, we should have that level known in advance and have buy limit orders in at that pricing for today. Whether you're anywhere near it or not, it's good practice to have your orders in, because sometimes it happens in a heartbeat and you wish you did.
I wanted to go through the moving averages that are being used. And so we've got the Keltner channels here. I believe this is based on a 20 simple moving average. And then the other two moving averages, the blue one is an 8 on the low, simple. And then the gold is a 20 based on the close, simple.
Not quite, but close.
Oh, go ahead.
So the blue line is the 10 simple period moving average of the high.
Okay.
And the other color is the 8 period simple moving average of the low, which is that
Okay.
color.
Yeah.
Really
Okay.
don't have
Okay.
any idea what to call that and what I
I
want to call
highlighted
it.
the
I'm
wrong
not going
word.
to say on air.
Cool.
Can we take a look at the 30-year bond futures daily chart?
Let's see, baby. Let's see. I'd have to remember the symbol on that one. I think it's USTYT equals 30. I could be wrong on the symbol. I am. We can't look at that one, Jake. Not without me running over and asking.
TLT.
TLT. Oh, okay. I can do that one.
Substitute.
And you'll notice when it turns red, it stays red for a long time. That's where I make my big money, right over there.
Or it might snap right back. I mean, that is the reality of any setup to get in today. Might be a loser tomorrow, but we've just got clear rules on that, so that if it is going to be a loss, it'll happen relatively quickly and be a small acceptable loss. Again, this is not 100%. It's generally been between 55 to 75% on many tests, but I always just sit in the middle of like 65. What I will say is that this has not experienced more than 6 losers in a row, which happened only once in the last 5 years on the daily charts, and that was in Apple. Statistically, it could have 7 or 8, maybe even 9, so I'm okay with it having 6 consecutive losses once, although preferably 2 or 3 consecutive losses, and that would be where we are with the benchmarks on these.
Jeff, can we look at weekly gold?
Yeah, we actually have a request for gold from Carlos. I'm going to go ahead and do GLD unless you have a different symbol you prefer.
That's fine. Can we make it weekly?
And Nick, you mind if I just make a comment on people? Some people say, well, that's fine. It's already in a big move up. It's easy to show it now. Well, sure, you have a buy setup and it either is a small loss or a small win or a big win. Ideally, you know when it is strong trending, and expansion contraction will show you that also. And then you know you want to stay in and build a position in it.
Well, bottom line is 80% of your money is going to be made on 20% of your trades.
Right, the Pareto principle, basically.
Right.
I'm going to say to that about 80% of the stuff I ever thought would be better wasn't, but the 20% was great.
80% of the ideas that I had.
Exactly. Well, so we go through a lot of what if and do a lot of back tests, and so spent a countless number of hours. I said there's a lot of research that goes into this, which has helped a lot in order to identify a large sample of data that's been consistent. Could that fall apart? That's a possibility, but it hasn't yet.
Kamal wanted me to repeat the moving averages. So the blue one is a 10 high of the simple, and the gold color is the low.
Yeah, you're too close to the 20 there.
Yeah, the low 8 simple.
There you go.
And then the
Right,
rest.
so even you had trouble calling that color.
What's that? What color do you want me to call it?
You had trouble calling what color that was. I
settled on gold.
My first one was baby poop, but you know.
I think that is actually the technical color of this if you look at the top files.
Well, before we run out of time, Jeff, did you want to say something before we run out of time?
Yeah, I kind of just wanted to talk a little bit about how you can get this, and I think now would be a good time to start doing that because we are almost out of time.
Sure.
So,
Thank you.
Before I totally take over, thank you, Jake, for everything you've done over the years. It's been a lot of fun. Totally my pleasure. And Brian, thank you for creating what I call the Swiss Army knives of indicators.
Thanks, Jeff.
All right, very cool. I'm going to kind of run here back into the PowerPoint and just kind of show the box. This has been one of our most popular products since it was released. We call it the Bernstein JBXC Complete. And Brian already did a great job of talking about what it can do, help you identify long-term trend, the strength of that long-term trend, short-term strength, swing strength, expansion, contraction, support, resistance, overbought, oversold, divergences, short-term breakouts, all that kind of stuff is kind of built into it. And I really like, I'm going to kind of skip through some of this because it's been relatively well talked about already. But what I really like is when we kind of went and put together the expert advisor, I really like the way that we kind of put together kind of this dashboard view. As I was kind of going through and kind of looking at this, I was like, you know, what we need to do is kind of give people just like a dashboard, kind of give them an idea of where everything is. And so that's where this concept came up. You can see trend strength, bullish, short-term strength, whether you're in a correction or how big the strength of that is there a breakout? All this stuff is really just spelled out for you. And it's all automatic. It's all based on kind of the code. It looks at that. It gives you where the major support and resistance and the minor support and resistance is. All of this is kind of spelled out in the expert advisor. I'm kind of a little bit biased, but I love the way that we designed that out. And in terms of scanning, if you're looking, I've talked about how much I love to scan for stuff. You can find stuff that has a divergence if you want. You can find just the buy signals. You can look for long-term trends. You can look for the sell signals. Everything is scannable. You'll be able to find what it is you're looking for. Okay. System tests. We include system tests. They look really good. I like the ability to go in and test the ideas and see how well they work and how well they kind of evaluate. These perform really, really well, which you'd expect. So I think that's it. We did sit down when we initially released this product and we recorded a live boot camp that's available instantly. In the first part of that boot camp, Brian and Jake sit down and discuss kind of the JBXC and how to work it. In the second part of it, I actually go in and talk about, you know, scanning and setting up your watch lists and creating everything you need to do to kind of use and take advantage of JBXC. And so there's no extra cost for that. We did it because we want it to be valuable for you. With this product, as with all of the products we offer it with a money-back guarantee. So we want you to succeed with it. We want you to be one of those customers that have been using it for years and years and years. The JBXC is only $5.99 as part of the conference offer that we're doing. It's going to be $4.99 here. That's a one-time purchase. Again, we're going to offer you a money-back guarantee with it. If you're new to Metastock and you want to get this with Metastock, we'll give you a 30-day trial. Your risk on that's going to be zero. It's either going to work well for you and you're going to keep it, or you can cancel it and get a refund. We don't do a lot of refunds here, but if you ask for one, we'll give you one. So you can take advantage of this by going to metastock.com/conf promo. You can give us a call, 800-882-3040, or metastock.com/sales chat. Give it a go. I know there were some charts that we just didn't have a chance to look at. If you have any charts that you want to see kind of with expansion, contraction, get in touch with our sales chat. They'd love to pull up a chart for you and help you with it. So $4.99, that's a one-time purchase. You don't have to pay for it every single month. Has a money-back guarantee. Metastock.com/conf promo, 800-882-3040, or metastock.com/sales chat. So again, thank you very much, Jake. Thank you, Brian. Really appreciate everything. And let me go ahead and with that, we'll start to move on. I don't know. Okay. I do want to say thank you to AAII for sponsoring the event. You can find out more about AAII at aaii.com. Great, hugely well-respected organization. We appreciate their sponsorship and what they've done. Also want to say thank you to Stocks and Commodities Magazine. You can find them at traders.com. They've done a great job of sponsoring the event ever since we started. So there you go. Al, make sure to reach out to our support team. They'd be happy to pull those for you. And same thing with that, Tracy. I know we didn't look at Amazon, but I'd be happy to have somebody send you a chart. Just get in touch with us. So, all right, Mr. Lewis, let's do a little real quick drawing. Let's find out who the next winner is. Are you ready?
I am ready to roll. Let's do it.
All right, let me look at the prize list here. Let's see, the next one is the Price Action Weekly Playbook by Silas Peters. This gives you weekly price action alerts. You will receive the top trade of the week, so you can avoid hours of research every night, and a bunch of other stuff. It's from Silas Peters. Silas is speaking a little bit later in the week, and it's called his Price Action Weekly Playbook. Greg, what I need from you is a number. Let me grab the list here real quick. All right, I have the correct list. What I need from you is a number between 1 and 6,757.
All right, and that number is, according to the Google random number generator, 1,750. That's 1750.
We're still in the U.S. It's only a matter of time before we get somebody that's
It's just a matter. It's just a matter of randomicity.
This actually is not a Gmail account, though. It's an Earthlink account.
Oh,
so,
old school.
Yeah. And US with an Earthlink account. And let me just make a note of that. Thank you very much for the assist.
You're welcome.
Silas Peters. Okay. I have to write these down now, or I have to come back later and watch the video to see who won. Thank you again, Greg. All right. Our next guest almost doesn't need any introduction. Wrote what is considered to be one of the most, I don't know what's the word I'm looking for. What's the adjective? One of the most influential books in options analysis. It's called Options as a Strategic Investment. A lot of people consider it to be the gold standard when learning how to trade options. Larry McMillan's very well respected, been releasing newsletters and reports for a number of years. It's our pleasure to have Larry on the event today. Larry, how are you doing?
I'm good, Jeff. Hear me all right?
I can hear you great, yeah. Let me make you the presenter real quick.
Okay. How about that? You see the screen okay?
Not yet, but sometimes it takes a second.
Oh, wait a minute. Do I
Now
have
I
to
can
hit? Okay. All right.
I'll get out of the way. I'll let you go.
All right, thanks.
Thanks, Larry.
So we're going to spend a little time here talking about the option market, what it's thinking about the stock market, and also near the end, I'm going to present a couple of more recent strategies and things that we've been talking about in our newsletters. So just a little bit of background. We started out as a research company in over 30 years ago, and we were selling data, selling research, etc. But then after the financial crisis, when we made quite a few decent recommendations, we moved into money management. So we're both a CTA and an RIA. And then we also have the option education division, which includes mentoring, but also webinars such as this. So I'm going to come back to this later, but the PDFs of today's presentation are available at that website, optionstrategist.com/metastock. So if you want to grab, there's two, there's one in color, one in grayscale, in case you want to print it out. You don't use up all the color ink in your printer. So basically, these are the four main things I look at, four main categories. First of all, the S&P 500. I mean, the chart of the S&P is really the king of all the indicators. If all your indicators are bullish and the market's going down, then the market is right. Hopefully that wouldn't be the case, that your indicators would be bullish when the market's going down, but the market itself is certainly an indicator, technically, chart-wise, that sort of thing. Then we'll look at put-call ratios, both in terms of the broad market and some individual stocks and futures. Market breadth, which has remained pretty stubbornly negative here for quite some time. And then things about volatility, VIX, VIX futures, and other things having to do with volatility, including a potential, what they call gamma squeeze, might be coming up in that area as well. So I have an important rule with a corollary. The important rule is oversold does not mean buy. So we're not really getting too much oversold, although with the market down again today, we might start to see some things that are beginning to be oversold. But we wait for confirmed buy signals from our indicators, because the market could go down a long time while it's still oversold. The companion or the corollary to that is overbought does not mean sell. So we're on our way up, especially in the last few weeks as we moved from the January lows up to the top of the trading range. We got some pretty good overbought conditions, really maybe just halfway up through the trading range, but that did not mean sell. You don't have a sell signal until it's actually confirmed as well. So we'll keep that in mind when we're looking at things. Let's start off with a long-term 2-year chart of SPX. We've been in a bull market since October of 22, and that's basically this entire chart, plus a little, I guess. But you can see up here at the top on the upper right that we've been in this trading range now for really since November. And we've tried to break out, well, twice on the upside, once right here, and then once last week, and then once on the downside. And all three of those breakouts have failed. And they were 2-day breakouts. In other words, they broke out, they held for a second day. That used to be kind of the standard. If you got a 2-day breakout, you were good to go, but that's not the case for this current market, which is being, pretty obnoxious about staying inside this trading range. So we're back in the trading range. There's support around 6,000, which was Friday's low. You can see that we've had a couple of days recently where 6,000 is held. The low today was just a little bit below that, 59.77. So we're closing back below there. And we may be headed for the bottom part of the trading range, but it's the market's volatile within the trading range, so there's plenty of trading that can be done. It's not like we're trading and it's just dull and nothing's happening. This is just a zoomed in 1-year chart. You can see here there's a gap that was left in mid-January when we broke down, had that false breakdown, and then broke out to the upside. We actually came up and had 3 gaps on the upside. 2 of them have now been filled, and this remaining one is all the way down at the bottom of the trading range. 58, I believe 60 would fill that gap. So it's possible. Not every gap on the S&P chart is filled, but most of them are. And you can look back to the left there and see a couple that are going way back that might not have been filled. But this is at the bottom of the trading range. So now that we've broken down below 6,000, we could easily be heading for the lower part of the trading range. And again, I would consider any significant 2 or 3 day close below 58.60 or so to be a breakdown. If you want to be a real stickler about it, you could use the 57.70, which is this lower red line here. Interestingly enough, there was a gap back on the chart back here. That gap was filled, and we bounced straight back up again. So, it's been a little bit of I guess obnoxious would be a word you could use in terms of trying to get a momentum signal out of this. But there's, as I said, plenty of signals can work within the range, and the range is, about 300 points wide. So that's a plenty decent move in S&P from one end of the range to the other. So this just sort of summarizes that. I don't know what would actually constitute a confirmed breakout now that 2 days doesn't seem to do it. We've had 3 false breakouts based on that. So I guess 3 days maybe. You don't want to wait too long, or the thing will move just way past where you wanted to get in. Anyway, there's another thing we do with the S&P chart that's to draw modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he used as the definition of realized volatility, he used the standard deviation of daily closing prices. That works for that purpose, but in reality, in the math world, they use the standard deviation of daily percentage price changes, and that's what Black-Scholes uses. And since we're in the option business, our implied volatilities are based on Black-Scholes. So we need our realized volatilities to line up or be calculated in a similar manner. Otherwise, we couldn't compare realized and applied, which is something that in the option business we have to do all the time. So we watch for the index to move outside of the plus or minus 4 standard deviation band. And then when it goes outside and back in, we get a signal. We turned out that this was very good over the years, but then we started to get a lot of false signals. So we put a secondary criteria on it just for more confirmation. and that's what we call a McMillan volatility band signal. So here's the current chart going back 1 year, same chart we just looked at, but now the bands are drawn on the chart. So you can see on the right there, like the top band, that's the +4 sigma, 4 standard deviation, and the next one inside is +3 standard deviations. So you can see here we moved outside and then closed back inside. That was a sell signal, which culminates by when the index trades at the lower band, and that was a successful sell signal. That gave us a buy signal last August, which technically is still in effect because we've never closed outside of the +4 standard deviation band since then. We've come close, you know, a little bit, not that close really, maybe here, but realized volatility has remained relatively high, even with the index in this trading range that we're in right now. So that's kept the bands fairly wide apart from each other, but right now, technically that's still in effect. This was another, the blue letter on the S here indicates a failed signal. You can see that the market moved down for a minute, then went up after that. So, you know, that was a stop. So all of these signals and things have systems built into them so that we don't get overrun. We have stops built in. So right now, this is a very old buy signal. We are still holding some positions, which we've rolled up many times since then. But you know, I'd like to see a new fresh signal start out. Sometimes when the market breaks out to a new high and you don't have any overhead resistance per se, we use that 4 standard deviation band as a target. So if the market were to break out on the upside, that 4 standard deviation band is up above 6,200. I think it was 6,240 on Friday, but it'll come down some today. It changes every day. It changes not only with the price of S&P, but also with the realized volatility of S&P. We have you can use this same methodology on any stock, any index, any futures contract. So we do that. We have a subscription service where we send you daily where new signals are occurring in terms of any well, stock or index or futures. Anyways, so moving on to the next subject, put call ratios. Put call ratios were invented as an indicator by Marty Zweig back in the 1950s when he was getting option volume from the Barron's ads that were run by the put call brokers of the day back in those days. And maybe they're on the whole week, there maybe be a couple thousand options that we're trading now. We trade a couple million a day, but whatever. But he found out it was a contrary indicator. So we use the equity only put call ratio, which is all stock options that trade, to predict the broad stock market. But here's the theory, this is Marty's theory, still holds true. If there's too much put buying, then everybody's bearish and the market will turn and go higher. If there's too much call buying, then everybody's bullish and the market will turn and go lower. Of course, quantifying what too much is a bit of a problem, but we think we have a pretty good handle on it. So here's how it works. Let's say IBM, at the end of the day, you sum up the volume of all the puts that were traded separately, sum up the volume of all the calls, divide the two, that's the put call ratio. So that's pretty standard. Since puts are in the numerator of the fraction, an increase in put trading will make the ratio go higher. But when are you likely to have an increase in put trading? Well, that's when the stock itself is going lower. So they move in opposite directions to each other. Same thing for calls. Since calls are in the denominator of the fraction, an increase in the denominator will make the fraction go lower. And when are you likely to have an increase in call buying? Well, that's when the stock is going higher. So again, they move opposite to each other. So we keep a moving average 21 days in case there's something to Fibonacci. And on our website, in an area that we call the strategy zone, we publish over 1,600 put call ratio charts every day. And our put call ratio charts that we publish in our newsletters or there include the stock price chart as well as the put call ratio chart, because you really need to see the two to see what's going on. So this is a theoretical chart. Let's say the stock is falling And as the stock is falling, people are buying puts. So the put call ratio is going higher and higher. Eventually, the put call ratio forms a local maximum. As the put buying exhausts itself and starts to roll over, that's a buy signal for the stock. Now the stock starts to go higher. Move over to the left side here. The stock's still going higher. And as the stock is going higher, people are buying calls. That forces the ratio lower and lower till you finally get to a local minimum on the put call ratio, and that is a sell signal for the stock. So that's the theory. And the reason we publish both the stock chart and the put call ratio charts, so you can look at them and see if they're actually behaving that way. If they're not, then something else may be going on, like arbitrage, especially something like dividend arbitrage that can distort the ratios. And when that's happening, of course, it's no good. So you need to see this symmetry. So this is not the current chart, but on the top is the S&P 500 index. And on the bottom is all stock options that trade, the equity only put call ratio. And you can see this inverse symmetry here that exists most of the time. And that's why we use the equity only put call ratio to predict the broad market. So what's it telling us right now? Well, here's the current, what we call standard ratio, just using the volume of the options as, was the case on the example. And you can see that we just, really in the last couple of days, put in a local minimum, which is a new sell signal. So it's in green, meaning it's a new signal. So I don't know whether it's going to be good or bad yet. Prior to that, we'd had a sell signal back in December, but that kind of rolled gently over to a buy signal. We had a good buy signal here with a local maximum last fall, et cetera, et cetera. So the signals are mostly successful, and it kind of keeps you on the right side of the market. There's a couple of blue letters in there, but by and large, this is a trusted indicator that we've used for a long, long time. Now, the fact that it's just rolled over there, technically, as a local minimum or a local maximum, it would be a point that lasted for 10 trading days. But if you wait 10 trading days, you might have missed a good part of the move. So we have computer analysis programs that look at these charts, and they estimate what's coming off the 21-day moving average, what might be coming on, figuring, tomorrow's readings will be somewhat close to today's, and also, can configure whether you are extremely low or extremely high in terms of the ratio, previous ratios. So the computer analysis programs also agree that this ratio is moving higher and that this is now on a sell signal. Just one note, we'll come back to a longer term chart in a minute, but this reading we had here in December was the lowest that we've had since November of 2021, which was right before the last bear market started. Now, I'm not saying a bear market is going to start, but that was pretty optimistic reading down there. 50 on the left-hand scale means that only 50 puts are trading for every 100 calls. And in equity, stock options, more calls trade than puts, that's a given. But when it's 2 to 1, that's really way high, like low, I guess you'd say here, low. So that's an overbought reading. And so we're getting this sell signal from a relatively overbought place on the chart, which should generate a decent sell signal. Perhaps, something on the range of, you can see here last July, the one that came in at that time was pretty decent. I mean, the market moved down I think that was about a 9% drop in the market, something like that. Now, as computers came along, we were able to calculate another, perhaps more meaningful put call ratio, and that's the weighted put call ratio or dollar weighted put call ratio. The way we calculate it is like this. At the end of the day, we take the options price and multiply it by the volume that traded that day and give us the dollar volume. Now, you could do that little multiplier thing there all day long on every price times the volume of every trade. That's an expensive and time-consuming operation. Now, we tried it for a while, wasn't giving us any better answers than using it this way. So we do that calculation again, let's say for every IBM option, And then we sum the dollar volumes of the puts separately, the dollar volumes of the calls, divide the two, and that's the dollar weighted put call ratio. So now we're measuring the dollars being spent on bullish opinion versus the dollars being spent on bearish opinion, which I think is a better number than just the volume of option trading that's bullish versus the volume that's bearish. But you can see the signals occur more or less in the same spot. They're just more extreme. So this chart, it goes higher, lower, but it's still giving us a brand new sell signal here in the last couple of days, just like we saw on the other chart. So we have this new sell signal here. This ratio here was the lowest it had been since November of 2021, et cetera, same sort of thing. Maybe gave us a little stronger buy signal there in mid-January, and then a nice strong buy signal back here in these 2 points early in the year. But for you get a really strong buy signal, you'd think you would need to have the ratio be up, in the area where these are. You can see that's 100. 100 means $100 are being spent on puts for every $100 being spent on calls. Again, since it's stock options, more dollars are typically spent on calls than are on puts. In any case, we had these buy signals from January have just now reversed to sell signals, and even though we're in an overbought area, the ratios were much lower in 20 and 21. In fact, I want to show you this longer term chart. This is the standard ratio going back 10 years. And you can see in the pandemic, that was the highest it got, and that makes sense, very bearish and pandemic, the local maximum there came in an extremely high spot. The yellow line is the 20-day moving average, or 21-day moving average, I'm sorry, which corresponds to the chart we just looked at. Well, we came out of the pandemic and immediately sentiment went completely bullish. And we dropped down to this, what I call extreme optimism state, the lowest on this whole 10 years, and it lasted for like a year and a half. Then we came out of that finally when we went into the bear market of 2022. So over on the right, you can see that we got down to where I said this was the lowest on those charts before. I said it was the lowest since late 21, which is true. But here's late 21 right there. So prior to that, it had been much lower. So it's possible. And I'm not saying, again, we're still in a trading range, but if we were to break out of this trading range to the upside and, the economy was rolling, et cetera, we could drop down into an extremely optimistic state again. So I guess the real point is that the local maximums and local minimums occur at any point on the chart. Just saying that this is where it was at some previous date is not a valid reason for saying it's a buy signal or sell signal. So what do we trade when we get these? So typically in our newsletters where we trade these broad market signals, we trade SPY options, typically 1 or 2 strikes in the money, and probably 2 to 3 weeks out, maybe a little bit longer than that in certain cases. So I want the delta of my option that I'm buying to be relatively high because I'm in the business of predicting where the underlying is going, in this case, SPY or S&P 500. And I want to own a SPY call that's got a decent delta so that if the underlying moves up and I'm bullish, I'm going to make some money. So typically our deltas on the ones we're buying are up in the 60 or 70 range most of the time, or much of the time. If we're buying something perhaps a little bit longer term, like a put call ratio, some of those are longer term signals, I might buy an at the money option. But even an at the money option has a call option has a slightly larger delta than a half. And so, if this underlying moves up here, I'm going to be making money. Obviously, there's time decay, but that's always a battle for option traders as well. Just as an aside, if you watch TV, when you look at the option trading, they almost always spread. And by spread, I mean they buy a call at a lower strike, and then they sell a call at a higher strike. Ostensibly, the reason is it costs less, but you'll see in a minute that's a false reasoning. Anyways, when you do that, you cut your profit potential off at the higher strike. So if you are right about the underlying, it really takes off to the upside. You've cut off your profit potential. So really, you should only be doing a spread if the options are expensive. Now, on our website, we have a free volatility, complete set of volatility data that realized versus implied, various stages of realized, percentiles of realized, percentiles of implied. That's all free data we post every Saturday. If you want it more often, we also sell. That costs you a little bit of money to get it on a daily basis. But in any case, you can easily tell from that data whether the options are expensive or not. So, right now, S&P options are a little bit expensive, and obviously with VIX popping up here above 18, 19, that's a little bit on the expensive side compared to where they've been in recent times. In any case, this is a graph so the red line is if you just bought a call, and the black line is if you did the spread. So when these proponents of the spread say you're risking less, that's really false. You're risking 100% of what your broker asks you to put up to do these trades. So your broker is asking for the debit of the trade. You buy a call, he wants you to pay for it in full. You buy the bull spread, he wants you to pay for it in full. So if the market goes down, you've already put up all the money, and what you lose is your money, not the broker's. That's what the broker's really in the business of making sure that he doesn't care if you lose your money, but he certainly cares if you lose his money. So the lowest, the call purchase is, if this is your concern, the few extra dollars that you don't put at risk, even though it's 100% of all the dollars you have in the trade, then only buy, let's say, 4 calls instead of 5 bull spreads or something like that, because having this upside available to you is really very extremely important. It's something that I would say in a given year we have 2 or 3 trades that just way exceed what we thought they were going to do, and if you've cut off your profit potential to begin with, that's a big problem. Now, sometimes when the options are expensive, you can mitigate the negative effects of the spread. So there's 2 things you can do if you're spreading that you should do when you're spreading, just to keep from cutting off your profit potential way too early. One is widen the difference in the strikes. And so so there's a lot of room between the 2 strikes. So right now, in terms of SPY, we're not spreading any options that expire before March 14th. So if you're buying something next week, the 28th or the 7th or whatever, then just buy the call, forget about it. But if you're going to doing March 14th or later, then on the call spread, if you're bullish, we would do a call spread 15 points wide. And if you're bearish, we would do a put spread 20 to 25 points wide. The reason that the put spread is wider is that out of the money puts are more expensive, and the indices than out of the money calls. But this will help you, give you some decent, at least profit potential between the 2 strikes. If you don't want to do a 5-point spread, that's just killer. But the second thing you can do is roll if the short strike is hit. So what I mean by that, let's say you go in S&P's around 600 a day, you bought this 600, 620, March 21st call spread, and you're fortunate enough to see, like in the future now, SPY moves up to 620. So what's really happened at that point is that you've got your calls. This was your spread, and this is your actual trade that's happening like this. So you're about right here, and yes, there's a little bit more you could make, but not much, because this cutoff at the 620 is going to cost you. So sell that spread that you already bought, take a profit on that, and buy a new spread. Move both strikes up higher, set your whole bull spread up higher, and now you can do it over again, and you can continue to do this if S&P continues to go higher. So even though you've got the bull spreads in place, you can make more money than just the original bull spread would have dictated. On put spread, it works just the opposite. If you were to do a put spread today, let's say 30 points wide, you'd buy the 600 put, sell the 570 put, and then if S&P traded down to 570, you roll both sides down 30 points. All right, let's look at some individual put-call ratio charts because those are always kind of interesting. And what the difference, the way we treat these, so stocks and futures and indices, as opposed to the S&P broad market, is that we still look for local maximum, local minimum, but we only take the ones occurring at the extremes. So like here, there's a little local maximum there, little local minimum there. We're not trading that. We're looking for this extreme one. So here we just got an extreme local maximum. That's a buy signal. This is on the British pound ETF. FXB is the symbol. And you can see in the past, this buy signal here, which came at the time, was a very high extreme. It's gone higher now. But you can see it was a decent buy signal. Then very low down here, this low extreme was a sell signal. That worked out pretty good. So now you've got a new buy signal in the British pound, and it's already off to a good start. You got a little bit higher highs and higher lows thing going on here. Another one that you might find of interest is Netflix. This just gave a sell signal as of Friday. So rolled over to, that's again local minimum sell signal marked in green because it's new, and the stock already fell a little bit and really kind of fell through one support area. So there's a brand new sell signal in Netflix. You can see the put-call ratio signals from the extremes in the last 8 months or so have been pretty good. Now this is one that we recommended a couple of weeks ago, but I'm just showing it to you how we treat these. So this was a sell signal in EQT, again, local minimum down here. It got us out to a sell signal just right around the 1st of February. So the stock fell a little bit, then kind of rallied, and now it's just fell again on, I didn't really look at what it did today, but that was Friday's action. But this put-call ratio is still trending higher. So as long as the put-call ratio here is trending higher, then I don't really have a problem sticking with this trade, because as long as this is the case, the sell signal from the put-call ratio is still intact. If it does this and it rolls over, no matter where, middle of the chart, high chart, whatever, then that would terminate the sell signal. So once we get into these, we'll stay with them as long as the put-call ratio signal stays on its initial course. Another one recently, CMS we waited for this to break out, that's the red line here. Sometimes we combine a little technical analysis here. That was some resistance. It finally broke out over that. And so once it did that, we bought, I think that was at 69. And so we bought the CMS calls. Here's a couple that are futures. So this is the bottom chart, the put-call ratio chart here is drawn using the corn futures options that trade on the Chicago Board of Trade. But you may or may not have a futures account. It doesn't really matter. But you can look at that chart, and then you can see here that recently there was a sell signal, just like a few of the others we've just seen. This local minimum right here. But what we said at that point was there had been some support for the corn ETF. So in this case, there's an ETF that trades on the stock side of the business, CORN. And CORN actually is trading the futures, but you don't care. You don't have to have a futures account to trade CORN options. But CORN had some support right here at 20. So we're waiting for that to break support at 20 before we actually buy the puts. So it's trading almost exactly 20 right now. If it breaks down again, say tomorrow, then we would be buying the puts there. But sometimes you'll get something like this. Now this is a new sell signal in coffee. And coffee can have some tremendous moves and some really nice moves. So the bottom put-call ratio chart there is drawn using the coffee futures options that trade on the ICE, but there is no ETF for coffee. There used to be one with symbol JO, but not anymore. The underwriter dropped it. So now if you want to trade these, you actually have to go and trade coffee options, which are $375 a point. So like buying one of those is like buying 4 stock options. And it can, the leverage can be pretty destructive. That one time there was a mini coffee contract that's gone too. So if you want to trade this, you just have to buckle up and trade the coffee options, futures options that trade on the ICE. Here's a couple of others. I had these saddles. I kind of like the saddles, but we didn't recommend them because both stocks are very expensive. So this is, first one is Avalon Bay. Just gave a brand new buy signal, but it's a $200 stock. So my rule of thumb is that we don't like to invest more than 3% of the risk capital. Anybody, me, you, or newsletter, whatever, don't invest more than 3% of your risk capital in any one trade. In fact, that's actually quite a bit. I think a lot of larger funds and things might limit themselves to 2% or even less. But here you can see that this stock is kind of trading on sideways range. So you'd probably want to see it break out before you actually were to act on this buy signal. But it's a $200 stock and it has a decently high volatility, so the options are pretty expensive. So we did not actually recommend that. There's another one, Public Storage. This is a $300 stock. Again, getting a buy signal. You can see here that there would be resistance right across there. So if it were to break out over there, you might want to buy. But I don't know how big your speculative trading account is. 3% or 2%, it might still allow you to buy. I don't really like buying one option. Either you can never take a partial profit or anything like that. So we did not recommend these in the newsletter because the stocks are too expensive, but they're still valid signals. All right, so let's move on to market breadth. Breadth is simply advances minus declines. You can keep a cumulative total or you can keep an oscillator. And there's two, it's a matter of what data to use. So typically you would use New York Stock Exchange data. That's certainly valid, but there are a lot of things on the New York Stock Exchange that are not stocks. They're interest rate related ETFs and things like that. So we also publish stocks only data, and that is, we can have a great data set for that. That's all stocks that have listed options. There's over 6,000 of those these days. So that makes it very robust and a nice data set, large caps, small caps, all that kind of thing. And so we can draw an oscillator using that data, and this is that oscillator going back about 6 years. So the green lines down there are oversold territory. So most of the time the market's been bullish, and we had, yes, a couple of very extreme oversold conditions. One being the pandemic right here, and then the other, that was the December of 2018, right before the Christmas, very nasty time. And then this was the pandemic. And then we had a more consistent oversold condition during the bear market, but now we're back into a bullish market. So we, again, just frequent or infrequent oversold conditions. And since you recall, we said oversold does not mean buy. So we actually don't buy till it stops being oversold. So that was right around mid-January. We shot up into overbought territory, and now we've come back down, and we've got a sell signal in February, early February. And last week it looked like maybe that sell signal was going to fail, but now it's kind of reasserted itself again with negative breadth in the last couple of days. Today breadth was negative, not tremendously negative, but this indicator is on a sell signal. This is our shortest term indicator. So we've had it's possible for it to whipsaw. We try to use 2-day confirmations on it, but as you saw with the S&P chart, 2 days sometimes is not enough. But by and large, it's been a good trading vehicle for us over the years. Cumulative breadth is another thing, and cumulative volume breadth especially. So this is the volume on advancing issues minus the volume on declining issues accumulated daily. And we've noticed two things about this. First of all, if it's making a new all-time high before SPX does, then SPX usually follow along and do the same thing. So in the last year or so, this made a new high 30-some times, and SPX even a couple of times was flagging behind, but it did catch up and make new highs as well. But at the top of a market, sometimes it will show a negative divergence. That is not happening now. Right now, and this cumulative volume breadth made new highs just last week on February 18th, 19th, and 20th, along with SPX doing the same thing. So it was a confirming thing. And so bottom line, there's not a negative divergence. Now, not every bear market starts with a negative divergence, so that doesn't necessarily mean you can't have a bear market, but some of the worst ones have started with negative divergence, and we're not seeing that right now. New highs versus new lows is another thing we look at, and we look at not only the New York Stock Exchange, but also that's the stocks only data that I talked about, as well as NASDAQ data. But it's the New York Stock Exchange data that we use as a signal. So we got a buy signal. The last buy signal we had came in right in here on January 21st and 22nd, when we had more than 100 new highs and new lows, new highs, 2 days in a row. And they outnumbered new lows. So that was a buy signal. Our stop out of that buy signal is if new lows outnumber new highs for 2 days in a row. So they did it 1 day there, but not 2. And 1 day there, but not 2. But then this was Friday. And now today, also more new lows than new highs. So this indicator is now stopped out. It's not bullish. It's not bearish. It's returned to a neutral state. Its next signal will come when there are 100 issues on one side of the slate or the other, new highs or new lows, for 2 days in a row. But right now, the buy signal was stopped out today, and we're in a neutral state on this indicator. So let's talk about VIX volatility and the things around VIX. The VIX is a very misunderstood thing. I think our analysis of it is pretty top notch most of the time, but a lot of times there isn't too much to analyze with VIX. There's a couple of things that are important though. One, the trend of VIX. If it is trending, that's typically opposite to the market direction. So if you can discern a trend in VIX, then the stock market trade would go in the opposite direction. And secondly, spike peaks on the VIX chart are buy signals. Now, along with our theory that overbought does not mean sold, sometimes you'll see VIX get overbought, get low, that is, on a chart, and stay there for a long period of time. We've done, some studies, and if you just sell because you think VIX is too low, that can be really harmful. Sometimes VIX will stay low and the market will go up for like a year. So that's just something to avoid. Anyway, here's the 1-year chart of VIX. All these B's are spike peak buy signals. We have a trading system built around these, and the red letters are successful. The blue letters are not. And when we get a signal, it lasts for 22 trading days. So here, this signal was in effect right there, and then we got a second and actually third buy signal in that same time period. We did not take any one but the first one. It turned out the first one eventually was successful. Then here in January, VIX spiked up to 22 and change and came back down. So that gave us a new buy signal on January 27th, and that's still in effect. We haven't exceeded that point on the chart, and so we're using what we call spiking mode as our stop now. So just today, that buy signal will stop out as well, just like the new highs versus new lows. So that just occurred on the close of trading today. Now the circle at the bottom right there shows what's going on as far as what we like to look at, the trend of VIX. You can see the 200-day moving average and the 20-day moving average of VIX are very close to each other there. This is the 20, and the 200 is here. So, you know, they're right next to each other. There's no trend there. But if both VIX and the 20-day, let's say, start to rise and get well above the 200-day, then that would be a trend of VIX higher, which would be a sell signal for stocks. That might be coming up relatively soon, depending what's happening here. The market really didn't look too good today, I didn't think. But it's not in effect yet. So we don't have either one of these signals in place right now. The one was just stopped out today and the other hasn't set up yet. So these are things we watch with VIX, but in the current time, neither of those systems is giving us a signal. Now, you can't trade VIX, but you can trade VIX futures and options. The VIX options are actually options on the futures. And so one of the things we look at is what I call the construct of the futures. Here's how the futures might line up, VIX futures. If they're sloping upwards as you go out in time, that's bullish for stocks. If this happens, though, that's bad. And if there's downward sloping, that's negative for stocks. So the last time that happened for any significant length of time was March of 2020 in the pandemic, and we made a lot of money on trades based on that. This past August, it happened for very briefly, a couple of days, reversed itself back out again because I'll just back up. There was that big spike peak there in August when VIX spiked up for a few days and then came right back down. So we watch for that, and here's the current. This was at noon today. The price of VIX was 1780. And then these were the prices of the futures. So you can see the March future was trading right on the same price as VIX. Subtract 1780 from the futures, subtract it from VIX, we get 0. So no premium. But if we look at the futures contracts, you can see each one slightly more expensive than its predecessor. So the term structure is still sloping upwards. And while these aren't huge premiums, they're still positive premiums. So that's all modestly bullish. Now, you can check the futures at the CBOE website, but also the CBOE publishes volatility indices, and there are 6 of them. It has a 1-day VIX, which is really mostly useful if you're trading the 0-day expiration options. There's a 9-day. VIX itself is 30 days, then a 3-month, 6-month, and a 9-month. And you can see from these prices, they also are all sloping upwards. This one's a little bit high compared to the others, I would say, but still, it's an upward sloping term structure, and therefore that's a bullish, bullish picture for stocks. That's one of the last really bullish pictures we have. But it is important to understand that the VIX traders are really not all that worried about the market right now. VIX is not spiking up. I'm going to return to the VIX chart again just for a minute. You can see that we had that big market sell-off last August, and VIX went shooting upwards like this. Then we had the FOMC meeting right before Christmas, and VIX went shooting up. But then we had, CPI and tariff rumors, and all of a sudden VIX is not really reacting like it did before to those news items. So, I'm not going to say that it never will, but it's sort of toned down its action here a little bit. So basically, the construct is bullish, and we would only get nervous if the front month futures, which is March, trading at 1780, rose above April, which is currently 1842. So April's trading higher than May. In March, that's not a problem. If they were to invert, then that would be a problem. And as I said, there was a slight inversion in August, but that only lasted for a short period of time. So all in all, here's how our indicators look. On the bearish side, we saw we had equity-only put-call ratio sell signals, and the breadth oscillators are still on sell signals. So we really only have two that are bearish. There is no trend of VIX, and there is no VIX spike peak now as of the close. So this indicator should move over and become, into the neutral area right here. Also, new highs versus new lows. That's we saw that was stopped out today too, so that'll move over into the neutral area. But the construct is still bullish, and that old MVB buy signal is still in place. So for the most part, we have negative two indicators that are negative, several that are neutral, and really not too much that's bullish anymore. But it's still, it's up in the air because S&P is in the neutral category because it's in the trading range. So unless that moves outside the trading range, I would expect these other indicators to continue to be somewhat mixed. So just a couple of other things. So we don't have a core position because they're very, mixed signals. So the offer that we're having right now is that you can take 1 month of each of our top 3 newsletters for $99 total for all 3 newsletters. That normally would be a $728 value. You can go to this website and pick that up. You can also get the PDFs of this presentation from the website. These are the 3 newsletters: the Daily Volume Alerts, which I write every morning, the Daily Strategist, which comes out twice a day, and then the Option Strategist, which comes out once a week, but that's our oldest publication, and that has more articles in it. The others are mostly strictly recommendations. So there are track records available on our website of all 3 newsletters. You can peruse those if you want to. If you go to the actual product listing where you would subscribe to the product, you can see the track record there. And one of the things that I mentioned earlier, the strategies changed a little bit. One of the things that we used to be able to use quite accurately was the option predictions before earnings. That worked great up until the pandemic, and then it hasn't worked well since then until just this quarter. So we're using that again now. You might find that of interest, but there's some pretty big movers that we caught. We bought straddles before the earnings on Airbnb and TTD, which are huge moves, and then Roku, Baxter, and Walmart were big moves, but not huge, but they're still profitable. So I think we had like 1 loser in that group somewhere, but it was it's something now that we're going to be using on a weekly basis until it stops working again, I guess. We have a couple of other newsletters. We have a YouTube channel. And then one last point, I wrote a little article about this the other day. There are rumors, well, not so much rumors, you can see, there's huge open interest in the VIX March 23rd and 23 and 24 strike VIX calls. So that's March 18th is the expiration for those. And the rumors are that there's going to be some attempt to push those futures up to that level, in which case the market makers are going to be short a lot of delta and gamma, and they're going to have to start buying some volatility to hedge themselves, and you could get a volatility explosion. Well, the fact is those calls cost 85 cents right now, a March 24 call. You might think, well, 85 cents, that's not too bad. The index itself, the March futures closed tonight at 1831, so they're, like 33% out of the money, but still, 18 to 24 is not a huge move for VIX, so it could happen. And but they are expensive. I mean, they're, the volatility of volatility is high, let's say. So if you need to get in touch with me, there's my contact information. If you're interested in our money management, this is the website. I will say that our minimum account size is $100,000. So Jeff, can I turn it back to you? Do we have some questions?
Yeah, I was going to ask you for the coupon code, but I just got it. So we did have a question from Kenneth, though. Kenneth wanted to know, to what extent does the market maker hedges move the underlying market?
Well, normally not much at all, but as I just pointed out in that one scenario there, where the market makers are short a lot of volatility, and of course they could be long hedges on that, which we don't know anything about. And so, getting the volatility up to that level might not really do anything. But everybody remembers in February of 2018 when there was a big short volatility position, and basically a couple of the large market making or trading firms ran the futures, and it made volatility explode. And everybody that was short volatility got creamed, and everybody that was long volatility made a lot of money. So they're kind of hoping, those same guys are hoping that happens again. I don't really know, but market makers are not stupid. And if we're talking about this, they obviously realize it as well. And I'm sure they have some ways that they're looking to hedge their risk. So market makers typically are not a market mover. And sometimes contrary to the market, because their hedging activity will reduce market volatility, but not always. But I would say in general, market makers are not a problem as far as causing market dislocations.
Cool. That was the only question. I've got the link up, optionstrategist.com/metastock. The coupon code for that is 3NL99. Larry, thanks for joining us. Oh,
all right,
we have a last minute question if you're still here.
I'm here.
Oh, okay. Frenchie wants to know where is the McMillan oscillator?
I don't know. I don't follow the McMillan oscillator, but it's probably similar to ours. So our oscillators are now moving down into negative territory, heading towards maybe being oversold.
Thanks for the question, Frenchie. Larry, thanks for being here. I appreciate it.
Okay.
Yeah, you bet. All right, okay, go ahead and do this. All right. Getting everything kind of translated over or moved over. No translation was happening. I do want to say thank you to Stocks and Commodities Magazine for the sponsoring of the event. I remember, it was about 10, 15 years ago, I called up and I said, we're going to do all these events. We're going to do them online. We're going to bring in guest speakers. It's going to be awesome. And at that time, we were just starting a 1-day, 8-session multi-speaker, and they've been on board ever since. So they do a really good job. It's a great magazine. If you don't subscribe to it, obviously you've been here all day, or maybe you've been here all day. Maybe you're watching the YouTube in the future. But you understand there's some value to learning about the markets. You understand that you're either probably getting better at what you're doing or worse. I don't think there's a lot of neutrals in this life. And I just think by getting a magazine every month that talks about different technical strategies is a good way to ensure that you're continuing learning and continuing to get better. So if you want to subscribe to them, www.traders.com. Great magazine. I've been getting it since I was hired here 27, 28 years ago. Traders.com. Thank you for the sponsorship, Stocks and Commodities. We appreciate it. So, of course, we're Metastock. And, of course, Greg, we're going to give away a prize right now. And it's going to be the last prize of the day. Do you know what that means, Greg?
Do not know what that means.
It means it's going to be the Metastock prize.
Oh, the best prize of the day.
Yeah.
That's what that means.
I'm going to rely on you a little bit.
Okay.
To do my job.
Okay, well, all right then.
All right. So we're going to give them 3 months of Metastock Zenith. Could you tell them what that is? Tell everybody
Metastock Zenith is, let's see, how do you always put it, Jeff? A multi-billion-dollar project by Thomson Reuters, formerly Thomson Reuters, now LSEG. It is pro-level trading. I'm not doing a very good job. pro level trading interface and system for active traders just like yourself. Even though it is pro level, it is not pro level pricing, and it's probably the best thing a private trader can get for their market analysis.
You did
Is that
fine.
better? All right.
Yeah.
I don't have that elevator pitch down like you do.
Yeah. Well, we're practicing. How about
I'm
Metastock? We're going to throw in 3 months of Metastock. Do you know what that is?
Yeah, I've heard of Metastock. It's been around. It's been around for what, 30 years now? It's been around for 50 years now. 31 time winner of the, oh, you got it written right there. Stocks and Commodities Magazine Reader's Choice Award. It's, again, just about the best thing you can do if you're a private self-directed trader, like many of the listeners right now are. And it's great for charting. And for anybody that asks themselves the questions, things like, I wonder what I should be trading today, or I wonder how I can test my trades before I spend my first trading dollar, or I wonder what the experts would say about this trade setup I'm about to get into. It's great for that sort of stuff.
Great job. I'm going to take some notes.
All right.
We're also going to give away, and I'll have you talk about this, and I'll get my spreadsheet really quick. We're going to give away 3 months of Learn Metastock.
Oh, that's good. Our old friend Kevin Nelson.
Yeah.
Very good instructor. Very well reviewed.
Yeah.
And he was a pretty good boss for Jeff too, I think, and coworker for me.
Above average.
Above average. Yeah,
Learn Metastock is a resource that we kind of rely on heavily when we bring on employees. We just brought on a new support guy. He's going through Learn Metastock. He's learning how to use Metastock. It's a service. It's only about $99 a month, and it's really kind of a service that's designed to show you how. It has hundreds of videos up there. Not just Metastock. They'll talk about technical concepts and that kind of stuff, but Kevin does a really, really good job with it. And we're going to throw in 3 months of that as well. If you have been using Metastock for a while, or if you're brand new to it and you want to learn more about Metastock, Learn Metastock's a really good way we could kind of help you with that. And we'd even do a 3-for-1 on it. So you're going to get Zenith, you're going to get Metastock real time, and then you're also going to get Learn Metastock if Mr. Lewis makes you lucky. So Greg, what I need from you is a number between 1 and 6,757.
Okay, I've already pulled that from the Google random number generator, and it is 5839, 5,839.
Okay, and that is James C. Still in the US. We did not get out of the country today. It's also a Gmail account, so very much a Gmail day, except for that Earthlink guy. Thank you very much for the assist, Greg. Appreciate it.
Absolutely.
All right. You also could get Metastock. We talked a lot about Metastock today. It's been rated number 132 years in a row. This slide needs to be updated just a little bit. But if you buy a month, we'll give you the second and third month for free. Pricing on that starts at $75 a month. With that, we're going to spend some time with you. We're going to sit down with you. We're going to show you how to use the program, how to run scans, how to set it up. They'll answer any questions that you've got. You'll have unlimited access to our tech support team. You'll get tons of training to kind of help you get going. And so for about $25 a month over 3 months, you can evaluate the software. If it's not helpful for you, you can cancel your subscription. But I hope you stay on. I hope it's helpful for you. I hope it's something that you continue to use. A lot of our customers, as well as our employees, have been with us for decades, and we really appreciate that. So any of the offers we've talked about today, you can get at metastock.com/conf promo. You can call us at 800-882-3040. You go to metastock.com/sales chat. So Greg, thanks for the assist. Our next speaker is Jody Samuels. Jody's been in our on our
Jeff,
events number. Yes.
Jeff, our next speaker is you just said.
That's right, teacher.
He's probably not listening. It's okay. Don't worry.
Well, it is the end of the day. So anyway, Anka's been on our presentation a number of times. We absolutely love having her. She's going to talk today. So Anka, let's bring you on here. Can you hear us okay?
Hi, Jeff. How are you? It's been a long day for you guys.
Yeah. But there's no mistakes that have been made. I promise.
Of course not.
Let me go ahead and make you the presenter. My mistake.
Okay. Thank you.
No problem. So you're going to finish this out. And I just sent the thing over to you, so I should be able to tell you we can see your screen in a second.
Okay. I don't know. Let's see. Where is the share screen? Okay, share my webcam, sharing. Not sure I'm sharing what I'm supposed to share.
Okay, let me go ahead and I'm gonna pull it back.
Okay.
And then I'm gonna send it back because it pops up and says, "Do you want to share?" And then if you hit yes, it makes it very easy for you. And I did see your screen come up for just a brief second.
Yeah. How about now?
Perfect.
Yay.
Yeah, it works. First try.
All right. Awesome.
All right. Thank you, Anka.
We're going to swing into profit.
It's all yours.
All right. Thanks so much, Jack, and thank you for organizing this super mega event. Are you kidding me? It's like this is going to be a real gem. So far, like 5 or 6 days of trading education. This is insane. All right, so welcome everybody. My name is Anka Metcalf, and we're going to dive right in. We're going to swing into profits in 2025, and I'm going to share with you why swing trading is my preferred style of trading. So let's get started. For those of you that do not know me, and I see a lot of new faces in here, my name is Anka Metcalf, and I am the CEO and founder of TradeOut.com, which is a trading education firm that is specialized into educating individuals how to day trade, swing trade, and invest in the market. I have been a professional independent trader for over 20 years. I come with 10 plus years in investment banking, and I run 2 services, very successful services from my members' standpoint. So I run the Stock Swing Trader, which is the oldest service with Trade Out Loud. It's over 14 years old. And it is focused on swing trading and also a little bit about active investing. We will run a full investing program into the end of this quarter, so at the end of March. And I also run a trading room for futures that I have been running since 2017. And I have to say that this caught me by surprise because I didn't realize there are so many traders out there really interested into generated income in the power hour. And also I do offer education for swing trading, day trading, and we're going to have a brand new program for investing coming up soon, like I said. And I do specialize in high velocity trades. And we're going to explain a little bit in this presentation what a high velocity trade is. I'm also a designer of an institutional proprietary trading system, and the reason why I'm the designer is because I cannot take credit for everything that I know and that I have learned about technical analysis and setups and everything. So I did have a lot of mentors, and I did have a lot of prep time before I even started trading.
All right, Anka, I think we lost your audio. Oops. Anka?
Jeff, I also don't lost audio for Anka, so I don't know what's going on.
I can hear you. So
she's still saying her mic is active.
Yeah. Okay. Let's see. All right. Not sure exactly what to do. Let me give her a call.
I'm not either. Anka, if you can hear us, you might want to what?
Oh, the best way to fix it is if you can hear us, unplug your microphone and plug it back in. What I can do is I can actually do this. And then I'm going to send her an unmute request. I do see she's still connected.
Yeah. I think it might be an internet thing. That's been the problem in the past.
Okay, Anka?
I still don't hear her either.
All right. Yeah.
And I don't see the little speaker next to the icon, so I don't think she's coming through to GoToWebinar.
Let's see. I see the speaker next to the icon. Oh, yeah. Like, yeah, I see what you're saying.
When she's talking, you know she is, because the microphone turns into a speaker icon. Anyway, this is information that probably our listeners don't really care about. I wonder if she's listening, if she logged out and logged back in. I should say signed out and signed back in to GoToWebinar. Would that be a good thing?
That always does help. I'm actually looking for a phone number right now for her, so I can give her a call. Give me a second.
Sure.
Greg, tell a story. Go.
I'll give you all the time in the world. I'm nothing but time, but the people listening right here may not be the same. So everyone, we do apologize. There does appear to be a problem with Anka Metcalf's audio video. This is something that's utterly out of our control since we go through GoToWebinar. So it could be several things that probably are not Anka Metcalf's fault either. We do ask that you please go ahead and give us another minute. Oh, she may not be aware, Jeff, because she just advanced her slide. She may be just going on thinking she's just fine.
I see that. Okay. All right, hold on a second. I'm working.
I wonder if you kicked her out of the room. That'd probably get her attention. Again, we do apologize. Our current presenter, Anka Metcalf, is having an AV issue. She's apparently not aware that she's having an AV issue because she does appear to be continuing with her presentation. So please bear with us while Jeff figures out what's going on. I have nothing to offer to the situation other than I think Jeff is trying to contact her now via cell phone to let her know what's going on. While we're waiting, I could mention that we are having this is only day one of our conference. Tomorrow we are going to have the second day of the conference. I'm not going to share my screen to show you this because I don't want to mess this up even more than it is right now. But tomorrow's presenters, Daniel Sinning kicks it off. Next will be Fausto Pugliese, I can never say his name. Next we have Martha Stokes, CMT, always a great time with Martha Stokes. Then our very own Kelly Clement will talk about powerful trading tools for today's market. Kelly Clement is the CEO and president of Metastock. I don't see any. Okay. Then next we will have Dan Passarelli and John Seville and Melissa Armo, and finally Silas Peters. If you have not, finally Rob Booker. If you've not yet registered, well, if you listen to this on GoToWebinar, you don't really need to register. All you need to do is keep on keeping on because you're already registered. If you're listening to this and watching it on YouTube, and you do want to be eligible for the door prizes that we give away between each of the speakers, go ahead and go to metastock.com and click on the banner on the top, and you will be offered a chance to register, and then you'll be eligible for the door prizes, and you also receive emails from me.
Quick sound check. Greg, sorry to interrupt you. I just want to know if you hear me.
No, Anna, you're not interrupting me. Quite the contrary. I was sweating bullets until they came back. Okay, we can see you.
Can you see my screen?
I can see right now it says, welcome to the future of wealth creation. It looks like you advanced a few screens. We honestly lost you after, I think, the first slide.
Okay.
I'm not sure how far to tell you to go back. You are the last speaker today. So I don't know, Jeff.
Okay. All right.
Yeah. And before you get going again, I do want to say that Reginald in YouTube chat said Anka has an awesome teaching style and lots of time to execute trades. So you got a nice compliment while we were waiting.
And thank you for the lesson in lengthening time and trying to entertain on your back of your heels. Right. Break a leg, I'll get out of the way.
Thanks, Greg. I appreciate that.
I'm not going to touch anything anymore, so I'm just going to continue from here. Okay, so thanks so much, everybody, and sorry for this tech issue. I mean, trading is a lot easier than having to handle tech. And this is just my opinion. All right. So I was talking about how much money we need to retire. I mean, have you really answered yourself? Like, do I have enough money in retirement? Am I able to maintain the same lifestyle? Well, here's an interesting fact. Investors feel that they need an average of $2.5 million in retirement to maintain their lifestyle, according to a Legg Mason survey. Well, that's about 2.2 million more than the average balance of 385,000 those individuals actually had in their 401k and IRA accounts or similar plans. This is so wild, right? So welcome to the future of wealth creation, and get ready to unlock the fastest and smartest way to grow your money in 2025. And there is no surprise that swing trading is my preferred style of trading. So the hidden wealth secrets for the top 1%. I'm going to be revealing how I identify my trades and what kind of trades I'm looking for and how the selection criteria is and how you can get started swing trading, even if you're just looking at the market right now, contemplating whether or not you should get into trading, or you're a day trader or you're a swing trader. Well, swing trading is something in between that we're going to talk about in a few seconds. Swing trading is the key to multiplying your money with precision. So remember what Warren Buffett said: if you don't find a way to make your money work for you while you're sleeping, you will work until you die. Oh my gosh, that doesn't sound very good. So let's start making money. Even if you have a full-time job, when you're on vacation, because money never sleeps, or anywhere in the world, as long as you have access to an internet connection, you can manage your money better than any professional, because there are huge fees that are involved with long-term money hold in our 401ks. There are monthly management fees that are approximately $300 per month. And what that means is that at the end of the year, you would have donated to the fund manager around $3,600. Well, that times 30 years, that is $108,000 in management fees. I don't know about you guys, but I do not want to donate that money to my portfolio manager. Funds do not care if we make money or do not make money. We are just an account number for them. And as soon as you open a 401a account, they automatically distribute your money into a fund. So avoiding pitfalls, and here are the 5 mistakes that cost traders thousands. Mistake number 1, chasing the wrong stocks. Trade the right stocks, not the hyped ones. So stay away from the water cooler discussions that are on media or on social media. Mistake number 2, over trading and burning out. When you're having the market in the context in which we have it right now, it's still range bound. When you're looking at the Qs, you're looking at the SPYs, when you're looking even at the Dow or Russell that have a little bit more weakness into it, they're still massively ranging and they still don't show a clear direction. Look, more trades does not necessarily mean more profits. You're actually burning your R's. You're burning your risk level. Learn the power to be patient, because when you're patient, you're actually analyzing the market and you're like a sniper looking for the next best trading opportunity based on the setup that is provided, of course, by the market. Mistake number 3 comes trading without a plan. You take random trades and therefore you're going to have random results. You need a proven strategy, and actually a very simple strategy. When you're just starting out trading, you should look for the simplest strategy, a strategy that resonates with you, with your style, and just apply that. Yes, you can make money by just applying one strategy. You do not have to know gazillion of strategies in order to make money in the market. A buy strategy or a breakout strategy is gonna really put you out there, and it's going to produce more profits than losses by mastering just one. And this is mistake number 4, letting emotions control your trades. We're talking about fear and greed that are destroying accounts. Here's how to stay disciplined. Have a solid money management plan. Determine how many trades you are going to take in a week. Determine how many trades would you like to have per month. And that is in accordance with the market bias, with the market environment. Because even if I have a plan, let's say, of taking 10 swing trades in a week, but if the environment is not right, I will refrain myself from getting into the market. And mistake number 5, not investing or trading in the right, not investing in the right education. Most traders fail because they go in blind, and they don't know what the risks are. They don't know, how to calculate a target, how to calculate a position size, how much risk they need to apply per account. They don't know how to trace the target. They don't know how to trail a specific trade. Oftentimes, when they see a little bit of green, they take themselves out of the trade unless they know otherwise, because in reality, the market needs to take you out of the trade by trailing, by price action, and you shouldn't be exiting the trade based on emotion. So the reason why I like swing trading is like DIY wealth. It is a self-directed style of trading, and trading and investing is all about taking control of your financial future and managing your own money. And yes, emotions are great because sometimes emotions give you the best clues into the market. And whomever is telling you that you should eliminate emotions from trading is wrong, because emotions are never going to go away. Emotions and definitely money is the most precious commodity that we have, right? And when money is involved, your emotions run high. Nobody can do it better than you do. So if you learn how to trade, you will actually master the skill, and it's only going to get better. Make your money work for you is the biggest objective, and should be the biggest objective of your life. And not only that, but instill this skill. Don't keep it for yourself. Learn your kids how to do it, your nephews, your nieces, etc. So definitely is something that you have to discuss with your family and get them involved so they understand the process of trading. For me, swing trading is also a channel of generating more cash flow. It's a channel of generating and supplementing what I already make into day trading, because income, what I generate from day trading, goes into my swing trading account, and then it goes into my a wealth account. It goes into my investing account. So again, whatever you're generating, whether it is from your job, my job every day is to trade the power hour in futures. I only trade for about an hour and a half every single day, and that's not necessarily, staying in the trade that long. Usually my trades are super quick, and of course they're in relation to the environment, in strict correlation to the environment of the day. But what I make from that is my primary job, and that is my ecosystem per se. So my day trading job is to generate income to pay my bills, and to produce enough so I can put into my swing trading account into my investing account. This is how you become a money magnet. Now let me share something with you. You do not need to be a math whiz in order to get started in trading. You do not need to have a finance degree in order to swing trade, and you do not need to know fundamentals. As long as you know when the company is reporting earnings, that is actually the extent of the fundamentals that you need to have if you're a technical trader. And it's all about having consistency in your trading. Now, I'm going to get deep into swing trading, and I want to share something with you that is going to be mind-blowing. Do you guys know that every year, and that is every year, stocks will move for about 20-30%? That's right, maybe more. So this is insane, knowing that a stock is going to move 20-30%, maybe more. Do you guys know how much percentage you're going to get by being invested with a firm? Well, that's about 7 to 10% if you're lucky. And we're talking about 20 to 30% every year. But wait, there's more. This is happening a couple of times per year in cycles. And the best part about it is that you can go long and you could go short. If you have a retail account, you could go long, you could go short. You have a longer term account where you can't short, you can use inverse ETFs. Let me share some of the cycles with you. So for example, in this cycle that started last year, November of 2023, all the way into this high until we had the sell pattern in the ongoing trend, you can see here that the Qs have generated 26%. So this is cycle number one. The pullback occurred back to the 20 SMA, the rotation happened, and as you can see, the cycle number two is on its way, it was on its way and produced another 20%. Then we had the pullback again. Then we had the rotation, we have the buy again, and this cycle again generated about 24%. Now I want to get to real chart analysis here because it's easier said than done, and I want to show you that we're possibly looking right now at a pullback period again where the next cycle of buying can be lining up. So this is a daily chart of the Qs. Right here I was sharing as well the weekly chart of the Qs. So the daily chart of the Qs shows us very clearly that we have the Qs in an ongoing trend. We have higher highs and higher lows, plus we have a massive level of support into the $500 area, which is a whole number area. It's a psychological area, and it's also an area that has been revisited back here in July of 2024 of last year. So this prior pivot high is holding the weight of this whole entire activity that has been going on since November. So right now, this is on high alert for myself to actually watch day-by-day activity into the Qs and see when we're getting that rotation. So an early sign of rotation would be tomorrow if the price is going to get over $530, and this will have the possibility of getting the price back into this double top formation. Now, when we're looking at a weekly chart, you can see here very easily that this is just the starting point. Now, this is the weekly chart, and by the way, this candle right here only represents 1 day of trading activity, so we can't talk about the weekly in that sense other than breaking out over 540 right here. But this is very interesting. When we're looking at the SPYs, for example, we're going to go to the daily chart, still ongoing trend, still multiple high grind over here in 610, 611, and this is just a pullback. So just wanted to show you that if we're patient to look for these pullbacks that are happening in the market, whether they happen on the daily chart, whether they happen on the weekly chart, we can potentially, pre-forecast when the next cycle is going to happen. So it is an amazing opportunity for the market. Every single time the market pulls back, it's showing us that the cycle may be getting ready to start again. So I want to give you another example here. This is the SPYs, and this is the weekly chart. And you can see here, this is the cycle that started on in January, towards the end of January. And in fact, it pretty much wrapped up right here in October. And this is actually the high into that $610 that we talked about when I showed you the current charts. That established a really big plateau right here. Okay, so not only that, but for example, the stocks are continuing to generate even more than the Qs and the SPY. So for example, we have here WHR Whirlpool, and this is a shorter term swing. Shorter term swings are the best because they are being generated on the daily chart. This is where I like to generate all my swing trades, and I like to look for ongoing trends for rotations that can push the price higher. And here we have the rotation that is happening, and you can see 3 bars up back into resistance. And again, it happened in a matter of days, and this was close to about 20% move. Let's talk about another stock that I highlighted at the beginning of the year. We actually hosted an event with our regular annual event at the beginning of the year with the forecast, with the 2025 forecast. And we identified this stock with the potential of a massive rally. Now, as you know, this is the Federal National Mortgage Association, FNMA. We called the price at $4.50. And as you can see here, this stock in literally 1, 2, 3, 4, 5, 6 days generated 63%. Now I have this stock into my investing portfolio. I also like to swing trade this, but I think this is going to be a really good stock to hold for 2 to 3 years at least. Now, money managers and hedge funds live mostly off commissions and fees. It's no surprise. I shared with you what the fees are like, and I'm pretty sure a lot of you guys in here know that the fees are super high, and of course depends on the fund manager. And the reality is that we are just an account number for them. So whether the stock or the fund is performing or not performing, or the market is crashing, you know what? They get paid their commission. So we're suffering if the market is down. They're not hedging for us. Most of these companies are not hedging for us, especially if you have your money parked in a fund. That's it. They're locked there, and you have to live through the pullback. As swing traders, we don't have to live through the pullbacks. So Barclay Hedge reported that over the past 5 years, the average hedge fund in its universe produced a net annualized gain of 7.2%. That's what I was telling you guys. You can make much more by trading your own accounts and obviously learning how to trade. That's why we're all here. So new report finds almost that 80% of active fund managers are falling behind the major indices, right? It's not nice, it's not great, but it's happening, right? So I'm going to share with you some trading ideas that I, scanned right before I came into this presentation. And these are some ideas that you can run with and actually, watch and see how they develop. I have noticed within the last 4 to 5 days, some relative strength coming into Lululemon. Now, this is the bar that actually closed today. And although it didn't cross much above this resistance, above this support here that is creating the minor resistance at this area, it is on high alert, on high watch, because it could potentially reverse higher. And if it reverses higher, it has the potential to go back into these prior highs. And as you can see, this is the support zone into the $350 that can serve as our stop. Another example is Starbucks. Take a look at Starbucks and take a look at the consolidation that we have here. It has been going on for almost 3 weeks into these highs. Of course, every single consolidation is a sign of the price action that is compressing and ready to break out higher. Now, sometimes when you have tight bases like this, you're going to see probably a shake and bake. When this happens is that usually funds are doing a forced sell to the downside because they want to grab more shares than a regular retail trader. So what they're doing is they're shaking out the retail trader. They're pulling the rug from the retail trader so they can get their hands on more shares so they can pop up the price. So in this case, you could have a hard stop or you could have a soft stop. You could have a wider stop. So it's, based on risk tolerance, what kind of stop you need to use. So in this case that I see here, because the stock already had reported earnings, I think that it makes sense to use a softer stop. And especially today when the Qs are down more than 1%, to have Starbucks, that is a NASDAQ stock, is under a NASDAQ, and to perform the way it did and actually closed over 1.6% up, this is a picture of relative strength. So side by side, Qs by, this is a picture of relative strength. Now, swing trading is the most effortless style of trading because it doesn't require for traders to sit in front of the computer all day. In fact, you could actually perform all these, the analysis by placing alerts ahead of time, using a scanner, or scanning your own trading universe that shouldn't be, let's say, wider than, let's say, 20 stocks or 50 stocks at the most, but be diversified and don't have only tech stocks or have only semiconductor stocks in your watch list. So be diversified. All you need to know is, but all you need to know and respect is the rules of the game, because you need to be patient and wait for the setup. Remember that if you're buying on support without a valid trigger, it means that basically you're buying into the last safety net before a drop. So I never buy a support without a confirmation, and my confirmation comes from a daily rotation or a weekly rotation that is a little bit more potent. It's not about the trade as much, but it's about the risk and risk management. So what do I mean by that? Risk, because you need to determine what your risk per trade is and position size for that risk, because it's way easier to come out of a losing streak if you respect the R's. And management, like I was saying earlier, you need to let the stock or the ETF trail you out. Price action needs to determine that action and not yourself, not taking yourself out of the trade. So when you take yourself out of the trade, you're trading on emotions. So you want to alleviate those emotions, and you want the price action and the market decide that for you. So why is it important to get started? Because the money that is sitting in our trading account right now is losing its value every single day due to inflation. And by the way, volatility and inflation, clear signs that they will continue, throughout March, throughout April. So who's swing trading for? So I do get this question a lot, and say, hey, you know what? I have a full-time job. Am I, a good candidate for swing trading? Absolutely. Busy professionals who want to manage their own long-term money and their trading accounts definitely can do that. Part-time traders who do not want to sit in front of their computers all day, or retired day traders, retirees, if you want to supplement your income or your pensions, individuals of all ages who want a better tomorrow, investors looking for faster returns, because you could very well have your money parked into an investing account, and you could have that money work for you. And I do have some stock that I absolutely love, because whether the market is up or down, I really don't even look in my investing account, because I know I'm collecting the dividend and I'm reinvesting the dividend. And even if you get a market pullback, I'm just going to buy more. Some of these are, for example, VOO or NVIDIA. I have Broadcom that offer really good dividends. And even though the market is not performing, the money is going to be working for you. You also have entrepreneurs and business owners that don't have time to sit in front of computers all day. Swing trading is also a great option. A lot of times people are asking me, okay, how do you select your investments, and how do you select your trades, and what trades do you like, more than others? Well, aside from looking at a scanner or scanning through the market, you could always look under your bank statement, and you're going to find out where you shop and what you do with your money and where your money goes. And if those companies, are doing pretty well, then that means that, it's worth taking a look at that company. So for example, I like Costco. I shop at Costco every week, and guess what? Every single time when I go there, the parking lot is the zoo. It's literally packed. So I know that company is doing really, really well, right? So of course, Costco is going to be one of my favorite stocks. If you shop at Target, Target is going to be, again, your preferred stock to watch, and, just take a look around. Are there a lot of people in the store? Are the parking lots full? And that's a good determination how that company is performing. So how can you get started, swing trading? Well, first thing, and your first step is to, obviously, before even step one, get your trading education. So do a lot of research. Technical trading is it's not hard, because it's factual, and it's so obvious, and you have certain areas that you need to watch for. You need to determine whether you have an uptrend or a downtrend, and it's easier to stick with the trend. So there are certain rules, but after you're done with your education and collecting information about trading and compiling a trading plan and writing down a trading plan of what and how you need to trade, then you open a trading account. You have multiple options here, and I'm not affiliated with any of those, but you can choose Robinhood or Schwab or TradeStation or Fidelity or Tastyworks. And it depends on how you like, for example, one broker or another. So for example, TradeStation is such a phenomenal platform. However, and broker, right? But it is so hard to use, and because it's hard to use, you're not going to see me using it. So I'm going to go with Schwab, right? I've been with them for, I don't know, maybe 15 years or so, maybe more. The second step is to determine what your risk per trade is and your risk tolerance, because for example, you could have a really big trading account. You could be trading your retirement account, for example, and you may not feel comfortable of risking 2% on a trade or even 3% on a trade. And remember that each week you are going to allocate yourself at least 7 trades that you're going to be selecting from or taking. So you're going to multiply that to times 5 trades or 7 trades or even 10 trades. And I'm going to tell you right off the bat, there are days where, and weeks rather, that I'm going to find 10 trades or even more, and I'm going to be getting in these trades. And there are going to be weeks in which I'm not going to get in any trades because the environment is not right. So for example, my personal risk for the trade is 3 to 4%. So that's how much I risk for a trade. I have been doing it for a while. And when I'm swing trading, I'm risking more than for day trading. When I'm day trading, I typically risk 1%. I don't go above 1% because it's a lot more riskier in the sense of R. So I'm allowing myself 5 trades in a day. So that's 5%. And that is per day. So that is 5% per day. And for example, if I have like, let's say, 5 losing days in a row where I max out into my risk, you can imagine that is definitely my risk tolerance. So I was telling you guys about the risk tolerance. You can have a really big account, but you cannot stomach the 2% or you cannot stomach the 3%. It's fine if you go down even to a 0.5% or to an amount that is more suitable for your risk tolerance. You have to be very comfortable with your risk tolerance and also with your goals. The next step will be establishing your game plan. Remember what I said about creating that trading plan with that one strategy that is going to be your major focus. I, for example, like breakouts and breakdowns. I look for stocks that are on the verge of breaking out, just like I showed you in Starbucks, or stocks that are breaking down depending on the trend. Also, I look for buy setups or sell setups within the trend, depending on, again, the trend, whether if I'm going to go for a sell, if I have a downtrend, I'm going to go for a buy if there's a strong uptrend. But I'll look for confirmations in the trend. So that means I look for the total rotation of price before I engage in any kind of trade. So I look for all clues, not only that it's sitting on support or on resistance for a short, but I look for the confirmation to see if the price action is ready to trigger for me or not. And of course, this trading plan is going to lay out where I'm going to enter the trades, when I plan to enter the trades, where I plan to place my stops, where I plan to establish my targets. And obviously, targets are very easy to establish. All you have to do, there's no magic formula in that. All you have to do is look to the left-hand side of the chart and determine the prior highs if you're taking the stock long, and prior lows if you're taking the stock short on the time frame that you're trading. And if you don't see the targets on the time frame that you're trading, just zoom out, go to a wider time frame. So for example, go to a weekly chart. If you're trading and doing your analysis on the daily, if you don't see any targets, go to the weekly or go to the monthly. That is going to help you a lot. And also, if you have a stock that is trading at all-time highs, a good idea is to use fib extensions and determine what those targets are according to that fib extension, because institutions and algorithms look at those levels and they consider those levels. Also, another thing, determine your risk. We talked about the risk. See if you're in the category of 2% or less, or even a little bit more than that, depending on your risk tolerance. Step number 4 is to create a trading universe. Now, here I have a quick example, but you can have it diversified. For example, you could have a home builder, then you have a semiconductor stock, then you have a pharmaceutical stock, then you have, let's say, a consumer cyclical stock. So have a trading universe of about, if you're just starting out, 20 stocks is more than enough, because you need to have a focus on those stocks. And remember, when you have a watch list, do not keep it like this. Make sure that you have a screen where you have all these charts that are going to be in your universe, because when you pop up that screen, you're going to see if you have a daily rotation to the upside or the downside, and it's going to show you the pattern right away. So when you pop up that screen, you immediately see in less than 30 seconds if you're going to have a trade or not. So it's so super simple. You don't have a trade at that, so you don't have that confirmed rotation. You're shut your computer down. But if it's getting ready for a trigger, just make sure that you place an alert so you don't miss the trade. So that is a very helpful tip. Don't have it on a list or don't have it on a piece of paper. Just have it on your screen. Have all these stocks on the screen. And trust me, it's a lot easier if you have a window on your screen with all of these stocks, even if you have only 10 stocks or even, 6 stocks if you want to watch, on a regular basis, because you don't have to go through stock, type in the stock, look at the stock, look at the patterns. No, it's just like you pop up your computer, you pop up your layout, and you're going to see them right there. And step number 5 is definitely to create the strategy. Like I said, I like to trade breakouts and buys or sells depending on the trend. So again, the trend is always going to be your friend, and the dominant trend is always going to affect the underlying stocks. And especially if you have a very strong, index, for example, like let's say the Qs that are leading, then you're going to look under the hood and say, which is the strongest, which is the leader, who is leading here. So you're going to go through the stock, through the sectors, and see which sectors are leading and which stock within the sector is leading. Counter trends are fine, and I've done quite a few counter trends in my trading activity. However, these are very short term. I want to remind you some of the examples from stocks that have gapped down. A couple of years ago, let's say FedEx, gapped down and had a really impressive gap. That was another trade that we actually had a massive win on. I can't remember. I think it was like 15 R's into that trade. So these are good opportunities. Now, what happened with FedEx can happen with a lot of stocks. So don't fear if you see a stock and say it gapped down. Look at the location to where it gapped into, because odds are that it gapped into support, that the price action is going to try to develop support into that area, secondary support, and then it's going to try to rotate. And then it's going to start with a counter trend. That means like a short squeeze that is going to take it back into the highs, or try to go to the next area of resistance. So what stocks to trade? Again, like I said, look through your statements, your bank statements, and you're going to find a lot of stocks and a lot of stock ideas in there. Definitely. One of them would be like Amazon for myself and Costco. Another stock that I would trade, for example, would be Google, right? I'm using a lot of Google Chrome. So again, look through your statement. You're going to find a Dropbox, another one. Okay, so look through that. So let's talk more about swing trading 101 and exactly drill in on what you need to look for in this strategy. So swing trading is the sweet spot between day trading and position trading. That is investing. It generates high probability trades, and it offers the best chances of success. That is that means the best return on your investment. Swing trading positions can be held from about 2 days to a couple of weeks, but they can extend a little bit longer depending on the trading environment. Because, for example, we have trades from December and from January that are ongoing, and that is because the market has been fairly sideways. In focus timeframes and timeframes where I scan for entries are the timeframes are the daily and the weekly charts. And also position trades, if you have a larger time horizon, like a little bit longer term trades will be held from a few months to a few years. I showed you the example in FNMA. And it focuses on higher time frames. Obviously, I'm using the monthly charts, the quarterly charts. Quarterly charts are extremely important for me, and they show massive clues as to where the prices may go, and of course, annual charts as well. Do the analysis. I usually scan through these quarterly charts on my favorite stocks, on my favorite and stocks that I have in my watch list, and I place alerts so I don't miss a beat. So swing trading and investing captures a portion of the swing from the low to the high, or from the high to low, and if you're shorting. And it's all based on technical analysis. I don't pay much attention to fundamentals. So swing trading is not about capturing the entire trend. It's impossible to do that. It's all about finding the best possible entry opportunity and profiting from the stock's momentum, up momentum or down momentum, whether it is long or whether it is short. Swing trading is really the simplest strategy where you enter the trade when the price breaks above a pullback reversal pattern and breaks above a range, also called a buy setup or a rotation. The key here is to know where to enter exactly these upswings or downswings and identify that sweet spot. What is that trigger point, and banking on the profits before the market turns around. So basically, when you're looking at a setup like this, this is the pullback process, this is the rotation process. You're never going to be able to nail the very bottom or the very top. Not unless you're a day trader, in which you have a strategy that is focused on that. But you're going to be looking for this core part of the trade. And some of the most, and not some of the most, but the most important elements of the trades are the entry, right? Because that is the time when your capital is at risk. The stop, because that is protecting your capital. The targets, because that is how you're getting rewarded if the trade is a success. And of course, the position sizing, which is share sizing, which is essential, because the secret to succeeding in trading is to apply the same risk on each and every single trade and position size for that risk. Here's an example of a breakout strategy. This is a trade that I've done. So this is the entry. The break is coming above this whole entire congestion. The stop goes below, and you can see here how beautiful the price action is moving higher. And again, apply a trailing strategy of your liking, but apply a trading strategy that is going to keep you in the trade longer, especially for swing trades. So oftentimes, a lot of the swing trading trailing strategies are a little bit different than the day trading strategies. So how to select winning stocks? Okay, so it takes a proven strategy to select high odds trades, especially swing trades and stocks and ETFs that you want to either swing trade or invest in. First of all, the stock needs to be fundamentally sound for long, medium term, right? Because we're not interested here about investing. We're more focused on swing trading, so capitalizing on those 2 days to 2 weeks. Fundamentals have to be aligned with technicals. And again, I highlight fundamentals are basically referring strictly to the earnings and the earnings result, and not necessarily trying to interpret the earnings results to see where the price is at. So let's say NVIDIA is going to report on Wednesday after the close, right? NVIDIA pretty strong today, pulled back a little bit, but what would a pullback in NVIDIA mean? If you're looking at the technical level, you're going to probably find 1 or 2 or 3 or more spots in the ongoing super trend where it's going to have support. So depending on where the price action is going to gap up or down to, it may offer another trading opportunity. For example, if it's going to gap down into support, the shock of the earnings is going to hit and it's going to produce a tape bomb.
So that tape bomb obviously creating the lower price, right? But where the price action is going to stabilize, that's going to be very, very important, because usually in about 2 to 3 days after earnings, you're going to find the calibration. And from that point on, the price action is either going to choose to go up based on a strong support level. Investors are going to be very happy, and they're going to be rubbing their hands and say, hey, we have a lower price, we want in. Okay, because this is what investors are looking for. So when you're getting into a swing trade, and when you're having investors, and I mean investors, not myself that I'm trading from home and I'm going to buy 500 shares, for example, but I'm talking about institutions, hedge funds, whatsoever. And when these guys are going in, you know, they are going to produce the upswing or the downswing. Buy stocks usually that are on sale. So whenever you have you're shopping for stocks, look for stocks that you usually wanted to hold in your portfolio, wanted to swing trade, but never got the opportunity to get in. So that is the time when you stock shop, right? So you're going to be focusing on the stocks that you wish you had on their way up. You wish you would have held them on the way up, and now they're finally pulling back. Now it's your time to get ready to ride those stocks, whether it's a Max 7 stock or what have you. So where to buy, when to buy when certain events happen. So for example, right now there's a lot of uncertainty in the market. Still, we have not a lot of clues in regards to the tariffs that are going to hit. We still don't have a lot of information about inflation. We still don't have a lot of, you know, consumer confidence, by the way, is coming this week. I think it's coming on Wednesday. We have GDP data that is coming on Thursday. So we may have a clue as to where the market wants to go, maybe within this week. But until then, things are still, you know, pretty choppy right now. And I think the whole market is waiting on the earnings results from NVIDIA. So NVIDIA is basically probably holding a whole entire market up. But in general, there are events that are happening. So if you're looking for the investor side, you're going to see that there are massive events throughout the years, like the 2000 dot-com bubble, the 2008 financial crisis, the 2016 election, the 2020 pandemic. All these years and all these pullbacks, all this panic in the market has created massive millionaires. So what do I need to, you know, do you really need such events? Well, not necessarily for swing trading, because the market is always going to be, you know, an oscillation. You're always going to see the price pull back depending on the releases, depending on earnings, and that's what's going to make the market a lot more tradable. But if you're an investor, you're going to capitalize on these massive moves. And I mean, if you look at the sequence that they have, you know, happen, they probably happen, you know, every 5 to 8 years. Focus on companies that have thrived and survived over the years. You know, I like to look at companies like Google, like Amazon, Apple, really strong, Broadcom. You know, I love these stocks that are so powerful. I tend to stay away from the airline industry, hotel industry, not unless it's a really short-term swing. Or a momentum type of swing, but other than that, I like to stay away. I'm not a buyer in Eli Lilly. I'm not a buyer in any kind of biotech hotel and anything. So I want to show you an example here. This is Williams Companies. It is a stock that has been compressing to the upside into resistance, and this is ongoing. So this has not triggered yet. This is something that if you're looking for a stock, whether for a long term or a medium term, for a swing trade or for an investment, this is a good stock to watch. The highs here are back into the prior highs from 2014 and 2015. You can see here the double top formation that took the price down, and then it chopped around before it got back into this place. Now, when this breakout is going to happen over $60, this can be explosive. That means that the price action can literally start blasting higher. I have a projection for this stock very close to $80, $100, and $120 for long term, and for short term around $80 to $100. So stay tuned for that. Also, when you're swing trading or even investing, you have to be in sync with the institutions. I never liked the wording that you need to follow. You need to follow the investors. You need to follow. When you're following them, it means that the move has already occurred. And all you're doing is basically you're chasing them. You're always a step behind them. The key to the market is to know where the triggers are, to know where institutionals have interest, and be in sync with their footprints. So walk along with them, not behind them. Types of stocks that I like to invest in, I like all the 4 categories except for the penny stocks where I stay away. They're extremely volatile. I like growth stocks, value stocks, income stocks, blue chip stocks. I love blue chip stocks, but penny stocks I tend to stay away. So how to select winning stocks? Well, when it comes to trading, literally nobody has a crystal ball. However, price action to the left-hand side is going to be your guide as to how the price action will react into those specific levels, right? Because when a stock revisits a prior high, it has 2 options. It either pulls back in a very shallow manner in which it offers you a really great buying opportunity, and that's showing you that the price action is digesting the prior high, is trying to chew up the prior high. Or option number 2 is trying to hold the highs. These are my favorite buying opportunities, and buying into resistance. A lot of traders just say, oh, I'm going to sell into resistance. Well, if you're selling into resistance on a very strong relative strength stock, the pullback is not going to have a measured move for you, because you're going to have probably a very shallow pullback. You're not going to have the outcome that you want. You want to make sure that you have at least 3 to 4 hours into your move to capitalize on, right? And when you're trading pullbacks, basically you're getting half an hour, or you're getting even less than that, or best case scenario, you have 1 hour, which is really bad. So it is just work. When it comes to scanning, it is just work. It's technical, 99%, and 1% fundamental. All you need to do is the stock that you're in, whether it's going to report or not earnings, or when. And if it reports earnings, if you have a stock that you like and you're watching and it reports earnings in a couple of days, just don't take that as a swing. You can do that with options with limited risk, but don't do that with common, because you're stuck in that trade. Okay, and you could, if it goes the other way, you're going to lose a lot more money. I have noticed a theme, and I've noticed the theme because I was scanning a little bit today, and I noticed that we have quite a few stocks in the insurance field sectors that are relatively strong. One of them is AIG. Now, this stock has not broken out. This is a pattern. It's a very, very strong pattern. It also has a target into $100. It's a little bit choppier, and as you can see, it really didn't do much since last year, right? But it's getting back into resistance here. So this is a top watch for me. This is also good right now to watch for a swing trade and also for an investment opportunity, because any kind of breakout of this sort that has a multi-month resistance could potentially be very explosive. Now, let me share with you some of the strategies that I use, some of the criteria that I use. So when I scan for stocks, I look for a good history of earnings, at least 3 years minimum, or at least the 3 prior quarterly earnings beat expectations. I enter the trade after they post the earnings results, and I look for companies that have really good earnings and sales. Obviously, these types of stocks will have the best chances of continuing higher. Look for companies that make a splash. I love to see new products, services, launches, etc. So pay attention to what Apple has to say tomorrow at the shareholders meeting. These are clues as to how the projections are going to be in the next earnings quarter. Also, I look at the technical chart. I always trade with the trends. Like I said, not always, because I like to look for counter trends, and these are 2 to 5 day counter trend moves on momentum. But I do love to look at the volume. again, when the volume is increasing on a particular stock, it means that there's some organized buying happening. And that means that institutions are legging in or are starting to leg in. I like to look for spikes of volume. I like to look for ranges. I like to look for near all-time high bases or shallow pullbacks. And I like to look for fib locations as well. I also look for volatility contraction. The bases also offer you a good idea about how the price action is reacting into a prior resistance or a price support. When the volatility is contracting, that means that there could potentially be an explosive move. Positioning within sector and indices, again, very important to select the stocks that have relative strength within the sector and within the market index, and pick the strength for momentum higher and of course weakness for momentum lower. So don't be very stubborn if you're seeing that the market is, strong, and you're seeing, let's say, a stock that has a little bit of weakness, but it's within a strong sector still and within a strong index. It just means that it has some trouble, going through, or it's losing some of the buyers, or buyers are shifting towards other sectors at that time, but doesn't mean that necessarily that's going to be a sell. And then institutional participation. Institutional participation accounts for 85% of the market movement. And of course, I like to pay attention to some block trades, dark pools, and all that sorts of stuff. So Meta, again, it's a stock that is worth watching because it has been in an uptrend. It's very strong. It's very, very solid. And it could potentially be at a turnaround point in the cycle. Remember, we started the presentation showing you that a stock can move 20 to 30% per year, per move. But not only that, it could repeat that a few times a year. Not a couple of times, but a few times a year. So remember that we have to pull back, look at the massive support level that we have here. We also have the trend line that is pointing higher. And if tomorrow we get above the high of today, we may start another cycle to the upside. But I think a big deal, the big deal is going to be the GDP numbers. Probably the market is looking for the GDP numbers. I was telling you earlier about the theme that I have discovered in the market today, and that is insurance companies. Here's another insurance company, and this is HIG. This is a tighter base, if you guys see it here. So this is actually, I have it on my watch for a buy over 115.20 with a potential target into these prior highs, and my stop is going to be around the 50 SMA, the rising 50 SMA. I may raise my stop a little bit higher because we have a prior low right here. So at the time of the trigger, I may consider this pivot, or I may consider this 50 SMA. It all depends on when it gets to this trigger point and how the price action is behaving. So how to enter trades into swing trading? Well, you have to focus on the cycle, the buy cycle, the pullback cycle, and entries are always early points within that potential leading stocks consolidation or reversal from the correction pattern. So remember, that is basically the pullback. So the pullback needs to be at least 3 bars, 4 bars, 5 bars. I don't like pullbacks that are shallow. So I don't like pullbacks that have 1 big bar or 2 big bars, right? Or even 2 bars into some kind of support. I like to see a much more substantial pullback, ideally into another area of support. And I'm looking for those buy pockets, right? I'm looking for those rotation points that are gonna point me out to a really good risk to reward ratio, and they're going to point me out to a precise entry and a precise stop. So the TOL strategy looks to buy in dominant trends and with confirmation of these rotations. Here's another example of American Express. Look at the base right here. This is something that I love to watch. This shows momentum of compression as well. So I'm going to share some of my personal trading rules, hoping that they are going to help you in your trading process. Trade stocks that have relatively high volume. I don't trade stocks that are lower volume. I like to look for an increased volume compared to the prior 2 to 7 days. So I want to see that institutional accumulation. I trade stocks that have pattern of beating earnings, and I look for fundamentally sound and solid stocks. Ideally, to trade stocks that are trading above the 20 SMA and above the 50 SMA, or coiling or finding support with an additional support, not only the 20 SMA and the 50 SMA, but additional support into that level would bring another layer of confirmation that that level is ready to hold. I'm also looking for confluence areas like overlapping key locations from multiple time frames. So for example, if a daily chart has support level, let's say at 50, but the weekly chart is showing that 50 is not a good level for support, then I'm going to cancel the trade. But if, for example, I have multiple time frames that show me that that particular area has substantial support, I will definitely consider that for a trade. Stocks and ETFs must have, for my trading criteria, at least 1 million shares per day to trade. And also sharp pivots have increased risk of failure rather than rounded bottoms or consolidation. So I'm here to invite you to a special deal. This is the oldest program that we have. This is the Stock Swing Trader. And I have created this program for traders that want to make their money work for them by spending only 10 minutes every single, not even, for example, today I didn't even spend 10 minutes in the market, but it's 10 minutes or less per day, because sometimes you want to raise your stop in a day, or you want to enter another trade. So that is the extent of it. So let's make 2025 the most profitable year ever. So if you decide to join today, we have a special offer for you guys. It's only going to be valid for 24 hours. I'm inviting you to the Stock Swing Trader. It is the oldest program that we have. We started with this, and it's the most successful. We have so many traders in this program, and we're sending out, in fact, the email was already sent out for Monday. And we have an email that is going to be sent out. It's a newsletter that is being sent out on Monday, typically Monday night. The value of the newsletter is $2,999, where we do a comprehensive market analysis. We do macro to micro. It includes the market focus and themes. Remember that we have identified the theme with insurance companies, sector performance, market performance. Everything is analyzed for you. We provide the technical market overview and trades for the week video, in which we explain all the key levels, all the trends, what we're seeing, what has happened in the prior week, what we expect in the current week, etc. We provide you guys with the earnings calendar, the economic calendar with the stocks that are going to be impacted for this particular week. We also provide you guys with a performance portfolio. Let me share with you how this performance portfolio is like, where you're going to have all the trades with the entries, the stops, the targets, if targets achieved, comments, and whether it worked or not, and how much money we made in it. Also, aside from this, you're going to get the pre-launch access to my investing picks. That is $3,500. And again, remember the FNMA, in which we scored over 65% in 5 trading days. Imagine your IRA with your position having 65% already gained for the year, and that is like 4 days into the year. You're going to get access to a private X feed. You're going to get platform layout, each student support via email, which if you have a question about a stock, if you have a question about a stock that I have posted, or if you have a question about a stock that you're watching, so doesn't have to necessarily be, my pick, it could be your pick, but if you want to have my take, again, you have unlimited access via email. You get a risk sheet. This is the position size sheet, where you are going to have a share size calculator, and you're going to get a money management cheat sheet as well. This total value, literally $16,000. We use so many scanners, so you don't have to. So we use 5 scanners where, you know, basically I pay around $4,000 for the software that is helping me with identifying trades, with research, with news, that you don't have to pay on a month-to-month basis. So if you want to be informed, you need to have these. So the stock swing trader, we're offering $500 off the yearly plan. So before I went into this presentation, I went and I saw that the link is not working. So if you would like to join, email me at info@tradeloud.com. More than happy to offer you the discount. It's $500, and the deal is going to be off the table tomorrow at midnight, February 25th. So thank you so much for having me, Metastock, and Jeff, thanks so much. Okay, so I hope this presentation went well now. And hope to see you guys in the stock swing trader.
It went great. As soon as we got it fixed, it went great. Thank you for joining us. I just put that email in the chat. It's info@tradeoutloud.com. Thank you, Anka.
Thanks so much.
All right, very good. Let's go ahead and do this. All right, and let me make me the presenter, and we'll just wrap up a little bit today. So there we go. Before we go, I want to say, I'll try my S sizzle again. I want to say thank you for being here. It's good to have you. I hope you enjoyed it. I hope you learned some stuff today. If you did, great. If you're watching us on YouTube, remember to like and subscribe. It helps a great deal. Shout out to all of our sponsors, AAII.com, Technical Analysis of Stocks and Commodities, Traders.com, the Traders Forum, www.thetradersforum.com. And of course, we're Metastock. Any of the deals that we talked about today, any of the Metastock products, any of that kind of stuff can be, you can get it. I'd invite you to go get it at metastock.com/conf promo. You go to metastock.com/sales chat with any questions that you have. And of course, you can call us at 800-882-3040. A big thanks for all of the presenters that spoke today and all of you guys for watching. Look forward to seeing you tomorrow. We have another great lineup. Thanks for coming today. See you tomorrow.